of labor statistics, the non-farm payroll that rose to by 1,47,000 in the month of June. We have Rick Santelli of CNBC who's joining in with us to give us details on this one.
Rearview mirror, it was the June jobs report. And many trying to get very much a sharp pencil under the microscope glimpse of the breakdown between government and private. Interesting. But do remember, these numbers are seasonally adjusted. And that process sometimes make exact head counts in various areas a little questionable. General trends, maybe, but the sharper the point, the more you need to acknowledge that there are adjustments. These aren't raw data points, they're modified. And we all learned during COVID, and before and to some extent still, seasonalities change, and sometimes the adjustment process isn't as quick to be retweaked as many of us would like. Finally, the details. 147,000 jobs, significantly better than what we were expecting. A drop in the unemployment rate to 4.1. That alone is worth the price of admission in terms of the Fed, because I just don't see any easing, obviously, at the July meeting with these types of numbers. And even at the Fed meeting, we have some job reports in between now and the September meeting, September 17th. But it certainly has been an exercise in understanding the half-full, half-empty dynamics of the economy. Many continue to look for the bad news that doesn't seem to come. And what's interesting with that type of philosophy towards the markets, we've seen that we haven't had a huge amount of bullishness. Thus, we've seen a huge rally. Sometimes when everyone is bullish, markets have a tough time going up. This is the exact opposite. Very few bulls out there, and the dynamics of the economy haven't rolled over. That's turned out to be quite a wild mix to the upside as the S&P and NASDAQ continually flirt with historic pricing records. Even the Dow is only about 1% behind its all-time high as well.
Okay, thank you so much for that. But that's all the global market action that we have for you all this morning. How are all these overnight cues going to be impacting our Indian markets? We have a team of research joining in with us to set you up for trade. Which are the important stocks to watch out for? We'll give you all of that in a Power Prep segment. Hormas, first up, good morning. And what are we watching out for in today's trading session? US job report surely seems to be strong, but will India be actually reacting to that, or a mild muted week is what we would be ending Friday with as well?
Morning, Winnie. And aside of the US jobs report, there are plenty of domestic triggers itself that we need to keep an eye out for today. It's typical, the week has been such. We've struggled to cross higher levels, consolidating in this 200-point range of 25,400 and 25,600, 650 on the higher side. And it's been this yesterday as well. We tried crossing Monday's high, failed to do that. But the good part was we managed to defend 25,400 on the downside. Yet again, the only negative bit though was, unlike Wednesday, we ended very close to the day's low. So that important 25,400 level will be a key monitorable to watch out for. A principal culprit has been Nifty Bank, which took the index higher last week, is dragging the index lower this time around. It's down almost 800 points from the record high levels. And the banking index will continue to remain in focus today, be it the private banks, be it the PSU banks. There have been a slew of business updates that have come out last evening. So all of them, be it RBL, Bandhan, PSU banks like Bank of Baroda, UCO Bank, all of them will be reacting to these business updates that have come in. Of course, devoid of global cues today, because US markets, though they ended higher yesterday, they were short. It was a short trading session. Today is a holiday, and that India-US trade deal continues to remain a key monitorable. So for now, it's indicating a cautious start for the GIFT Nifty. So keep an eye out on our markets today.
What we're watching out for. Look at the Nifty implied open as well. When we started the show, 17 points up, and now very flat, right? 0.40 points is what it's indicating. So flat start, cautious start is what we're watching out for. Let's move on and talk about which are the important stocks to keep on your radar this morning. We have Upasna joining in with us for that. Upasna, good morning.
Good morning, Winnie. Well, lot of stocks on our radar today on the back of Q1 updates. First up, let me start with Marico. The consolidated revenue growth on a YoY basis stood in low 20s. Next is Bajaj Finance, reported a strong Q1 update. AUM saw a growth of nearly about 25% on a YoY basis and 6% sequentially. Bajaj Housing also came up with its Q1 number with an AUM growth of nearly 24% on a YoY basis at 1.2 lakh crore. Bank of Baroda, domestic deposits up 8.1% and domestic advances up 12.5% on a Y-on-Y basis. Bandhan Bank also came up with its provisional Q1 numbers. The total deposits up 16% on a Y-on-Y basis and 2.3% sequentially at 1.5 lakh crore. L&T Finance also reported a strong Q1 update with a retail disbursement growth of nearly about 18% on a Y-on-Y basis and 17.5% sequentially. Vedanta is the next one on our radar with the aluminium production up nearly just about 1% and flat sequentially, and saleable metal of this is down about 7% sequentially and down 5% on a Y-on-Y basis. IEX came up with its June update. The electricity traded volume is up 6.5% on a Y-on-Y basis. And next up is ONGC. The company has signed an agreement with Japan's Mitsui O.S.K. Lines to build, own and operate two very large ethane carriers is what the company has indicated. And lastly, Emcure also in focus, as according to our sources, Bain Capital is likely to sell 2.4% equity via block deals on this counter. So all in all, lot of stocks on our radar today.
Absolutely, Upasana, a whole list of stocks that are going to be on and in focus in today's trading session. But finally, Mangalam is waiting by, as always, to tell us what is going to be happening in the world of F&O. Good morning, Mangalam.
Good morning. So if you look at, the way the market fell yesterday, it seemed like it was an expiry-related move. Why do I say that? Because if you look at, the intraday charts of the Nifty Bank, as well as, the key components, you would see it was only towards the end where the Nifty was holding on to 25,500. Those put writers suddenly had to throw in the towel. And then in the last hour, it was led by two index heavyweights. You had Reliance, which moved to the low point of trade, and we had HDFC Bank. So it definitely looked like expiry-related moves itself. GIFT Nifty is indicating a mild green start. The question I'll be, looking for an answer to is whether this last hour downtick in yesterday's trading session will get readjusted in the first hour of trade today or not. Just keep an eye out on the fact that the US markets are closed for trade today on account of Independence Day. So that implies that when the cat is away, mice will play. We will have a lot of domestic institutional investors, backing a lot of the mid and small cap stocks. The FIs, they continue to sell in index futures. So 2,400 crore worth selling yesterday, added 6,800 shorts, unwound 5,800 longs. And as a result of which, over the last three trading sessions, their net exposure on the short side has nearly doubled from 38,000 to minus 61,000. And the long contracts have come down from 37% to 29% itself. The important part, however, the Nifty, despite its volatility, is holding on to day's low. Yesterday's low was very close to the previous trading session's low, in fact, a shade higher. But at the higher level, around 25,600, we are facing some supply. That's something that we've seen over the last 3 days, Nifty high itself. So that's the broad range that the street is working with. In terms of the mid and small cap indices, like I said, the domestic institutional investors will be in focus. So keep an eye out on that one. And also watch out for Nifty IT. Why do I say that? Because overnight, Wall Street did extremely well. Trump's spending bill has passed. So if the US economy looks a lot better, then you have the IT sector which benefits. The Q1 results come in very soon as well.
Absolutely, Mangalam. Thank you so much for that. Keep an eye out on the IT sector going forward as well. That's an important update there. But more important updates coming in as market regulator SEBI has actually barred a US trading firm, Jane Street Group, from accessing the local securities market. Hormaz is joining in with us with more details on the story. Hormaz, good morning. And what is that update now we are picking up here? And how important will this be for our markets?
Good morning, Vinny. And big update coming in from SEBI this time around. And they have barred Jane Street Group from accessing the securities market in their interim order that was released last evening. And unlawful gains, according to the order, worth almost close to 5,000 crores will be impounded. And since this is an interim order, this amount will be deposited in an escrow account. And Jane Street has been directed to open an escrow account in any scheduled commercial bank. And the banks where Jane Street and their entities have accounts have been told to not allow any debits without the SEBI permission. Now, this all started last year when SEBI had asked NSE to probe any the activities of Jane Street to ascertain any market abuse. The report was submitted in November of last year, and in December it was that the regulator noted that there were certain entities that were running large risks in cash equivalent terms. Of cash equivalent in F&O terminology generally means highly liquid instruments which can be converted into cash and used for trading as collateral. And in February of this year, it was found that prima facie the Jane Street Group appeared considered to be engaging in activities which were in violation of the SEBI regulations. And as per the SEBI's order, NSE had sent a letter of caution to Jane Street to desist them from taking any positions that were manipulative in nature. And Jane Street had even responded to that in February, and in May of this year it was found that Jane Street continues to remain in violation of the caution letter that was sent as well. Now, over the last 2 years, as per the SEBI order, the amount of profit that Jane Street has made through this index derivative trading activity comes up to almost 36,000 crore rupees, and this is across 4 entities. And this is analyzed over a period of 1st of January 2023 to March 31st of 2025. So almost 36,000 crore worth of profit through index derivatives. And this comes when a SEBI order had mentioned that 9 out of 10 FNO traders lose money in the derivatives market. Now, what is Jane Street? Well, they are a global proprietary trading firm employing close to 3,000 people, trading in over 45 countries, and they generally use algorithms to identify trading opportunities. So a big move coming in, almost nearly the largest ever impounded amount in history.
Okay, Hormas, thank you so much for that. But on that note, we're going to sip into a very short break. Up next, we'll bring you India's Defence Acquisition Council, which has cleared the proposal for purchasing military equipment. We get you more details on this story after the break. The Defence Ministry has now cleared 10 proposals to buy weapon systems and military equipments worth 1 lakh crore rupees. So this is a big update that's coming in as well. And Parikshit Luthra is joining in with us to give us details on this front. Parikshit.
Well, this is another big boost to domestic defence manufacturing. The Defence Acquisition Council has cleared at least 10 proposals worth over 1 lakh crore rupees. Now, these are proposals for the Army, Navy and the Air Force and will go to domestic manufacturers. What does this really include? Well, the government has approved proposals for procurement of armoured recovery vehicles, electronic warfare systems, integrated common inventory management system for the tri-services and surface-to-air missiles, which are very important for our air defence as well. Now, these procurements are aimed at giving higher mobility, effective air defence and better supply chain management to the three services and also boost the overall armed forces preparedness after Operation Sindoor. We've also seen proposals being cleared for moved mines, mine counter measure vehicles, super rapid gun mounts and submersible autonomous vehicles as well. Now, this is to mitigate potential risks posed to naval and merchant vessels. We've seen heightened tensions in the maritime domain over the last few months, and this is to boost the capabilities of the Indian Navy to provide security in the high seas. There will be a greater push for indigenous design and development, and these acceptance of necessity documents have been accorded under the Buy Indian, indigenously designed, developed and manufactured category. So this is aimed at boosting Indian supply chains and procuring from the Indian private sector.
Absolutely, Parikshit. On that note, we'll keep an eye out on those defense stocks also in today's trading session. Let's move on. And 2 days after imposing a fuel ban on old vehicles, Delhi government has made a U-turn now. The government has cited tech challenges and has said that ban is not feasible following public outrage over the proposed ban. Shivani is joining with us and she's filed a report on the same.
Well, it seems like a major rollback on policy. The Delhi government has put on hold the fuel ban for end-of-life vehicles just 2 days after its implementation. The move comes amid widespread public backlash, technical failures and concerns over enforcement infrastructure. The now suspended policy had aimed to deny fuel to deregistered vehicles identified through the ANPR cameras installed at fuel stations across Delhi. But the system, the government admits, is riddled with flaws, cameras not working, sensors malfunctioning, and speakers not functional at many locations. In a letter to the Commission of Air Quality Management, Delhi's Environment Minister has said that the plan is premature and potentially counterproductive. The government warned that the Delhi-only ban would lead vehicle owners to procure fuel from nearby NCR cities like Gurugram and Ghaziabad, possibly triggering a black market of the fuel. Importantly, the government stressed the lack of NPR infrastructure in native states, making effective implementation across Delhi NCR currently impossible. So for now, it is a U-turn on the ban for fuel on end-of-life vehicles in Delhi.
Thanks for that, Shivani. In fact, let's also listen into what the Environment Minister in Delhi had to say about the fuel ban.
Because of the technological and extremely complex system and lack of integration with neighboring states, there is a public discontent and outcry. In these set circumstances, it is not feasible to implement this system where fuel is being denied to EOL end-of-life vehicles identified through ANPR installed at petrol pumps in Delhi.
Okay, on that note, we are going to slip into a very short break. After the break, we'll get you cues in the world of commodities, so stay tuned in for that. Welcome back to Power Breakfast on CNBC-TV18. Now, getting you the latest related on Trump developments. What has happened overnight over there? Dia is joining in with us, as always, in our special segment, Trump Watch. Dia, over to you.
Starting off with the big, beautiful bill, President Trump has secured a broad economic policy shift as the House passed his $3.4 trillion fiscal package on Thursday. The bill cuts taxes, reduces spending on key safety net programs, and rolls back major clean energy policies introduced under Joe Biden. Trump called it a rocket ship for the U.S. economy and announced he would sign it Friday at 4 p.m. in a ceremony at the White House.
We're sort of celebrating like the biggest bill of its kind ever signed, and it's going to make this country into a rocket ship. It's going to be really great.
Meanwhile, US President Donald Trump said he did not make any headway toward ending Russia's war in Ukraine during a call with his Russian counterpart Vladimir Putin and expressed frustration at the ongoing conflict. President Trump said he wants safety for the people of Gaza ahead of his high-stakes meeting next week with Israeli Prime Minister Benjamin Netanyahu. The meeting is expected to focus on efforts toward a potential ceasefire in the region.
Still want the U.S. to take over Gaza as a part of a peace?
I want the people of Gaza to be safe, more important.
So that
I want to see safety for the people of Gaza. They've gone through hell.
And despite earlier talk of diplomacy, the U.S. is ramping up economic pressure on Iran. The Trump administration announced new sanctions targeting companies involved in trading Iranian oil just days after U.S. airstrikes on Iran's nuclear infrastructure. Officials say the targeted network handled billions of dollars in oil shipments. Now, on the trade front, the White House may take its next step as early as Friday. Trump said letters could go out to trading partners announcing unilateral tariff rates with a July 9 deadline fast approaching for new trade deals. In response, Canada's finance minister said Thursday that Canada sees a clear path to negotiate a better trade deal with the Trump administration, pushing back on speculation that the country might be forced to accept baseline tariffs on all exports to the U.S. And from Europe, French President Emmanuel Macron is calling for swift movement on an EU-US trade deal. He said he wants an agreement as soon as possible with the lowest tariffs possible as the US deadline for a final accord quickly approaches. That's all for today. Now back to you, Vinny.
Thank you so much for that, Dia. But let's move on and talk about what's happening in the world of commodities. Manisha Gupta is waiting by to give us those details. Good morning, Manisha. What are we watching out for? Crude, gold? What should we keep an eye out on?
Thank you for that, Winnie. I'll start with the crude oil prices because we are up by 2% in this week after that very sharp decline that we saw in the crude oil prices in the previous week. Well, the U.S. is restricting trade of Iran oil. The U.S. Treasury and State Departments have announced sanctions against network of entities, shadow fleets of vessels involving in Iran oil exports. So that is what is adding premium to prices. The markets will also focus on the OPEC Plus meeting on 6th of July. An interesting report from Barclays says that they are now raising Brent oil forecast by $6 to 72 barrels per barrel for 2025, another $10 for 2026. They're looking at improvement in outlook for demand going forward. So one such initial reports coming in, which is supportive of the crude oil prices. What has seen profit taking, though, in the overnight markets has been the gold and silver prices. The US dollar, the Treasury yields, the US stock index rose after the US payroll was above expectation and unemployment rate lower than forecast, and that has led to some profit taking in precious metals.
Okay, Manisha, thank you so much for that. So that's an update coming in on the commodities front, crude and gold, both where we are keeping an eye out on. But that's all the time we have on this edition of Power Breakfast on CNBC-TV18. Nifty implied open is indicating a very muted start, a cautious start for the Indian market. Keep an eye out on that. Up next, your Bazar morning call to take you through all that action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazar Trading Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. It is the 4th of July and perhaps in some ways the US president couldn't have asked for more because, it's almost a perfect backdrop for the US market. Is that going to give enough ammunition to the bulls here back home to get their mojo back or not? We'll discuss this, all the cues and news that matter along the way. I'm Surabhi Upadhyay, with me Mangla Malu and Rima Tendulkar. Hi guys, morning.
Hi, 4th of July, and for the US, fresh highs on the S&P, NASDAQ, and that big, bold, beautiful bill is soon going to become a law. But back home, just looking at Asia, there appears to be a little bit of caution.
Well, there is a little bit of caution. We'll see where that goes. And yesterday we saw that last hour decline on account of expiry. The question is whether that gets adjusted today in the first hour or not. But speaking about the first hour and last hour, I'm looking at the test match.
I knew you'd say that. I was wondering, no, you were not looking at US markets.
I mean, I was looking at the US markets, but then they were doing what they were doing, right? You watch the Indian markets, you watch the Indian batters, 259 for Shubman Gill and then Akashdeep coming in, taking quick wickets. We're poised for a good game. Let's see where that goes for both markets and the Indian Test cricket. So far, so good.
Good feeling this Friday. We'd perhaps say that. So let's get started and tell you about all the key cues. So like we're saying, the big headline is the big, beautiful bill, but I'd come to that a little later because the trigger for the market, which shut a little early for the 4th of July holiday anyway, was the fact that the jobs report is way better than expectation. And that's what led to record highs for these two indices, the S&P 500 and the NASDAQ, once again galloping along. So we've got about a gain of, almost 1% on the key US indices. Coming to non-farm payrolls now, the estimate was 110,000. The actual number came in even higher than the May number at 147,000. So looking very good. The unemployment rate actually ticked down as well from 4.2 to 4.1%. Now, as a result of this, equity market surged, but there was some unease in the bond market. Yields marched higher, almost 5 basis points higher on the 10-year, almost 9-10 basis points higher on the 2-year. Because with this kind of a jobs report, the market is now scaling back its expectations of a Fed rate cut, at least in this meeting, in the July meeting. If you look at the CME Fed Watch tool, then it's suggesting that there is a 95% probability now that the Fed is going to stay pat on interest rates. So that's what the big headline was. In fact, this jobs report also pulled up the dollar. The dollar index in intraday action had hit, a level as high as 97.20 thereabouts. This morning, let's see where it is. It's still above 97. So pullback happening on the US dollar as well. Now let's talk about this big, beautiful bill. It has become a reality, and that's what, the US president wanted. He wanted to sign that into law on the 4th of July, on Independence Day, and that's what will happen now. The passing majority was fairly narrow, must point that out as well. It was 218 votes in favor and 214 against. 2 Republicans voted against the bill as well. So it was not without its share of political drama. We know it's going to add about $3.3 trillion to the US budget deficit. And there are big sort of tax cuts, tax extensions, big deductions as well, and the very contentious, clawback from the tax credits that EVs were getting. That was, of course, the big talking point as well. So that's the big, beautiful bill. The other positive news came in the form of Apple. I mean, just giving you a sense that corporate America is chugging along. Apple finally saw its China iPhone sales rise by about 8%. And it's the first time that this has happened in the June quarter in the last 2 years. So if you're looking for more incremental positives, there were plenty in US market action yesterday. So all in all, looking pretty good. Now, will all of this translate into buoyancy for our market? That's the question, because global cues have been actually fairly all right through the week. Yet we've spent the entire week in consolidation. The Nifty has been a very tight, trading band of about 250 basis points. We're at the lower end of that trading band as we speak. The upper end is, of course, 25,650 thereabouts. So can we get back to the highs, at least, of the trading range today? Let's see. We'll find out. Going forward over the next couple of days, I just want to highlight a couple of events that will drive market action. Maybe it's the calm before the storm, you can say. And why do I say storm? There's earnings season coming up. Obviously, clarity on overall global US tariffs beyond Vietnam, clarity on the India-US trade agreement as well. And let's not forget the GST meeting is going to take place in July as well. And that perhaps is a big event that markets will watch out in case there are meaningful changes in the slabs themselves. I want to just end with a lookout to defense stocks. Watch for all of these because yesterday the Defense Acquisition Council again approved proposals worth a massive over 1 lakh crore rupees is what we're talking about. So maybe some of the stocks will perk up. They took a bit of a breather. So watch for this. Momentum is anyway on the side of the defense names. And they're looking at procurement of all kinds of systems and armored recovery vehicles, electronic warfare systems, surface-to-air missiles. So the whole gamut. So watch for defense, perhaps an interesting area to observe today. Rima.
Indeed. So take note of the defense news and the stock price action today. But the action is warming up, right, in individual stocks and stories. But quickly, let's pull up Asia because the Korean markets and the Hong Kong markets, that's Hang Seng and Kospi, both of them are down nearly 1.5% as we speak right now. And there are cuts even in the others. The Taiwanese markets is down more than 0.5%, and Nikkei too has a red tick. The GIFT Nifty for now is on the flattish side. But this whole week, markets have been extremely range-bound but resilient. The Nifty is down about 0.9% week to date, but midcaps managed to buck the trend with a gain of close to about 0.5%. And we've oscillated. The Nifty at least has oscillated in a very tight band. So on the way up, it's the Monday's intraday high of 25,670. And on the way down, it's that 25,378, which was the intraday low. And it pretty much ties in with some of the moving averages. The 10-day simple and the 10-day exponential moving average is at that 25,350 mark. In terms of flows, the DII is bought 1,333 crore in the cash market. The FI is net sold nearly 1,500 crore. They've been selling through this week. In terms of individual stocks, it's Marico. We'll discuss all of these in greater details, but just to quickly put the snapshot, the India volumes have hit a multi-quarter high, revenue growth in low 20s. Bank, some of the updates have been a bit disappointing. So for Bank of Baroda, the loan growth and the deposit growth has declined on a quarter-on-quarter basis. Bandhan Bank, again, the loan growth has fallen 2.5% quarter-on-quarter. RBL Bank, Yes Bank, again, the updates from some of the banks have been on the weaker side, but NBFC updates have been encouraging. So Bajaj Finance, for instance, has reported an AUM growth of about 24%, and L&T Finance too is ahead of expectations. So action is warming up over here. It's a Friday. The trading week is drawing to a close. Mangalam, what are you looking at?
Well, I feel a lot better in today's trading session than what one would say in the last hour of yesterday's trading session. And the reason why I say that is because yesterday's last hour decline seemed like it was largely on account of options expiry day. Why do I say that? You know, if you look at the intraday chart of the Nifty, the bulls were hoping for that 25,500 mark to hold. It wasn't holding for a while, and thereafter towards the last hour, we saw all those put writers run for cover and then throw in the towel. And if you look at not just the Nifty, the two biggest components of the Nifty, we had Reliance as well as HDFC Bank. Both of them saw a big decline only in the last hour, telling you that a large part of the last hour move was expiry related. Now, if you look at the GIFT Nifty is indicating a flattish start, the first thing we'll be looking at is will Reliance and HDFC Bank undo some of the big gash that we saw in the last hour of trade yesterday or not. And the other part is that the US markets, they're shut in today's trading session on account of the Independence Day, which implies that when the cat is away, the domestic mice play. We'll watch out for all those small and mid caps as well. But the FIs, they're selling in index futures, lock, stock and barrel. Yesterday, they sold about 2,400 crores, unwound about 6,000 longs, added about 6,800 shorts. And just to put things into perspective, over the last 3 trading sessions, the FII longs have dropped from 37% to 29%, and the net exposure on the short side has actually doubled from around 38,000 contracts to 62,000 contracts itself. But be that as it may, for all its volatility, the Nifty is holding on to its lows. Yesterday's low of 25,384, pretty close to the previous trading session's low of 25,378. At the higher level, there is supply, 25,600 thereabouts, because that's where the highs have been contained over the last 3 trading sessions. So the Nifty day's high for the last 3 trading session comes up for you. The street does not believe that this range is likely to break out. At the lower level, 25,400. At the higher level, 25,600. So this 200-point range is what everyone's betting for. Small and mid caps are the ones that I'm talking about. We'll keep an eye out on largely because domestic money will be at play today. And the other large index that may be in focus is Nifty IT. Because even if the Nifty is about 3% away, the Nifty IT is 16% away from its highs. Trump's spending bill being passed, stronger US economy, Q1 results soon. All of these factors should work for the IT stocks. And that's something I'll be watching out for.
Okay, all right, Mangalam, thanks very much for that. We've discussed all the usual cues and laid them out on the table for you. But let's also not forget that there is a big regulatory order out there, and it's the Indian market regulator that has completely cracked down on Jane Street. And this is after months of analysis, even discussions with the Jane Street group. Finally, what SEBI is saying is that Jane Street has to be completely stopped from all action in the securities market. In fact, banks have been asked not to do any further debits with entities associated with Jane Street. Not just that, Jane Street has to give back that big amount. That's close to $500 million, over $500 million, almost 4,900 crores. This amount has to be impounded from Jane Street. SEBI's contention has been that it gave enough time, in fact, even a warning in February to Jane Street to desist from undertaking any activities which were in violation of securities laws. But it seemed that this remained unresolved, and Jane Street and its associated entities were still taking very large cash-associated positions while dabbling, of course, in the options market. And this goes back to an earlier episode where there were talks about market abuse, market manipulation as well, perhaps, especially on expiry days, when it came to very large positions in the options side of the market. We'll be discussing this with experts. We'll get Anuj to join in as well. But, this is a very strong message to all the large algo trading, institutions out there that market abuse or any sort of market manipulation will not be tolerated. And remember, the exchanges were a part of this investigation. The NSE had been asked to submit its report as well, which it did a couple of months back. And after the NSE's submission, a warning was given to Jane Street in February. Clearly, that didn't prove to be enough. And finally, there is this complete cease and desist order that's now coming from the regulator.
Indeed, one of the biggest crackdowns that we've seen on algorithmic and high-frequency trading in the history of India. We'll discuss that in greater detail. For now, let's invite on the show James Knightley, Chief International Economist at ING. He's here with us. James, thank you very much for joining in. First, let's get chatting about this big, bold, beautiful bill, which is soon going to become a law. Now, the Congressional Budget Office, CBO, is talking about a deficit of $3.4 trillion over the next 10 years. What are the economic implications of this bill for the US economy and even for the world economy?
Yeah, I think there's an important distinction that we've got to make. Firstly, this does add a huge amount of debt to the US government's debt pile, but it does very little. It does next to nothing to actually boost US growth because, in fact, if we look at what the effect is of this extension of the 2017 tax cuts, and that's what the bulk is, this is debt that now has to be acknowledged. But of course, because it's an extension, it means my tax bill doesn't change next year versus this year. Likewise, tens of millions of other Americans will not see a change in their incomes whatsoever. Moreover, what we've got to remember is that there's a huge amount of spending cuts as well. So overall, this bill is actually quite a significant headwind to the US economy in terms of growth. Also, remember on top of this, what other fiscal initiatives has Donald Trump introduced this year? One is tariffs. That's effectively another tax bill of about $2.8 trillion over the next 10 years. And on top of that, we've got the spending cuts from Elon Musk's Department for Government Efficiency, which is probably running at about $200 billion right now over the next 10 years. So actually, what we've got is an almightily massive debt pile coming through for the US economy to try and get people to lend to it but also it does very little good in terms of supporting US growth.
So in light of that, what do you think the US Fed would do from here on? Because on the one hand, you have, the US economy, the jobs data was fairly stable. At the same time, you have a lot of spending that the government is doing. All these tend to be slightly inflationary. This at a time when everyone is expecting it to go ahead and cut rates. The yields saw a bit of a spike yesterday. What's your own assessment of what the Fed would be doing from here on?
Yeah, I mean, obviously the Fed are under a lot of pressure. Donald Trump was last week saying that the Fed should cut 200, 300 basis points. And then two of the appointees that Donald Trump nominated back in his first term got in behind him and said, yeah, we could vote for a 25 basis point cut as soon as this month in July. But I think the rest of the committee are far more conservative. Jerome Powell made it quite clear that he thinks that the US economy is in relatively decent shape and that they've got time to assess the impact of the tariffs on inflation. That's what they're really concerned about, because if you remember back in 2021, 2022, the Fed was telling us inflation will be transitory from all of these supply shocks post-COVID. And of course, it wasn't. So the Fed really does want to make sure that it can give the green light to rate cuts. It needs to see what the tariff narrative does. So I think we're going to have to wait another few months. I certainly think they will be cutting before the end of the year, but I just think that to get clear evidence that inflation is not more permanent because of these tariffs means that it may be a December rate cut rather than a September rate cut that the market is currently pricing.
James, hi. Morning. Can't really blame the Fed, can we? Because data out of the US has been so strong, so resilient, including the jobs report last night, right? It's almost like the US is gold-plated right now. Markets are surging. Macro data is looking positive. And so far, corporates have also pretty much held up. We'll see soon enough. On inflation, though, what are you penciling in? What is a baseline tariff case that you're working with? And therefore, what is the pickup in inflation that you're estimating?
Yeah, I think it's what we need to focus on are the month-on-month rates, because if we look in the context of what month-on-month inflation readings do we need to see to deliver 2% year-on-year inflation, it's 0.17. That's the key threshold. If the number comes in at 0.17 month-on-month or below, we're in decent shape. But if it runs hotter than that, we're going to be moving away from 2% year-on-year in terms of the run rate. So that's the key threshold. My worry is that over the next 3-4 months, we're not going to be seeing 0.17s. We're going to be seeing 0.4s, possibly 0.5s. And in that environment, I think the Fed's going to find it very challenging to justify cutting rates, unless, of course, the job market really starts to weaken very precipitously imminently.
James, just getting back to that earlier point about the bill, where you're saying that despite the tax cut, it's not going to result in a fiscal push and boost growth. And on the other hand, you perhaps will be looking at a bit of a debt spiral with debt ballooning. But the bond market in the US appears to be fairly sanguine, just going by the rate on the US 10-year yield. So, I mean, tie that in with us. Shouldn't the bond market be worried and signaling that?
I think it should be very worried. Well, the bond market itself is not necessarily worried. It's about getting the investors to keep lending to the United States government. That's going to be potentially a little bit more challenging because we've got to remember that there's two phases. At the moment, the bond market is focusing on the Fed, focusing on the lower Fed funds rate story. That's, I think, what the key driver is right now. But the medium to longer term story when the Fed is no longer cutting, when the Fed is potentially going to be hiking rates, I think there's going to be a lot more nervousness about the bond market. What sort of returns you need for the risk that you run? And I would argue that we could well see bond yield come under upward pressure because we're going to see a wall of issuance coming through over the next few years. When you've got foreign investors which own 25% of the bond market, seeing the dollar continuing to weaken, and you've also got the Federal Reserve, which owns 15% of the bond market, still selling. It puts the real onus on domestic investors in the United States to step up, to lend to the US. And as I say, we're just a little bit nervous that we could see medium to longer term a lot more upward pressure on Treasury yields as the government tries to sell this debt.
Okay. All right, James, we will leave it on that note for this morning. Thank you very much for joining in with Perspective. We'll see what the next couple of weeks and days bring. Hopefully more clarity on the tariff front. Well, with that, let's move on and quickly tell our viewers more about what's lined up on the show over the course of the next 2 odd hours. Coming up at 8:30, we discuss the SEBI order on Jane Street threadbare. What does it mean, not just for Jane Street, but for overall market construct? Could it have any kind of implications in terms of trading volumes or sentiment? Gurmeet Chadda and Prakash Diwan will join in. At 9 a.m., we'll be joined by Nitin Agarwal of Motilal Oswal Financial Services. We talk about a lot of these Q1 banking updates that have been pouring in. What do the early signs tell us? At 9:20, Manish Gunwani of Bandhan AMC joins in. He's our market master of the day. At 9:30 a.m., we'll be in conversation with the management of JSW Infra. We'll talk about the company's FY26 outlook and their plans with respect to capex. After this, Shikhar Agarwal of BLS International is going to be with us at 9:40. We'll talk about demand trends amidst geopolitical tensions. And about 9:50, Rajiv Kale of Thomas Cook joins in to talk about summer travel demand and overall trends and expectations for FY26. And towards the end of the show, in our special segment, It's the Economy, Lata analyzes Credit Bureau CRIF's report on how India lends with Sachin Seth of CRIF India and South Asia Madhusudan Ekambaram of Credit B Financial Services, Kanika Paricha of Union Bank of India and Sudipta Roy of L&T Finance.
All right, with that, we'll step into a short break. But as we do that, we have a lot of stock-specific action to track today. We'll get to it in just a bit in our special top 10 segment. But today, we're looking at Bajaj Finance, Bajaj Housing Finance. We have Marico, AU Small Finance, L&T Finance, IEX, all of them on the back of their first quarter update. Defense vendors that are on our radar on the back of positive news flow. The big government spending bill that was announced yesterday. Bank of Baroda, Emcure, and Trent are stocks that are likely to open in the red.
Welcome back. In a dramatic turn in the Indian financial markets, SEBI has barred the global trading giant Jane Street from accessing the Indian securities market, citing alleged manipulation, and they're also impounding gains to the tune of 5,000 crore rupees. Prashant is now joining in with his thoughts on this entire episode. Prashant, hi, good to see you.
Good morning, Rima. Good morning, Surabhi and Mangalam as well. You know, this is big, and it's in terms of regulatory action, perhaps as big as it gets. And the primary reason for that is for the last 2 years, if you remember, starting in the middle of 2023, we've been sort of reading, hearing about this sort of, entity called Jane Street. I mean, there are other entities in this sort of category of players in the market. There are players like Jump, Citadel, but Jane really, has been the focus of attention. If you remember, the first time these sort of articles started to appear were in the foreign press. Which I still remember that article which said that they made $1 billion in net profits that year. I think this was in 2023, and of course after that there has been a litany of press coverage on it. I remember the last news item which came through was one of the Indian publications, long-form publications, which said that the mysterious hand in the market, which moves market willy-nilly, as they desire. So this is, in a way, the culmination of all of that, and the regulator is now stepping in. I'm sure you guys will, of course, we've been telling our viewers what has been done by SEBI in terms of asking these entities and asking banks which are holding the profits which Jane Street made not to be disbursed to Jane, not to be taken out of India. And of course, barring them from capital markets, etc. So the modalities of the order, I'm sure we've been sort of telling our viewers. What I want to do here, guys, is just tell you what SEBI has found in terms of their order, the modus operandi on the basis of which this order has been passed. So there are two sharp points. There are two sharp strategies which SEBI in its order has highlighted. Number one is, and there's been an inkling of this in the market for a while. Essentially, you take remember, the options market is much larger than the cash market, right? It's 300, 400, 500 times bigger than the cash market. On expiry days, even larger. So the inkling always has been that, this entity would move cash markets to benefit disproportionately in the options market. To give you an example, to move the cash market, you need much lesser amount of money. So, for example, you put in 5 rupees, 10 rupees to move the cash market to wherever you want it to. And this, by the way, is all happening in the same day. So in the morning, say from 9 o'clock to about 11:30 or so, in the first 2 hours of trade, you have, Jane Street moving the cash market, in the way that desired. So let me just give you a specific example. So buying 5 rupees worth in the cash market, at the same time, you're taking an opposite position in the options market. You're selling calls and you're buying puts, which essentially is nothing but going short in the market. So, cash market, you buy, the price goes up, say, for example, the Bank Nifty. And by the way, bulk of this investigation which SEBI has done is all on the Bank Nifty. Very little of it is based on what they found on the Nifty as a contract. So in this example, you bought a little bit in the cash market. You were able to move the cash price on the basis of which all index options on it, all index values are determined. So the retail, the general audience, the public, for example, at large, sees the cash price go up substantially. Sometimes 500 points, 1,000 points. We've all reported on those wild swings during the day. And they think, well, the market's going up. But this entity at the same time is actually taking an opposite position in the options market. They're selling calls, they're buying puts. And then in the second half of the day, so this has happened in the first 2 hours, 2.5 hours. And in the second half of the day, you dump the cash position. So the cash price comes down dramatically to where it was before they ramped it up. And then you unwind your calls, the calls that you've sold and the puts that you've bought. And then you profit disproportionately. With a small amount of position, you're able to move the cash market. And then you're able to profit disproportionately in the options market through these calls and puts. And this, by the way, is all happening on a single day. First half, ramp up the price on the cash side, sell the calls, buy the puts, and reverse all of it in the second half. So this is one. Second, very quickly, and the second strategy, the second modus operandi, if I can call it that, is even happens in an even shorter time frame. This all happens typically in the last 1.5 hours of trade. So for example, these entities go short the Nifty bank in a big way using options, etc. And then you essentially sell so for example, if this is a Bank Nifty, you sell the constituents of the Bank Nifty in the cash market to drive the price down of the index itself, and then you square things off, and that's how you benefit. So the second one is pretty straightforward. The first one spread through the course of the day. So these are the two sharp kind of modus operandi which SEBI has found in its order, on the basis of which they've gone ahead and if I can call it this is a cease and desist order. I've also spoken with sources in SEBI who say this is a kind of a cease and desist order. Investigations will continue. Bulk of what they found is on the Nifty bank. This is all Bank Nifty, mostly Bank Nifty, but they suspect that similar things would have happened on the Nifty as well. on into which investigations will continue as we go forward. I also asked my sources in SEBI whether other entities, it's not just Jane, there is for example Jump, there is Citadel, there is Millennium, whether other entities are also have they found these kind of things with other entities, and can we expect something like this in terms of an order? What I was told is it's Jane. I mean, by far, in terms of the size of positions, in terms of the delta that they were running on a daily basis, by far the number 2 player does not even come close. So no, the answer to that question from my source in SEBI was no, this is limited to Jane. But the point is, this is for now a cease and desist order, and investigations will continue into what other tactics, what other strategies that they've used to sort of profit unfairly, as SEBI calls it, in its order. Guys, back to you.
Prashant, thanks for that, and thanks for putting it in context. And those strategies really explain perhaps what was going on. While there's nothing, it's not against the law to take one position in the F&O market and take an opposite position in the cash market or vice versa. I think the scale at which this was being done with the intent, that is where the problem was. It's been enough to pull Prashant back. Prashant, sorry, we had to, truncate into your, make inroads into your holiday. But, Prashant, just hang on for a second, because Anuj has also joined in. It's good to get Anuj back in the studios as well on this. Given the scale and magnitude of this news, Anuj, it's a large order, and it's a big message that the regulator is sending across, right? They're saying we're impounding close to $500 million. You've done wrong. We gave you time to, wind up your shop, but it hasn't happened. But my first question to you is, will it have any market implication, because Jane has to now wind up everything?
Surabhi, good morning. This is an interim order, and I'm sure that Jane Street will appeal it. And look, at the end of the day, we have to be very careful about this, and this is what Jane Street would say, that making money is not a crime, right? I mean, at the end of the day, yes, they disclose it. I'll tell you a very funny story, how this whole thing started. In April 2024, which is when we at CNBC Awaaz first picked this up, in 2024, Jane Street had a case against Millennium. They accused Millennium that Millennium poached 2 of their traders, and they made huge money because of that. And Jane Street said, look, we had a lot of resources on the system, which helped us make $1 billion. So that was when it first started. And next year, actually, Jane ended up making, that was in 2023. In 2024, Jane ended up making $2.3 billion from the Indian market. So $1 billion was an eye-popping number, $2.3 billion, of course, even more eye-popping. And Jane and Millennium settled their case, but it gave SEBI, a peek into what was happening. Again, this is no front-running case, so it will be very tough to prove, obviously, and I'm sure that Jane would go to SAT and then maybe even Supreme Court or whatever. But the issue here is, in a nutshell, what was happening, especially on the Bank Nifty, while the other order on Nifty and Sensex may also come. For example, on Bank Nifty, and we always say that Bank Nifty is a very lopsided index. Why was this more prevalent on Bank Nifty compared to Nifty and Sensex? Because on Bank Nifty, you have 2 stocks, HDFC Bank and ICICI Bank, which primarily account for almost half of the index. So, you have one HDFC Bank which moves 1%. Now, you move HDFC Bank 1%. Suppose you sell a lot of HDFC Bank, but before that, you bought put options of Bank Nifty. And that HDFC Bank falls by 1%, but that put option from 100 rupees becomes 400 rupees. So that's a 4x return. And that is where obviously, when HDFC Bank falls all of a sudden, some funds will come and buy HDFC Bank, and the price will eventually go back to the equilibrium. And that's what was happening. Even if you look at yesterday's price move, look at what happened intraday in a lot of stocks. And that is where you will square off these positions and make huge money. So if you see the table, in index options, they made 43,289 crore, but they lost 7,680 crores in futures. Because that is where, you ended up losing the trade. The same would happen on the other way around. I mean, if you're buying call option and, you're doing that. So eventually that, in a nutshell, is what was happening. The market impact, you asked me, the market impact would be restricted to 2 or 3 stocks. I think BSE, for example, today could be one of the biggest casualties because, a lot of volumes on BSE, I am told, were being generated by hedge funds. So in that sense, there could be some impact, though my sense is at lower level, even that will see some buying, because first of all, this is not a final order. And second of all, I think this is going to escalate. I mean, Jane Street, obviously, if you're making $2 billion, you have deep pockets. You you will fight this case, and you will put if needed 500 crores in the legal fees or whatever, but you will fight this
No,
case.
Jane Street is one. The other thing is that now that this has been unearthed, but a lot of other hedge funds would be doing the same from here on as well. So will this really stop at some point in time? Because this is, like everyone said, this is not entirely illegal. It's just positioning that they are taking. Right?
Yeah, Mangalam, that is where, I tell you earlier what was happening was that you had daily expiries. So, so to curb that, SEBI said, okay, we will now restrict the weekly expiry to 2 days. Earlier, we had Monday to Friday, all days expiry. Now, if you see, our volatility has restricted really to Tuesday and Thursday. Yesterday, for example, there was a lot of volatility. The whole issue boils down to whether, what Jane Street was doing was illegal in nature or not. Was it market manipulation or not? At the end of the day, making money is not a crime. 90% traders were losing money, but someone was making that money, and that mostly was on the other side. I think even Samir Arora had tweeted about it earlier, long back, that, a lot of these hedge funds are making money. Why are we letting them do it? We, as in the retail traders, because, there's no way you can fight these machines. You remember Terminator, right? You can't fight that machine. That is going to just kill you. So that is what was happening. The retail trader was getting killed. The whole issue, and I keep harping on this point, the whole issue is this will escalate. I'm sure this is not the final order, and Jane Street will appeal. Whether SEBI will be able to prove that there was something illegal about what was being done. At the end of the day, it just boils down to that.
From my experience, I have traded prop for about a year and a half before I joined CNBC-TV18. Obviously, that time there weren't as many volumes. But the concern that time and the concern now is the same. The depth is not as much. If you do about $1 billion worth a trade, immediately the price impact will take place.
Especially on Bank Nifty. Especially on Bank Nifty, because that was, you have a 12 stock index in which 2 stocks account for what, 50% of the index. So that is rather.
That's really well put, Anuj. And let me quickly go back to Prashant for a final word on this. Prashant, really, that's what it is, the crux of it. And this is going to be fought out in the legal courtrooms, right? Whether taking opposing positions between the cash market and the F&O market, is it really illegal? Technically, it's not. That's what hedging is all about. But this is a different level of, algorithmic trading. Final thoughts?
No, it's going to be it's absolutely right. And Surabhi, I think we've discussed this on the show in the past as well, right? When we sort of spoke about as I said, this inkling was there. I mean, I saw this order at 5 in the morning, and I immediately said, well, because the inkling was there, well, this is what they were doing, that they would take outsized position in the options market, use a small amount to move the cash market, because, the cash market is much smaller, and then kind of sort of, reverse those trades in a very short time span. But just, guys, think about it, right? Over the last actually last year and a half, how many times have we reported on wild swings, 1,000 points, 1,500 point moves, just out of thin air, which comes, disappears, and then it's almost as if nothing happened. And I think, this order now and the modus operandi that I first explained, the two ways in which the markets were moved, explains so much, if you think about it. And of course, the legal matter, we'll leave it to the lawyers. There are securities lawyers, there are experts, there are SEBI officials, etc., who will who'll all weigh in terms of whether this is illegal, whether this is right, whether this is wrong, and whether Jane Street is liable or not. But just as as people who've reported on daily markets, hourly markets, I think what SEBI has put out in its interim order is an eye opener. And absolutely, as I began by saying, this is an interim order. I've been told very, very clearly the bulk of the focus has been on Bank Nifty. They've not really gone into what was happening in the Nifty in any great day, except I think one day on the 15th of May, I think, when they were when they found irregularities in the Nifty as well. But otherwise, this is primarily focused on the Bank Nifty. So once this order, as this order goes into effect, investigations will continue in terms of what they've done as far as the what has happened on the Nifty as well. By the way, for a lot of our viewers, Surabhi, Mangalam, Rima, Jane Street would be sort of, people would wonder and scratch their heads and say, well, who is Jane Street, right? Who are these guys? And I think it's an absolutely legit question to ask. And the reason why many people don't know about Jane Street, unless you've sort of, so inclined to go in, dig in, and sort of, do a deep dive on who these guys are, it's because they are so secretive. And that goes back to the point which Anuj was making earlier. The first time I think all of us heard about Jane Street was when I think it was Bloomberg which put out that story. This is back in 2023 that there was a fight between Millennium and Jane Street, and Jane Street was suing Millennium. It's one of the most secretive sort of trading organizations in the world. I think by far the most secretive trading organizations in the world. And for those so inclined, I'll give you, if you want to read more about their strategies, etc. And of course, SEBI has shown us some of what Jane Street has done. But I think you can, there is an excellent biography of Sam Bankman-Fried, SBF, right? I mean, he was, of course, himself indicted by US prosecutors, etc. The book was written by Michael Lewis of Liar's Poker fame. And there is about a chapter in that book. And by the way, Sam Bankman-Fried worked at Jane Street for a while. And there is a chapter in there, in which, what Jane Street really did. And this came from Sam Bankman-Fried in terms of what Jane Street did really came out. And I think that's one of the few publicly available strategies which were available before the SEBI order now, in which SEBI, I think, has clearly shown us at least two ways in which Jane profited, according to SEBI, unfairly, illegally, and of course, on the other side of the trade, the counterparty to the profits that they were making was Indian retail investor who were unwittingly taken to the cleaners. There's no other way to put it. Just look at the numbers which we're talking about here. Tens of thousands of crores in profits by one trading shop. So I think we can go on and on, but this is a landmark order in that sense. It may be an interim order, but it's a landmark order against a global trading giant. Not the end of it. Interim investigations will continue, but I think this is pretty massive.
Yeah. Oh, indeed. And, SEBI has acted, in the past, say, against NSE, against, algo trading, etc. But the fact that this time you've passed an interim order against, a global giant, it's unprecedented so far. Thank you very much, Prashant, for joining in, and hope you enjoy the rest of your holiday.
Yes.
Let's invite Gurmeet Chadha, Managing Partner and CIO at Complete Circle. He's joining us on the show. We also have Prakash Diwan weighing in with his thoughts. Gurmeet, let me start with you. What would your initial takeaways be from this entire episode?
Yeah, hi, Rima. I think I agree with Prashant. It's quite a landmark order, and I think by the sheer size, I think probably I don't recall anything like this. But I think there is a line we need to draw between the technicality and the part of it being fair practice and impact on market stability and integrity. And SEBI is responsible for market stability and integrity being maintained. And if you see the order, it clearly mentions, obviously it mentions Bank Nifty incident, where on 17th of Jan, the HDFC Bank is a market reacted. Bank Nifty opened down post the update from the bank. And in first 7-8 minutes, you buy huge quantity in cash. And as a result, obviously the put option prices go down, and then you go short on the market, and then you obviously reverse it. And if you're doing that too frequently, and if you see the second page of the detailed order, it talks about how you create large delta positions, through very aggressive buying in a very short period of time, and then doing concurrent trades. So one is the technicality of it, one is the intent behind it, and using sheer power, sheer muscle to manipulate it. And I think the key word here is manipulation and being unfair in terms of prices. And I think to me it's just the right order. I'm sure there will be legal recourse done, and it will be a long drawn battle. But I think it's a good order, and it sends the right message that you hedge yourself, you trade, everything is fine, but there is a line you need to draw in terms of manipulating it and doing it the right way.
All right, but just to speak from the other side on here, Gurmeet, and speaking absolutely objectively, if there is an index which has been created which has two stocks that account for a majority of the weight on the index, I'm sure it was just a matter of time before someone would actually try to benefit from that lopsidedness of the index, right? So in that sense, do you think from here on, now that this has happened, the Index Reconstitution Committee will perhaps look at making it a lot more fair weight?
No, I agree with you, Najidar. And, end of the day, our markets, the way volumes have picked up post-COVID, I mean, we've added, 7-8 crore new investors post-COVID, and any market which adds, such kind of investors on COVID, obviously it will take time for the markets to get, the indices to get efficient. But I agree with you, the index constitution needs to be looked at. The frequent changes which we keep making to the index, which is free float market cap for one index and others, also needs to be looked at, because what we are also doing is, apart from this, is also making optically index look so expensive. if you keep shunning out, stocks and keep getting new entrants basis the sharp price movement, I think some balance also needs to be done, and some thinking has to be done there as well. But I think as a regulator, if my investors are being manipulated into something, I need to act. And I think to me, that's a fair thing to do. Changes in indices, constituents of indices, obviously this is an ongoing process, and even indices need to look. I think they've made this as a gambling casino machine. So many changes in expiry, every day some expiry. I mean, obviously creates so much confusion in the market. And look at yesterday's close, for example. Every day you see index moving 100, 200 points in a matter of 10 minutes for no obvious triggers and reasons. And this is not good for the market, in a market where, we are talking of new retail investors coming in. So I think it's a good order, and I think more needs to be done. This is just probably a starting point.
All right, yeah, we haven't heard the last of this story for sure. Promises to be, perhaps a long, drawn-out legal battle. Prakash, hi, morning. What a busy morning it's become, thanks to this big order. Your thoughts? I mean, in the interim, in the here and now, as Jane winds up its positions like it's been told to do, I don't know. I mean, if it impacts other large algo trading firms, what's your sense? On just the trading side, the volume side of the market, would you expect any impact?
I think definitely. The restraint on the volumes and the methodology of trades done by Jane Street was supposed to be curbed much earlier. And the order actually talks about penalizing them for not having heeded that caution. Which means that there will be a shrinkage in volume, and a lot of the others, names that don't probably feature in the interim order, but will probably be part of the full investigation, whether it's Citadel, Millennium, a lot of, domestic outfits, whatever, have been set up, will participate, will have to kind of, get covered. See, what it does is it draws a very clear distinction between speculative activity, which is to the ill effect of other traders or the overall market sentiment. The restriction is primarily been brought in on, has been crystallized because we have futures on indices, which is not the case in a lot of mature markets, including the US. You will notice that you have single stock futures, probably with a 1 year dated maturity, but not index futures. And that's precisely where, the trading in India has been a bit lopsided. There will be a lot of hue and cry about FI saying it's not a fair, environment, and you can't kind of be doing these things. You have to open up the market instead of restricting it. But the element, the segment of FIs possibly which gets impacted if there is a curb on this kind of activity on options, particularly, is very small. So there will be a lot of noise, much more disproportionately higher than what actually the impact is. So this will cleanse the system. They will cleanse the system, make sure that capital destruction that was happening rampantly for small investors stops, which is good. But it will impact some of the capital market infra plays, right? We've seen how in the last 18 months they've done so well, whether it's exchanges, brokerages, a lot of those elements. So there will be an impact on that. But I don't think the overall market gets bullied by this. It'll probably be much healthier. And the regulators made it very clear that they will not be sitting down just because somebody is kind of out there with much more money to be traded into these options.
Take that point entirely, Prakash. Thank you so much for joining in. The impact of this could be limited as of now, as per Prakash, to just the capital market plays on account of this. Gurmeet says that we haven't heard the last of it yet. It'll be very interesting to see where this goes from here on. Thanks a lot, gentlemen, for joining in. Just a closing word on this, Surabhi. When the futures market was created world over, it was on three basic tenets. The three things that futures market was created on. The first part of that was hedging oneself. The second part was arbitrage. And the third part was speculation. So speculation is part of the futures design by itself. So let's see where this goes from here on. So we'll most definitely keep an eye out on how this story develops. But for now, what we'll do is take a short break, come back on the other side. All fundamental stock talk with Siddharth Khemka of Motilal Oswal Financial Services. We'll also get to some stocks that are in the news. Welcome back. You're watching us here on CNBC-TV18 Bazar Morning Call. Two stocks that I'll be watching out for, both from the consumer space. Marico, good first quarter update. They've said that improving rural sentiment and urban trend steady has actually taken their underlying volume growth in India to a multi-quarter high. For me, the biggest positive this time around was value-added hair oils grew in double digits. This has been an underperforming segment for the company for the last many quarters. International business has been continuously doing well. So all of this means that the consolidated revenue growth for Marico has been low 20s. In a sector partial for growth, low 20s for staples is fairly good. Remember, gross margins are under incremental pressure, but operating margins have seen a mild improvement over the last year. There has been overall margin compression, but 20% plus growth, the street will take that with both hands. On the other hand, for one company, 20% growth is great. For the other, not so much. The company that I'm talking about is Trent. The company held its annual general meeting yesterday, and they said that the first quarter growth is seen around 20%, which is much lower than their own 5-year CAGR of 35%. I remember a couple of weeks ago when they met analysts, they said sustainable growth for the company is around 25%. So to that extent, 20% at a time the stock has seen a sharp recovery from the lows would be a negative, and it has prompted brokerages to cut their revenue and EBITDA estimates for this year, and they've downgraded Trent to hold, revised the target price lower as well. That's Nuvama. Let's get in Siddharth Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services, on his views for the same. Good update coming in from Marico, not so much for Trent. Siddharth.
Good morning, Mangalam. Yeah, glad to be on the show Friday morning. So yes, I definitely see that the update from Marico is quite heartening, especially in an environment where the staples businesses are struggling for growth. And in that environment, Marico reporting a low 20%, but still a strong number for the from the industry perspective. So good quarter. We are seeing gradual improvement in overall consumer sentiments on back of easing inflation, favorable monsoon, as well as some of the policy stimulus. So overall, we remain positive on Marico. We believe that the companies aim to achieve the double-digit growth in this year. That is playing out well. And again, as you rightly said, there are some short-term pressures on margins, but that is also easing out. And hence, what we are expecting is about 11% and a 13% EBITDA CAGR over the next 2 years. But among these staples, I think Marico stands pretty strong with that update. So we continue to like it, and we like the stock from a long-term perspective.
Okay, all right, got that. Siddharth, stay on. We'll have more questions for you in just a bit, but we do have to take a very, very quick break. Come back on the other side. We'll, of course, start getting our pre-open rates. We'll get to our technical experts as well on today's trading setup. Welcome back. Just a quick check across Asian markets and what we're getting in terms of the implied open. Asia is very mixed. Some of the markets are doing okay. For instance, Japan is a little flat. Mainland China seeing a minor gain. But the Hong Kong market and the Taiwan market, they are slightly lower today. So the enthusiasm of Wall Street, that's not quite rubbed off on all the Asian markets. That's the implied open, fairly modest, fairly muted, just 11 points higher. We'll do one thing, take that quick break and come back with today's trading cues in just a moment.
Watching us here on Bazar Morning Call, 16 minutes before we open, 1 minute before the pre-open, and good time to get in all the technical experts. 10 points higher on the GIFT Nifty. We have Shrikant Chavan joining in along with Mitesh. Mitesh, good morning. After a big decline in the last 30 minutes yesterday, what do you think the market setup is like? Are we still in that range?
Good morning, Manu. I think, what has happened in that last 1 hour, which the market turned negative, was that the Bank Nifty structures turned weak. And Bank Nifty does enjoy a significant weightage in the Nifty, and therefore I think, we could see some pressure in the coming days as well. I also mentioned that in case we start getting below 25,400 and just below that is where we crossed, good chance that we might actually drop down to about levels of 25 to 200 zones, which is where the next medium-term supports kind of get in. So maybe I think we'll go down to that level. The range will be 25,200 to about 25,650, 700 on the upside. And looks like we are poised to head towards the lower end of the range.
All right.
Got that. Shrikant, what would your index call be?
Good morning, Rima. Good morning, everyone. See, for Nifty, the overall trend for the market is still bullish. We saw a spectacular rally from the lows of 24,500 to almost 25,500, 600. And now it is resting. So we are witnessing some correction, and in that correction, there can be the possibility that the market may again retest the levels of 25,200 or 25,100, where the market has spent a lot of time in the past when it was rallying from the lower levels. So close to those levels, the market is having support. But at these levels, we are witnessing good amount of selling pressure in banks, NBFCs, real estate. Actually, all these particular sectors did really well in the past. I mean to say in the previous month. But in this month, we are witnessing selling pressure. And also, if we consider FI's activity, then they are also selling on a day-to-day basis. So broadly, I am of the view that in the near term, we may see some correction close to 25,200 to 100. Traders or investors having opportunity to create some long position, contra position of going long. But at these levels, we should be careful and we should look for creating short positions with a final stop loss at 25,600.
Shrikant, hi, morning. We want to know about your individual stock calls as well. But just before that, in 30 seconds, we spent a lot of time discussing the legality around this whole Jane Street order. But purely from a trader perspective, do you see it having any near-term impact next 1-2 weeks on volumes, on trading? If at all you have a view. Quick 30 seconds and then your stocks.
No, I think we need to go through with what position or maybe stocks he's holding in. I'm going to say the fund is holding in his portfolio. That is very important. But I don't think that that is going to impact because market is so big that all these things matters only on specific days like weekly expiry or monthly expiry. Otherwise, I am of the view that the overall the impact of the same is going to be very, very negligible. But yes, definitely it will help to curb this volatility.
Okay. All right. Good to know that. Stocks now for today?
So based on the weakness of the market, I am of the view that we should look for creating some short position on ICICI Bank with a target of 1375. It's a very short-term sale with a stop loss at 1450. And the other stock which we like is Amber Enterprises, which is around 7300, 7350. The overall space is doing well, consumer durables. And in that specifically, we like Amber with a target of 7800. And we can keep a stop loss around 7,100 for buying Amber.
All right. And Mitesh, your stock picks?
Well, I have a mix of buy and sell calls. On the buying side is BSE with a stop at 2790 for targets of 2885. And Oil India is a buy with a stop below 444 for targets of 470. While on the selling side is Rhoda Builders, keep a stop at 1390 or above 1390 and for a target of 1315, and Cholamandalam Finance, that's a short-term sell with a stop at 1550 for targets of 1475.
Got that. By the way, pre-opening rates are in. Marico's on the way up. Along with that, you've got Bajaj Finance in the green, and on the way down, Trent. The pre-open rate suggests a big fall, 6.5% down, while HDFC Bank too could see a little bit of red. In fact, a whole host of banking and NBFCs reported their Q1 updates, lots of them. But Gaurav is here just to tell us the key ones we should watch as we begin trade today.
Well, yes, first let's talk about Bajaj Finance. A very big positive surprise is what we have seen from the quarterly updates. 26% AUM growth, let me correct, 25% AUM growth on a year-on-year basis, which results into 6% sequential growth. On the other hand, customer base also increased almost by 21%. In fact, now brokerages also believe that this is going to be positive and the next checkpoint is going to be credit cost. Bajaj Housing Finance also followed the same trend where 24% growth is what we saw in AUM. And at the same time, disbursements also grew almost by 3% on a sequential basis. On the other hand, let's also focus on some banks. Bank of Baroda actually came up with a little bit of weak set of numbers if we compare it with the expectations, because the loan book growth was at around 12.5%, while deposit growth was at around just 8% on a YOY basis. AU Small Finance Bank actually came up with good set of numbers. We saw advances growing at a rate of around 23% on a year-on-year basis, whereas deposits also grew strongly at around 31%. But let's not forget that this bank has also seen a rally in the recent days, so definitely watching out on this counter. And lastly, let's also focus on L&T Finance. Good set of number. Here also we have seen retail loan book actually increased almost by 18%, whereas when we talk about disbursements, there we saw 18% growth on a year-on-year basis, which also translates into around healthy growth on a sequential basis as well. So definitely a positive set of numbers from L&T Finance, and on back of this, we are watching on this stock as well.
All right, take that point. Gaurav, thank you so much for joining in and giving us your views on all the updates that came in post 3:30 in the financial space. Nitin Agarwal, who's the Senior Group VP Head BFSI Institutional Equities at Motilal Oswal Financial Services, joins in as well. Of all the updates that have come lately, what has been, according to you, some of the standout numbers, both positively and negative surprise, Nitin?
Yeah, hi, sure. Thanks for having me. So far, the business updates reflects a modest growth in the overall banking business. Some banks have reported a decline in their advances portfolio. AU Bank has relatively reported better numbers on both loans and deposit side, while RBL numbers also seemed in line. HDFC Bank numbers have come in today, and while the deposit traction remains in line, they have reported a 1.5 to 2%, slightly close to 2% kind of deposit growth Q on Q, but advances growth is almost flattish to less than 1%. So, which is something that is expected also, given how the RBI, we know that data is going on advances front, and expectations are of a lagged recovery in advances growth over the year. So I will say, barring the decline that has been reported by some banks, which is a little bit of a negative surprise, I think the rest of the numbers are broadly in line to our estimates.
Nitin, hi, morning. I guess PNB is the one, right, where the growth is lower. I'm just going back and checking the numbers. Yeah, their advances, domestic advances have grown 9.7%, which is lower than their overall guidance for the year. I mean, just looking at the starting Q1 trends purely in terms of growth, I'm not talking about margin right now, purely in terms of growth, which would be the banks that you'll really watch out for?
So I think, see, AU Bank is one wherein certainly we are looking growth to sustain in early 20s because it could have been mid 20s also had it not been for MFI, which is, again, we are expecting a decline Q on Q. And so that's certainly going to be on the higher end of the range within our coverage universe. Rest of the banks, I think growth rates over the year will be low to mid double digits is something that we are looking at for most banks. And that's essentially because the system growth also we are looking somewhere close to 11 for the year. And our hopes are pinned around a recovery in the second half because first half growth may remain a little weaker and may run around 9-10% range is what we think.
So, you know, the question, Nitin, really that a lot of investors are wondering is whether they're better off looking at tier 2 lenders. You're only looking at banks, or I'll restrict this to banks, rather than stay put with the comfort of, say, an HDFC or an ICICI, which I guess market wisdom is maybe they'll give you 10-11%. Tell us, in fact, you know, what your estimates are. So the question is between large banks and mid-sized banks like an AU you've singled out, but are there others which perhaps could be just a better investment this year?
I think you will still have to look at on a case-to-case basis because while mid-sized banking space has done well, and there are certain names like even we upgraded RBL Bank last quarter, and that has done fantastically in the current quarter. And the expectation is that with MFI stress receding and margins after having seen an initial decline in the 1Q and possibly some bit in 2Q, these banks will do much better on the margin line, and alongside the credit cost benefits will also start to come through. So that will drive a healthy recovery in ROAs for these banks, and therefore the growth also can recover from where the trajectory is right now. So over the year, yes, if you take a next 12 to 18 month view, these banks can do well from where they are right now.
So RBL and AU small, right? I'm just confirming the names, the mid-sized banks that you like.
Yeah, so we like AU Bank, we like Federal, we like RBL, though Federal is still relatively larger, but we like Federal and we like RBL Bank.
Any trend that you can spot from the PSU banking updates? Because PNB yesterday was weak. Today we've got Bank of Baroda. And again, here the deposit growth has been muted. It's declined on a quarter-on-quarter basis. Is there any trend in the PSU banks that you can spot so far from the provisional updates?
I think, yes, BOB has reported a decline while we were expecting a flattish kind of positive growth at least. But Q4 was very heavy in terms of business accretion that the bank reported. So it seems like some unwinding has happened on both the fronts, both loans and deposits, and that has resulted in a decline. And we have to watch out the trajectory here on, but I don't think that there is a reason to change the growth estimates for the year because 1Q is known to be a little seasonally weaker. And some banks which have reported a marginal growth, other PSU banks like PNB. But I think over the year, we are still expecting growth rate to sustain around 10 to 12% range for these banks.
All right. Where do you stand when it comes to IndusInd Bank? Because earlier we had Nomura, turn positive on the stock. Very recently, we had Goldman Sachs turn negative on the stock. The stock is down about 40-45%. Everyone's awaiting the leadership change out there. How much of that is realistically in the price?
Yeah, so I guess we are somewhere in the middle. We have still maintained a neutral call. We released a note today only on IndusInd Bank. And so what we have done in this is we have taken off the bear case multiples. Earlier, we put out a target of 650 on the stock, which we have revised to up to 800 now. And the rationale is that with the impending appointment of the CEO, I think one will look forward to how strategically the bank moves forward and decides on the growth and the earning outlook shapes up. So the negativity that was there since last few months, more than a quarter, I think more importantly, what we are watching out is that there shouldn't be any more one-offs or regularities related hits that the bank will take, which I think is the view that we are taking right now. And while operationally things will take to recover, you will still see a muted business growth this quarter. Margins will likely take a further dip from the normalized number of 4Q. And gradually, we are expecting ROAs to recover towards 1% over the next few years. So which is where we still maintain a neutral call on the stock. But we are keenly awaiting this clarity on the management and the strategic direction and the new management.
Absolutely. It's not for the faint-hearted because you have to, go through this transition period and then see how the bank emerges. Very quickly, last question, Nitin. You gave us a couple of your top picks on the mid-cap banking side. Let's come to the big boys as well, the large banks between ICICI, Kotak, Axis, SBI and the others. What would your top picks be and why?
Yeah, sure. So we have been positive on ICICI Bank and HDFC Bank, and we have maintained this while within PSUs. SBI remains a preferred pick, and I think post this capital raise, SBI, I think the overhang will go away, and you have already seen a catch up with many of the other PSU banks. If you look at, say, Union, Canara, Indian Bank, these banks have done fairly well in the recent months. The return can be between 15 to 25, 30%, and I think as you move forward, the valuation gap now between SBI and the other PSU banks has narrowed significantly. So post this capital raise, I think that overhang will go away, and alongside a recovery in the overall earnings line as the margins start to recover over the second half for most PSU banks, I believe, will drive a re-rating in the stock. We still maintain of course a buy on SBI with a 925 target.
925 on SBI. Nitin, thank you very much for joining in. Let's talk about Reliance. Because there is some internal restructuring plan for the retail business. Ashmit joins in with the details. Ashmit.
Well, Reliance Retail now looking to hive off the part of the business that dealt primarily with FMCG and looking to house that under one arm, under one company, which will then be a direct subsidiary of Reliance Industries. That's the long and short of the filing, the application that Reliance Retail has made before the Mumbai bench of the NCLT. Now, what we understand is that currently the FMCG business is housed between Reliance Retail in part and partly under Reliance Consumer Products. What this application suggests is that there should be a new company by the name of New Reliance Consumer Products, which will now be a subsidiary of Reliance Industries. That's, of course, the proposal that has been made. Now, the rationale that has been put forth before the NCLT is that FMCG business by itself is a large business. It requires specialized, focused attention. It requires a different kind of expertise. It requires a different kind of skill sets as compared to the retail business. So essentially distinguishing the FMCG business from the retail business. Then subsequently, the application then also goes on to say that this business will require large, focused amounts of capital going forward, and that this hiving off, this demerger of sorts, will allow for attracting of these different set of focused investors, which will be primarily directed towards the FMCG business. That is also something that's on the cards. And finally, the application also goes on to say that that the consumer brands business, the FMCG business, is not a part of the retail business, strictly speaking, and therefore there is a requirement for housing this, for placing the FMCG vertical under a different company altogether, and that this is a part of an internal restructuring exercise. Now, what we understand is that this application is currently pending before the NCLT. The NCLT, on its part, has directed for Reliance Retail to get approval from its shareholders, to get approval from its creditors, both secured as well as unsecured. Subsequently, there is also a direction from the NCLT to give a clear list of any pending dues in terms of IBC.
Okay, Ashmit, sorry, cutting you off there. Apologies, but we're running into market opening. Got the gist of it. Thank you for that update. That's an important one. As the restructuring gets underway with respect to Reliance Retail and the consumer businesses. There's the bell, and the stock you need to look out for is Trent. It's down 8% straight away. The market's up. Market's actually opened higher. It's opened better than what the implied open was indicating. Nifty is about 10-11 points up, but the mid-cap index is already flashing red, so it is slightly volatile. Like I said, let's straight away flash Trent, and Mangalam highlighted this earlier as well. What the issues here are. The company has spoken about 20% growth in Q1. Their own, steady state guidance is 25% on an ongoing basis, but they've grown 20%, and that disappointment is written all over the stock. We'll go back to this in just a second, but that's your big headline. But otherwise, the market's managing about a 25-point gain. So let's see what's pulling it up. Bajaj Finance, like Gaurav told us, numbers are looking good, about 25% growth. Market likes that. Stocks about 2.5% on the higher side. We're seeing some move on a BEL. Need to watch out for some of these defense stocks as well. Like I said, over 1 lakh crores of proposals approved by the Defense Acquisition Council. BEL is already up and about. Wipro, Bharti Airtel, Bajaj Finserv, these are some of the other early winners. HDFC Bank is managing a 0.5% gain. but then it's getting really quiet. Reliance, for what it's worth, is adding 3 rupees, sum total of 3 rupees, so it's not too much of a contributor. Markets holding on to the green just by the, hanging by a thread, so to speak. On the flip side, you've got a M&M, Tata Steel, Tech Mahindra. These are some of the names on the downside, only 7 points higher. It is volatile. It's not a clean sweep. So the optimism on Wall Street hasn't quite translated to the Lal Street just yet.
Well, on the way down, by the way, it's the capital marketplace. So clearly this Jane Street's, the interim order on Jane Street impounding gains to the tune of 5,000 crore is hitting some of the capital marketplace. So pull up an Angel One, straight away 5.5% lower on that. BSE is open with a cut of about 4.5%. A Motilal Oswal, CDSL. So the entire capital market complex today is under pressure. The street fears that liquidity will get impacted, market making will get impacted, and that is hurting sentiment there. Trend, of course, is the big loser. Outside of that, on the way down, you also have cuts coming through on Bank of Baroda, where the street is a bit disappointed with the provisional updates. That stock is open with a cut of about 0.5%. On the way up, as a sector, it's the defense names. So Paras Defense, Bharat Dynamics, BEL, that's the complex which is higher today on the back of the Defense Acquisition Council clearing orders to the tune of 1 lakh crore rupees. Marico has started with strength after the volumes hit a multi-quarter high, 3.5% up on that. IEX has a bit of a gain going for itself, and some of the other big movers include a Sapphire that's up nearly 4.5%. A few other NBFCs, Suryodaya Small Finance Bank, Credit Access Grameen, also up and about. But on the whole, very, very flat on the benchmark indices. Nifty Sensex holding up with a mild positive bias. Mid-caps unchanged.
Flat on the benchmark indices. We do have, the advanced decline pretty much at an even keel early in the day so far. Metal stocks have taken a knockdown as well at the open. So we have Tata Steel, which is about 1% lower. And at the same time, a large part of the weakness in the capital marketplace could also be on account of the update that has come in for the month of June from Angel One, where the gross client acquisition is actually down 41%. The number of orders themselves have declined by about 32%. So yes, there is that cloud of the Jane Street thing, but at the same time, fundamentally as well, their update for the month of June hasn't been very good. Speaking about weak updates, definitely has to be Trent. The stock had seen a rally all the way up from 4,500 to close to 6,000 on hopes that, growth will return at some point and valuations are getting comfortable, but growth hasn't returned. And in light of that, valuations also seemed a lot higher. I'd like to see what Avenue Supermarts does, because if the company or the quality of Trent is growing just at 20%, yesterday Avenue Supermarts was down 4% on account of a 16% growth. So will Street give a longer rope to Avenue Supermarts right now or not? Is something that I'll be watching out for through the course of the day. Marico, 4% higher on the back of 20% growth. That definitely is your stock of the day on the way up. We're also seeing some traction on, a couple of these jewelry companies. So they are doing well. We are awaiting, updates coming in from both Kalyan as well as Titan. And I also watch out for Dabur as well. If Marico is growing well, will Dabur continue to underperform the industry as it has? Or will that also get its act together? The street is betting on perhaps it may see some improvement from
Marico has finally put it out there. They're saying that, yes, we're on track to perhaps finally getting back to double-digit growth for the year as a whole.
Fair for Marico, they've been saying that all of last year as well and this year. And Marico has gone ahead and, delivered that too. Yeah. So from a stock standpoint, Marico's seen a lot more in terms of re-rating. And it's done well because their volumes have outpaced the industry for the last 3 or 4 quarters. The only problem was the margins, largely because of higher input prices. But here as well, the commentary is positive. They're saying that things will improve in the second half of this year.
Well, it's really interesting. You put 2 stocks today, Marico on one side and Trent on the other side, both from the consumer space, but very different dynamics, different market positioning, leading to the...
Both from the consumer space and both growing at 20%, mind you. So it's just a valuation. Marico's 20%, Street likes 4% higher. Trend's 20%, Street does not like the stock down 8%.
It's positioning, it's expectations, it's valuations, all of that.
But as someone was pointing out, it's also Trend's growth rates have been decelerating, right? I'm just going back over the last 4 quarters, 29% in the prior quarter, 37% before that, 40% before that, and 57%.
Yeah, so which is why we saw the derating as well.
You've seen that derating.
Mark, the stock went down to 4,500. From there, it saw an improvement because the street believed that there could be some improvement, and the company themselves said that it can grow at 25%.
Yeah.
So the street was adjusting itself to the new normal of 25%.
25%, now it's 20%.
20%, but it's one quarter, you don't know. And they say one swallow doesn't make a summer. So let's see. Actually, let's take this debate forward with Manish Gunwani, head of equity at Bandhan AMC. Manish, good morning. Thank you for joining in. It's a very spirited Friday morning here in our studios because we have the big Jane Street news and all these earnings updates coming through. So fair bit of excitement. But actually, let's start with the consumer debate. And what we are seeing play out. A lot of participants in the market want to pivot back towards consumer stocks because they've not done too well. But you need hard evidence that growth is coming back. What's your sense? Are you liking the space? What's the positioning here? And what kind of consumer companies would you prefer, if at all?
So I think the macro is positive. If you take a medium-term perspective, I think multiple things are happening. One is the tax cuts. Two is, I think, interest rates coming down. So EMIs coming down will help consumption. If you see the pay commission, which may come anywhere between 18 to 24 months from here, that has also been typically a good trigger for consumption. And I think overall, if the economy does well, given that monetary easing is happening, that should also help. But yeah, the challenge is more bottom up there because consumer stocks in India tend to be super expensive, actually. So a lot of the staple companies, the discretionary companies are not cheap. So I think sometimes going down the market cap curve helps. There are some consumer companies which are at 1 to 2 times sales, obviously because they've not done well. I think it's good to probably have some exposure to them because if the cycle comes, typically in India, any consumer brand goes back to 3 to 6 times sales. So I think in the large cap names, it is a bit difficult to be very excited, even if you're positive from a top-down perspective, because you get about 1 to 2% free cash flow yield for 60 times. So yeah, I mean, top-down is good, but other way to play it is through auto. But there are some technological challenges, obviously, in four-wheelers, etc. So I think you'll have to mix and match a bit here.
Manish, I think, your preference for small caps is not restricted only to the consumer stocks because I am reading your note and you believe that there are many industries in the 250th to 500th name in terms of market cap which are offering massive opportunities for investment. Can you throw some light on, what prompted you to look so down the curve and what are the opportunities in what sectors?
So in general, I think there's obviously a lot of choice beyond large and mid cap. Obviously not very liquid, so finite amount of money can be deployed. But I think it's just that the large caps, given that penetration-driven growth, I think in India is structurally peaking out, to be honest, because our demographics, our penetration of a lot of these products is very high. Like if you see two-wheelers or a lot of other basic stuff, we are probably by volume today among top 1 or 2 markets. And therefore, you can't really bank on, opening new markets and getting growth. In that case, you have to play something which is getting premiumized, where it's becoming a bigger part of customers' wallet. And as I said, then you also need valuation on your side, right? I mean, so for example, I think one of the distressed media companies is a good option value for us. One of the not so well-performing branded apparel players is an option for us because all these are available at fairly cheap valuations versus a lot of the very large companies.
Okay, So you're betting on some of the non-performing stocks. So one which catches your attention is in media and the other one is in the branded apparel space. So not going with the winners right now. Manish, since you've been in the markets now for so many decades now, you want to share your thoughts on SEBI barring Jane Street from the market? I mean, how should one go about thinking about this? Are there any implications for capital market plays in India?
Honestly, don't have any strong view on this because being a fundamental investor, it's very difficult to figure out what exactly is happening in the derivative space. So yeah, I'll kind of pass this because I really don't understand how this issue actually is being handled.
Okay. The last time we spoke, you were bullish on financials. I think you were overweight on financial. Does that view still hold? Are you incrementally more positive now, or have you been adding to your stocks? And tell us in your portfolio, which would be the top bets now in the financial space?
So I think financials, I'm quite bullish. I think that's the one of the few spaces where valuations are interesting. Having said that, again, I don't expect very high growth in banks, which are a big part of the financial space. But I think general insurance, life insurance, AMCs, these are interesting spaces. They may also not look cheap now versus 2-3 years back, but at least when you see the market caps, you can say that these market caps are still very low versus what is going to happen in the next 5-10 years. So I do think that financials are one of the most interesting space in the market right now from a risk-reward perspective. So we are, in general, overweight a lot of segments, including banks, but more structurally, I would think AMCs and general insurance and life insurance.
Okay. Got that point. Manish, overall for the market, what's the sense? Would you be expecting a bigger move in the second half of the year, or do you think this is pretty much it and now it just boils down to individual stocks and earnings? But are you optimistic on a big earnings recovery and a major push through in terms of flows, etc.?
Not clear on very high GDP growth coming through, but I think the macro is too good, the micro is too challenging. So I think what I mean by micro being too challenging is there is obviously not very broad-based earning acceleration, and a lot of stocks are expensive. There's a lot of supply. So in spite of macro being super attractive to my mind, I mean, the currency looks solid. Inflation, current account deficit looks solid. The top two economies in the world are very difficult to invest in. I think the US government debt is going to become a big issue. So there'll be money flowing out of the dollar, I would think, on a medium-term basis. So the macro looks super positive, but the challenge is just the micro in terms of getting stocks at reasonable valuation where there's not too much of competition coming, where there's not too much of supply coming. So I do think that between this tug of war of macro and micro, you probably get a flattish market, and hopefully if you are able to choose the stocks right, so it's a very peaceful environment for stock picking because nothing is moving up too fast. So you don't want markets to be very volatile. So it's a good market, I think. It may not be very exciting, but it's going to be interesting market, I think.
Where do you stand on the global-facing names? Because domestic macros, you said, are great, but domestic micros from a stock standpoint, not particularly good. On the other hand, global macros, very uncertain. But from a stock-specific standpoint, IT stocks or stocks which are, having some sort of global exposure have been suppressed because of this uncertainty in global markets. Do you think they'll come back at some point?
Very difficult to be excited about global sectors. I guess the biggest issue today is, as I said, the US government debt. Whatever way you cut the numbers, it's it's a very difficult issue to resolve. And I think what probably global markets are building in, because when you see most of the markets are at all-time high, that the end game is quite likely going to be that US will run negative real rates and Fed will print money, because otherwise the demand supply of US bond doesn't resolve very easily. I think that is, to my mind, driving gold, Bitcoin, equities, everything. And from that perspective, maybe metals is a okay contra trade, not a very high conviction thing, but if eventually QE has to start, or whatever form Fed takes to support the US bond market, a lot of the metal names, the commodity prices are not very high. The stocks are cheap on a free cash flow yield basis. But overall, it's going to be very difficult to figure out how this thing resolves. But yes, the more benign interpretation is it will force not only US, I'm talking of most of the developed worlds, that, and Japan's been doing this for years now. And so if you see, Japan incidentally has same inflation as India, but the 10-year yield is 1%. So the point is, eventually, if this leads to globally negative real rates coming, I think that prospect, I think, is keeping most asset prices high.
Okay, lots to think about as we look at some of these global macros and how they play out. And of course, lots to track here in India in terms of earnings and what really is hitting the mark. Manish, great conversation this morning. Thank you very much for joining in. We look forward to connecting again soon. Well, by the way, before we move to our next corporate conversation, the market for a bit dipped into red. Now it's flattened out, but it's absolutely quiet. So none of the Wall Street enthusiasm has rubbed off. And we've been, in this zone, in this block of around 25,400 now for the better part of the last at least two sessions, including this morning. So let's look at that. As flat can be, 0.00% on the Nifty. Well, so let's move our focus then to corporate conversations. The next company on our radar is JSW Infra. News reports are suggesting that the company is all set to win a big order, almost 832 crores. This is for mechanizing 2 berths at the Netaji Subhash dock at the Kolkata port. Let's talk about this and the overall roadmap and growth plans for the company. Lalit Singhvi, whole-time director and chief financial officer at JSW Infra, is with us. Mr. Singhvi, thank you for joining in. Can you confirm, whether indeed you have got this particular contract? And if so, how does it make business sense for you? What will it add in terms of revenue visibility over how much time? I think you're on mute, sir. If you can unmute yourself.
Thank you, Surbhi, and for having me on your show. So regarding this Kolkata thing, we have yet to hear from the Port Trust, officially. So once we come to know, then we can talk more in detail. Bids were invited, and so final decision, official communication or LOI is yet to receive.
Understand, sir, that's exactly. I understand. So you can't exactly confirm till you hear it from the port authority.
Yes.
But you were going to, I think, construct and mechanize. It was 2 separate berths at this particular facility.
Absolutely.
And from what we know from reports is that yours was the highest bid price of 4,678 per TEU. So tell us, why were you interested? Why are you interested in being a part of this project? Why are you interested in this asset? And again, my same question. How does it help you in terms of revenue visibility? How long is the gestation period for a project like this? When does the money flow in?
So generally, if you see that we have been very active on acquiring the terminals at the major ports. We are the largest concession holder in India, having 9 concessions already with us. And we keep participating to acquire these terminals, and this makes a very good business sense for us. So if you see our cargo profile, we are 50% revenue comes from the private ports and 50% almost comes from the terminal side, which we acquired from the government. So in line with that, we keep bidding the good assets, and to have a presence in the container segment. That we are largely, we are bulk and a liquid company. On the container side, we have presence on the Mangalore container terminal. So we are looking for the good assets. So we found these assets to be quite good and strategic fit into our scheme of things. So
what are the volume projections, sir? You would have done obviously your back of the envelope calculations. Yeah. What would be the volume projections with this project?
This has a capacity of say 450,000 TEUs, and they are already running at 90% capacity utilization. So there is a there is no dearth of cargo. So they cater to the east side, and Kolkata is the main market for this. So we don't foresee, and we will run it more efficiently. There are no night operations like type of things, and we will try to do and optimize after putting up a good cranes and whatever the mechanization we need to do. So after this will further, their operational efficiency will increase and give them more cargo.
Okay. So if you do win this, how will you fund it? And, it's a good asset, as you said. What would be the peak revenue that you would expect from this? And what would it do to your overall volumes? You would have done the math.
No, that is, this particular thing, as we said, that 90% utilization is already there. So we don't foresee, and the funding of this, for 800 crore project is not an issue. We are having a very strong balance sheet sitting on the cash. So that is not a problem at all for us. So point is to diversify our cargo profile, and revenue, and this thing will not be an issue. As per the market prices, we will be able to charge this, and if we run it more efficiently, we are able to increase our revenues from what the current at prices it is being run. And secondly, one more berth will in future will come from the Kolkata dock, which is likely to come very near. So we will be looking at those opportunities also, so that we have a good presence over there in the Kolkata port.
Can you explain to us this rationale of nearly 4,700 rupees per TEU as a royalty? How does that compare with all the other ports out there? What is the freight rate per TEU for you to be able to give that sort of royalty?
See, this all, in the beginning when we acquire anything, whether we acquired in JNPT and all that, everything in the beginning looks, that it is, royalties on the higher side. But if we run it efficiently and ramp up the capacities, so then, the numbers and efficiency and returns profile comes. On the face of it, if it comes, then everybody will bid for that. So that
what I'm trying to understand is how does this compare with royalty which is paid to other parts of the country?
No. So if you look at whether Tina Tukra or whatever has happened in Kandla or Mumbai, all were on much higher than this also. So that's not an issue. So issue is you must have a cargo visibility. So that we have a good sense of the cargo visibility in that region.
What is the visibility that you have? I mean, how many TEUs do you think you can move here?
No, we can move. We can do much better than the capacity also. That is, capacity is 450 by doing various optimization, by starting night operations, putting up a better cranes. So the cargo is no doubt there.
Okay. So can you help us understand what we're trying to ask is that, say today if JSW Infra is doing X amount of volume, if you get this facility and by the time these two berths come up, it could be how much? X plus 20%, X plus. We're just trying to understand over what time frame.
They grow. If you look at JSW Infra, we have 9 terminals and we got 3 private ports. From 177 million tons, we are taking it to 400,000 tons.
Correct.
So in that scheme of things, as a percentage increase is not a very large percentage increase. But likewise, every year, some capacity will keep coming in and we plan to add it. So if you look at, say, 500,000 TEUs would be what, 7 million tons of, say, in terms of tonnage of the cargo, if you take, around 14 ton a TEU as a thumb rule. So, if I am already doing 117 million tons, so it is a 7 million ton. So,
got it.
The point is not that. Point is that every year such assets we keep acquiring and we make a full chain of these terminals, which gives us more, efficiency and EBITDAs and the revenues.
Can you give us
Which
a
one?
sense of what sort of revenue you are looking at on account of this for FY26? Because you had earlier given a guidance of 720 crores in your logistics business with 15% margins.
See, these exact details we can talk during the Q1. By the time, hopefully, this will, whatever till official announcement comes, it will be too early to talk all these numbers and detailings. So we must get it first, which we have not yet got it. So this is, we can talk at the appropriate time.
Sure. Thank you, sir, for joining in. That's the word from JSW Infrastructure. Markets are flat. The Nifty is below 25,400, a minor cut of 23 points. HDFC Bank is in focus. That's the heavyweight, which reported the Q1 business update. Gaurav is here to revisit the numbers for us. Gaurav?
Well, yes, HDFC Bank came up with their Q1 updates, and it looks like good set of numbers is what the bank has reported. When we look at advances, they have increased almost by 6.7% on a year-on-year basis, while deposit growth has been strong at around 16% on a year-on-year basis, and it also implies a strong growth on a sequential basis as well. Deposit growth, let's not forget, this was driven by the term deposits, and as a result, when we look at the CASA ratio, and implied CASA ratio comes at around 33.9%, which is again in line with what the street is expecting. Now, let's not forget that bank had said that they will be bringing down their CD ratio in the range of 85 to 90% in a gradual way. And if we look at the advances and deposits in this quarter, the CD ratio comes at around 96%. That again shows that the bank is actually moving towards what they had guided earlier. Another key point to highlight is that they also had mentioned that they are going to grow their loan book in line with the system. Now, Q1 loan book growth is usually weak, and it seems that the bank is picking up at the pace of system, given that 6.7% growth on a year-on-year basis for Q1, and at the same time, average loan under management also grew at 8.3%. So definitely, good set of number is what we can see for now. We will be watchful on how the NIMs are going to be, but for now, good set of numbers from HDFC Bank.
Got that. Thank you very much for that. Let's invite the next corporate now on Bazar. We've got BLS International joining in to talk about the quarter gone by. Looking ahead, Shikhar Agarwal, Joint Managing Director at the company, is now with us on the show. Shikhar, thank you for joining in. This is Reema here. Now, the quarter gone by had multiple geopolitical flashpoints, whether it's the India-Pakistan or the tensions in Middle East. Flights were getting rerouted. Then you had that Air India the fateful crash there. Was Q1 softer than expected on the back of these developments? Is it tracking lower than what you were earlier anticipating? And what was the impact on the whole?
See, if you see our last year numbers, we've done a 70% growth compared to last year. We did a 540 crores of PAT compared to around 300 crores last year. If you talk about Q1, these geopolitical risks keep on happening from the inception of the company. There was a war in the Middle East, etc. But we have not seen any impact on our numbers. The demand for tourism continues to be strong globally. There is short-term impact, but on a long-term basis, we have not seen any impact. So our numbers remain strong.
So there was a short-term impact, though, in Q1.
I mean, definitely, at the time of war, the stoppage of flights happen in some certain jurisdictions, but then it is also, compensated by increase in travel in other jurisdictions. So definitely on an overall basis, if you see, we have not seen any big impact.
Right. If you could give us a sense on the applications that you processed this quarter, what's your target for this year? And what proportion of those applications would be in the value-added space, or rather the premium space?
See, if you talk about last year, we processed around 4 million applications. It was a big growth compared to the year before. We also had consolidation of our acquisition opportunities like iData and Citizenship Invest. So 20% of the revenue even flew in from that. The first quarter numbers will be out soon. So definitely we will be sharing the numbers when the results are out.
This year, what are you targeting in terms of applications? 4 million last year. How much do you think can you do this year?
See, next 5 years now, what we have seen is, if you see last 5-year trajectory, we have grown 70% CAGR. As the company, as the base becomes bigger, our objective is to maintain the EBITDA margins and the growth momentum. Our target is, if in the next 5 years, if we can do 25% plus growth year on year, I think we can really increase the size and the base of the company. So definitely that is the target, in terms of volume, in terms of revenue, etc.
You think 25% CAGR revenue growth over the next 5 years is possible without acquisitions on a pure organic basis?
See, definitely, if you see the opportunities that are throwing in the market, there are billions of dollars of contracts that are up for renewal. We as a company now have global market share of 17%. The industry is growing 14% annually. It is poised to become a $4 billion industry in the next 2 years. So definitely, if you see all these factors, new governments are outsourcing, new services, new territory, etc. So our market share increasing, new governments outsourcing, we definitely feel that we can continue the growth trajectory.
Your market share globally is 17%. And what would be VFS's market share? And how has the market share changed in the last 5 years?
See, when we started, 10 years back, starting getting into the foreign government space, we had only the market share of 5 to 7%. Over the years, it has grown to 17%. Definitely, our competitors, which are backed by private equity, will have bigger market share. But what I know is our market share is around 17%, and we feel both the industry is growing. The outsourcing market is growing, and the visa volume is also growing. So our market share is also poised to grow in the next few years.
What we understand is that VFS or some of these operators might be looking at an IPO in the Indian market as well. Currently, the only play in this travel and visa space is BLS International. The scarcity premium goes away. So to that extent, for those who are looking at your numbers and then VFS's numbers, what is the your pitch to investors who would be looking at BLS then, saying because VFS obviously is a lot bigger?
I feel that this is a big advantage for us. More players getting listed in the Indian market is a testament for, we have been listed from 2017. We have been saying that the Indian market is really good. And I feel more industry data coming in, more players coming in, more research on the industry, more awareness about the industry will actually lead to a growth in the industry, growth in the visibility on the industry, growth in the market as a general, more investors coming into the industry. So definitely we feel it is a big benefit for us. Right now, we are the only listed player in this segment globally. So more companies getting listed will definitely add on, I feel, to our valuations, to our numbers, to the insight into the company.
And how many contracts of yours come up for renewal this year, and how many new markets are you looking to bid for this year?
See, most of our contracts in the last 2 years we have renewed. So 90% of our revenue is intact. We have a clear visibility of at least 5 to 7 years. But there are multiple contracts that are coming up for renewal of the competition. If you talk about billions of dollars of tenders are coming up for renewal, there are newer governments that are also considering outsourcing, first-time outsourcing. So definitely there's a big opportunity pie in front of us. Even if you see the acquisitions that we did last year, only some months of the revenue had come in. The full year revenue will start coming in from this year. So definitely there's a big leeway for us going forward. And these new players, the other players getting listed will add more visibility to the industry.
Any new white spaces you're targeting in your business housed under BLS International? One, of course, is to go deeper, wider in the existing visa business. New contracts are coming up. Many first-time governments are outsourcing their visa processing. But any new white spaces in the next 5 years that you're contemplating?
See, if you see the acquisition that we did last year, we wanted to get into, long-term visa space. That is why we acquired this company, Citizenship Invest, which is working globally with multiple nationals, facilitating second passports, residencies, etc. So definitely that was more aligned to our government service business. Going forward, if there are businesses wherein there is government outsourcing globally, user pay model, negative working capital, etc., we will be very inclined to look at those businesses. But as of now, we see a big opportunity in the visa outsourcing space. So that is what we are focused on.
Right. And margins, you said you are looking to maintain. Are you looking at around 30% from here on? 25% revenue CAGR, you've given us the numbers. Margins, what is your aspiration?
See, if you see our margins have grown from 21% to 28% and now 34% in the visa business. So there has been a constant increase in margins. We've been doing efforts for the last 5 years. Now with the, increased base, we are a 540 crore profit company. Our immediate target is to maintain the margins even on the increased base. But overall, we are continuously focusing on technological efficiency, cost efficiency, increased revenue. So definitely our immediate and long-term target is to maintain the margins. And then if there's an increase in margin, it will be more long-term.
All right, we take that point. Thank you so much, Shikhar, for joining in. Always a pleasure speaking with you. In fact, we're done with this conversation, but not done with the travel and tourism space itself. Take a short break. On the other side, Rajiv Kale of Thomas Cook joins in to discuss the summer demand trends and their FY26 outlook as well. Stay with us. Even as the markets have flattened out, the broader markets have picked pace once again. So Bosch, for instance, has moved to the high point of trade. We are seeing some traction in IGL, Mahanagar Gas, or some of these city gas distributors doing well. And Godrej Properties too has moved to the high point of trade. So if you look at the advanced decline from what it was, say, about 20 minutes ago, we have seen an improvement, a marked improvement, with around 1,600 stocks advancing for 800 stocks which are declining right now. That number was a lot lower just as we started trade. But let's talk about the travel and tourism space itself. The management of Thomas Cook India now joins in on what summer has been for them, but more importantly, how FY26 is panning out. Rajiv Kale, who's the president and country head, holidays and MICE visa services, a whole host of travel services that they provide, joins us now. Thanks a lot, Rajiv, for joining in. How has summer been? Let's start with that, because there was unseasonal rains. There were a lot of these, geopolitical issues. In domestic tourism itself, we had the India-Pakistan skirmish that happened. So to sum all of that together, how was summer 2025 so far?
Good morning. Thank you for having me. Summer 2025, I think we saw a little bit of a blip towards the end of the summer. I think what we look at is, our acquisition for Q2, which is April, May, and June, was fairly good from the acquisition point of view. So we didn't see a very big impact as such on this quarter. The acquisition was obviously slow for July, August, and September, which is the next quarter. But we are very confident that we have taken some aggressive steps to kind of restore the confidence of the travelers, the customer, to keep traveling, and we will get the demand back.
So what did Q1 report in terms of revenue growth according to you, and what's your outlook for this entire year?
So we look at the calendar year. So for us, the Q1 is basically the Jan, Feb, March, which was fantastic. We were ahead of the target. Q2 also is, looking good. We still have some, numbers to kind of conclude. So on the whole, this year is looking good, and we will be on our target or ahead of our target.
What is that target be?
So we are looking at growth of between 12 to 15%, and we should be there on that growth trajectory.
Can you give us a breakup of that growth as well between your several segments, travel, and there is corporate services? So this 15% growth that you're speaking about.
I'm talking about the travel business.
Only the travel business. Yeah. Okay, so within travel, can you give us a mix between domestic, outbound, long haul, short haul?
So largely we are, long haul and short haul where the growth comes from. Consolidatedly, I can talk about the number because we actually consolidate those numbers from long haul, short haul, domestic, and then we have corporate travel, and then we have MICE. So these are the three large units that we look at from the overall travel as a whole spectrum is concerned.
So all put together, you're saying everything put together should grow at
the leisure
15.
side, we are looking at the growth of 15%, 12 to 15%.
Okay. And corporate travel?
Corporate travel, very difficult to comment at this point of time from the year number point of view. So as the case with MICE, which is meetings, incentives, and conference, I think we will have to see how the demand comes in for the coming quarter, and but I think the pipeline is looking very good.
Okay, you've got a cash of more than 2,000 crore on your books. What's the plan? At least in the second half of the year, are you planning to deploy?
You talked about the cash.
Yes, cash on your books. What is the number now, and what are the plans with respect to deployment?
See, we have some plans as far as the expansion of business is concerned. We will look at the AI space is something which is very important, and we have already invested in that. And there are other growth plans are there, which we will talk about it to the market as it comes through.
All right, you're looking to invest in AI. Speaking about AI, you have the digital photo vertical, which has actually been an underperformer in the previous quarter. If you look at the numbers, there has been a decline in revenue, there has been a decline in profitability as well. At a time when everyone has a phone
DIE is a completely different division, and I will have their managing director talking about that specifically. That is much better.
Rajiv, just to go back to that point on corporate travel and MICE, your meetings and corporate event segment.
Yeah.
You're saying it's looking good, but you're refraining from putting any sort of numbers to how much that business will grow. Is there a concern? I mean, are corporates cutting back? Didn't quite get a clear picture on the corporate side. So and how much does it contribute? How much are you projecting leisure travel will be, and how much will corporate and MICE be?
So I'll talk about the corporate MICE because that is my area. I'm the head of MICE.
Yeah.
When I'm looking at MICE, if I have to compare it with last year, I'm very confident that we will have a growth of 12%. We are also heavily involved into the government business, which is the Sports Authority of India. We are impaneled on SAI. So we did a large event, in the first quarter, which was the National Games, which was held in Uttarakhand. And government is looking at expanding their portfolio from the Sports Authority of India point of view. There are various Khelo Indias and National Games are coming up. So that is definitely going to help us, because when we are looking at MICE, we just don't look at the corporate. We have exhibitions, we have sports authorities, events.
What proportion of your revenue comes in from the government? What proportion of your revenue comes in from the government?
Approximately 10 to 15%.
All right, we take that point. Thank you so much for joining in and giving us an outlook. 12 to 15% growth in your travel services vertical is what you're guiding for this year, led by at least 12% growth in MICE, and you have the government, which accounts for about 10 to 15% of your sales. You believe that, with Sports Authority of India and some more events taking place, this year looks good. Notwithstanding the weakness that we've seen in the previous quarter, you believe that the forward bookings are strong. The street likes what you've said, and we've seen a bit of an uptick in the stock price from the time that you came. The street is betting on these themes. It's up around 4% for Thomas Cook. Let's welcome Mitesh Thakkar back on the show. Mitesh, your trade at 10, what would you have?
I think markets have reversed to slight negative for opening, and the 25,400 still hasn't been taken out decisively. So on the index, I'm waiting, in case we start going below that, we might get a 200-point kind of a decline. Else it will be a 200-point kind of range on the upside, 25,400 to about 25,650. On the stock side, Lupin is a buy for me. Buy here with a stop at about 1950. Look for targets of around 2025 to begin with, and then maybe even more. And the second stock is on the negative side, Persistent System. I would want to sell if it starts breaking below 59.10, 59.15. So sell below 59.10 with a stop at about 59.60 and look for targets of around 5,800.
Just wanted an update on your 9-10 call on BSE, because the stocks opened sharply lower. Do you think it makes sense to stick on the long side for BSE, or maybe stay away?
In fact, with the gap down Mangalam, there was no long position initiated because it opened below the, so nothing was initiated. Just that maybe a news flow which kind of negated the charts.
All right, take that point. Thank you so much for joining in, Mitesh. With that, we'll take a short break. On the other side.
Before we take a break, we've got some fresh updates from the US president. So just point this out. So the most important point is he's saying that countries will start paying tariffs on the 1st of August. So it's not like 9th of July or 10th of July, suddenly these tariffs come into effect. But he's giving mixed signals. He's saying that the value of tariffs could range from anywhere from 10% going all the way to 70%.
Which is exactly why I did not allude to that even as I was reading this. Because, Donald Trump says countries will start playing it from 1st August. They will start sending tariff letters to countries starting Friday. Which countries? We don't know.
Correct.
How many letters? We don't know. what would be the... Yeah, so, after reading this out as well, we'd be none the wiser until Donald Trump says something again. And even after that, we'll be none the wiser.
Sometimes you have to read between the lines, Mangalam. And if you read between the lines, then the sense is that there is still posturing going on. The sense is that negotiations are still underway. He's saying he'll start sending out letters to some countries over this weekend. But there's no immediate tariff levy from the 9th or the 10th of July. So I think this is still a little bit of, maybe brinksmanship, negotiating tactics, call it what you want. A little bit of that's still going on. That's the latest on tariffs from the US president. We'll come back on the other side and then turn our attention full throttle to the commodities market. Back in a moment.
Okay, then index should come up for you on your screen, absolutely unchanged. We're talking about 0.00%. Individual stocks are flying around, but we'll get to that in a bit. For now, it's over to Manisha for the entire lowdown on the commodity markets. Manisha.
Thank you for that, Reema. I'm looking at iron ore prices. Within the metal sector, we have been seeing all of those metals actually continue to do well, ferrous and non-ferrous. But the iron ore prices clearly have been gaining for a second straight week. In this week, now we are up by 2%. For the year so far, we still are in the negative by 7%. One of the underperformers, really, when you look at metal as a sector. But three of the major top lines really come in from China in sense of support for iron ore. One is the industrial output capacity, where China is looking to reduce that. The other is about China supporting its struggling steel industry that could lead to more demand for iron ore going forward. And then China also is supporting its struggling steel industry, its housing industry as well. And the markets believe that China's stimulus could drive construction recovery to support iron ore prices going forward there. The other thing is about resolution by the way of tariff trade agreements that could also stabilize prices. The markets are looking at US making trade agreements with various countries, and that in turn has been supportive for metal demand, industrial demand, and in turn for metal prices there. The other thing also is about the shipments in sense of supplies. Australia, Brazil, we've seen shipments on a decline. These are the major producers of iron ore, and we've seen decline in the last couple of months on an FY25 basis as well, and that markets see as supportive. And then the major miners like Rio Tinto, BHP, Fortescue, Vale have reported lower exports on a month-on-month basis for the month of June. That's yet another factor which is leading support to the markets there. If you look at the Indian markets, then we're looking at better production. If you look at 2024 for the 2 months here, we're looking at 53 million tons versus 52.7. It's a 0.6% of a gain, but gain nonetheless. And when you look at the year-on-year production when it comes to iron ore, we saw record numbers for the FY 2025 at around 289 million tons, which was at around 277 million tons in the last year. The final plate shows you on what is the outlook for iron ore prices going forward, and most global banks and brokerages believe that you could be looking at a higher number going ahead. BMI and UBS talk about $100 a ton, and then you have ING, AOC talking about 80 to 95. Goldman Sachs also says $95 a ton is a possibility for the iron ore prices going ahead.
Okay, all right. Manisha, got it. Thank you very much for that. That's the latest from the commodity markets. But the latest in the equity market is that the Nifty is still struggling. It's down about 1% or so, absolutely flat. And Trent is still down 7%. Mangalam?
Well, now from what we spoke about earlier to now, the only difference is that the company has officially updated the exchanges on the first quarter numbers. Yesterday, they said that it would be 20-ish% sort of growth in the first quarter in the annual general meeting to analysts, basis which the analysts came out with their notes. But now the number is on the exchanges. 20% is the exact revenue growth that the company has reported on a standalone basis. 5,061 crores. They've added one West Side store. They've added 11 Zudio stores in the first quarter. Remember, a large part of the Zudio store additions happened in the second half of the previous year. So the street believes that maybe, they will start catching up when it comes to same-store sales growth in the last part of this year as well as these stores anniversarize. But 35% is the CAGR that the company has reported over the last 5 years. 25% just a couple of weeks ago management said could be sustainable. And in that, a 20% growth is something that the street definitely did not like, especially after, a 30% rally from the lows on the stock itself. So on the back of which brokerages have cut their estimates basis the first quarter performance. FY26 revenue is being cut by 5% and FY27 by 6% by Nuvama. And as a result of which, they've cut their EBITDA estimates by about 9 to 12% too. And they've downgraded the stock from, buy to hold. And they've cut the target price from 6,600 rupees to 58.84, marginally above the current market price. But still, it's a hold.
And in this stock market or stock exchange update, they've not given any other reason. And I'm just trying to think if there could be an aberration, whether they have a lot of their stores. I'm not sure. I mean, for instance, in the western northern states, because of the skirmish. I'm just, completely talking out of my hat, but just trying to figure whether this could be an aberration quarter or whether this is
If it was, the company would have given it. But the update is largely, pretty fact-based. And that's why we're seeing the, reaction. Had it been any reason that the company would have given, etc., maybe the stock would have seen a recovery from the lows, etc. But in any case, your FY26 estimates now stand downgraded, whatever be the reason.
Indeed, thank you very much for that. Well, with that, it's time for a short break. On the other side is our special segment. It's the economy. Lata analyzes Credit Bureau CRIF's report on how India lends. With Sachin Seth, the author of the report, CRIF India and South Asia, and Madhusudan Ekambaram of Credit B Financial Services, Kanika Pasricha of Union Bank of India, and Sudipta Roy of L&T Finance.
Welcome to It's the Economy. Today we discuss how India lends, a report prepared by credit bureau company CRIF. They have aggregated a mountain of data on loans lent by all institutions, private banks, public sector banks, NBFCs, MFIs, and have come out with an interesting set of trends visible in terms of lender behavior and borrower behavior. The report should be useful to lenders themselves, to the regulator, more so to investors, viewers, to understand where is the loan growth and where is the pain. Joining me on the show are the author of the report, Sachin Seth, who also is the head of CRIF, Sudipta Roy, Managing Director and CEO of L&T Finance, Kanika Pasricha, Chief Economist, Union Bank, and Madhusudan Ekamaram, Founder and CEO of Credit B. Well, gentlemen and Kanika, thank you very much for joining us. Welcome to the show. Sachin, let me start with you. Can you begin by telling us the key things, anything surprising that you noticed in terms of trends?
Thanks, Lata. So first of all, Lata, every time we release this report annually, there are a lot of things which comes completely, surprising. So this time I'll say there are 3 or 4 points. First of all, this microfinance, the issue, or let's say the stress which has been there, I think it has lasted much longer than anybody expected. I think every quarter, everybody has been tracking, and we hope that, it should, we should recover from that. But I think it has lasted much longer. We are seeing some signs of improvement now, I think, as that we saw the data last month. But that's one thing which was surprised all of us. Second is that if you see the share gain by public sector banks, and even NBFCs in many of the segments over private sector banks. That has been a big surprise because there has been a stronghold of private sector banks in many of the segments, including home loans, including other segments, credit cards, personal loans, etc. That has been a very, very eye-opening thing, which means that there are systemic change happening in the industry. So that's a new thing. Third thing, that the amount of focus and thrust being given by government and multiple ecosystem partners on MSME. We were hoping that there could be a lot more adoption, but I think there has been changes, or there have been improvements, but I think it's still a lot more to be done there.
Work in progress.
Work in progress, yeah. And I would say on another segment, consumer durable segments or other personal loan segments, I think we see that it's continued to be dominated by 3 or 4 players, primarily NBFC players, which is very, very different compared to other industries. So there are only 1 or 2 banks players, and NBFCs are doing far better there. So that continue to be there. So I would say, in a sum and substance, these are the 4 things. Everybody else, and I would say
let me ask if Sudipta agrees with you. Sudipta, anything? You've been a veteran player. Anything surprised you, shocked you in the findings of the trends in FY25?
My answer will be provocative, actually, and nothing shocked me.
Okay.
So in the sense that, okay, maybe, the pace of slowdown in some places have been a little more than what I estimated for. So if you say that is something which I found probably a little more than my expectations. But the fact is that if you see, last year was a tough year, actually. From an asset quality point of view, last year was a tough year. And most of the lenders, right, they took up their sort of credit guardrails. And coupled on top of it, if you see, from around from the latter part of 2023, the Reserve Bank of India also started upping its ante on sort of curbing the runaway growth in unsecured loans as well, right? A variety of actions. Now, when the regulator is also pushing you to sort of temper your growth charge, as well as when you have risk rising on the margin, which obviously the private sector banks with very large unsecured portfolios, credit cards and personal loans portfolios go for the first time, always. And then we saw the microfinance sort of asset quality issues start bubbling in the front from the April of last year. Overall, there was a sort of a realization in the industry that, probably, the froth, as we call it, on top of the lending ecosystem had built to a certain extent that there was a slowdown needed.
That point is taken, Sudipta. What surprised me is not that the unsecured loans fell, because the Deputy Governor Swaminathan was telling us in the press conferences that 30% growth is not like, when nominal GDP is growing by 10%, you can't have a 30% growth in unsecured loans. But I was more surprised by MSME originations falling. It was a good year of growth, a decent year of growth, FY25. That surprised you?
No, didn't surprise me because Lata, have to understand that everything is connected and MSME also takes unsecured loans. Okay. So the fact is that, when you have one part of the sort of ecosystem exhibiting risk, which is in credit cards and many of the MSME, especially on their personal or the individual capacity, also borrow from the market. And the fact is that when you underwrite an MSME loan, you not only underwrite their business, you also underwrite them personally. And when you see that their personal borrowing facilities are showing signs of stress, the guardrails also go up in the MSME lending.
Fair enough.
Right? So
okay, point taken.
I think the risk perception of the industry went up, which led to increased sort of credit guardrails across all segments, which led to a sort of secular degrowth in lending in all.
Okay, got it. I'm sorry if I'm hurrying you all because it's such a rich report. I'm trying to get, some analysis on everything. The other thing that, which I want the economist to comment from Union Bank, Kanika, it says, the report says small ticket loans saw slower uptake and higher delinquency pressures. Whereas the borrowers seem to have gravitated towards higher ticket loans. Is this saying about K-shaped recovery? What does this say?
So, Lata, first of all, thanks for having me here. It's such an esteemed panel. You're absolutely right. It is the high-ticket loans that are gaining momentum. And I'll actually connect with what Sachin talked about. The reason why private sector banks were not growing as much as public sector banks, one of the key areas is home loans. And in home loans, what we found is that private sector banks' growth is less than 5%. If I look at RBI data, I'm not quoting from How India Lends report, while public sector banks' home loan growth is around 12 to 15%. While the number of accounts growth is falling in both segments. But it's the ticket size of loans that's rising in public sector banks because private sector banks, as the cycle started to shift towards easing. They didn't want to get into EBLR-linked loans. And in fact, there's such competition in home loan market that the interest rate bucket for 9 to 11%, which had 65% share in FY23, fell to only 40% in FY25. It all shifted to 7 to 9. So private sector banks were not willing to lend there. So ticket size of the loans has shifted from private sector to public sector, and that too, we've seen it's the higher ticket size loans as part of K-shaped recovery that are growing more, while the smaller ticket size is struggling. So you're absolutely right. It's the shift in wealth effect. It's a shift in the income pyramid as well. And it's the bottom of the pyramid that's still struggling on inflation, while the upper end is relatively comfortable.
Madhu, to get you into this personal loan thing, Sachin's report says early stage stress showed improvement. Now, does this mean that we are in an improving cycle of bad loans because early stage defaults are declining?
Yeah, see, I think before getting into the report itself, let me talk a little bit about what we saw in the industry as such, right? So if you take Q1 of FY25, which was last year, somewhere in that April, May, June quarter, everyone saw the stress in the unsecured lending space. It could be either the short-term personal loan, long-term personal loan, or even the microfinance started showing certain stress. Now, it all depended on when each of the companies' stress kind of peaked, when did the risk peak, right? So most of the NBFCs, when we see that, it peaked by Q2, and in the results, we could see that, or in Q3, somewhere the risk was peaking, and after that, it was always improving. But the stress continued somewhere in the microfinance segment, and people say that it's yet to be seen, the peak risk is yet to come out and whatnot, but that is where it has continued as a higher risk within the personal loan segment. Now, specifically coming to, let's say, the fintech segments where we operate, I think what we saw was that the Q2 where the risk actually peaked, and after that it has been in a very much of a improving trends is, or the declining trends is what we have seen, and that's how the industry benchmarks are also showing. Something from the report, what I have seen is that while a lot has been talked about, there has been a risk that is in build up in the short-term personal loan or the small ticket personal loan. But if we go a little bit deeper and then look at it, less than 1 lakh rupee, the risk has not built up. The risk has built up in like 2 lakh to, let's say, the 10 lakh segment is where we have seen the risk has deteriorated over the time. But less than 1 lakh has always been performing well. That's what the data shows. But however, there has been a lot of narrative both in the media and everywhere else there, that anything less than 50,000 or 1 lakh rupee has been more stressful, but that's not the case if we just look at the report data, and that has been a pretty good surprising element for me. Yep.
Okay, yeah, I think an earlier report had said under 50,000, but that was an old report, so maybe things have corrected since. Sachin, would you agree, from what Madhu is saying, will we in FY26 see less stress? And I'll tell you why. The financial stability report that Kanika referred to, that gave the impression, especially for NBFCs, that stress will rise. From about 2.9%, they are expecting the baseline to go to 3.3%. But you're seeing some signs of early stage delinquency falling. What is your best guess of 26? Will stress be more than 25?
Yeah, I mean, first of all, it's a forward-looking statement. Yes. So we always look at the data from Bureau from the past. But yeah, if I say that, whatever we are seeing the signs, and we have also compared it with the last 2 or 3 years in certain situations. So if I stick to the segments, what we have assessed, definitely we are seeing that certain corrective actions being taken by lenders. So microfinance, we are working very closely with the industry. We are seeing corrective actions, and we have, in fact, I can tell you what is not in the report. We have even taken the data of April also, and we are seeing that, there is an improvement.
Decline in stress.
Yeah, decline is happening. Good. So we are hoping that when we release the report in June, or June end cut data, it will definitely have improvements. So hopefully that would be better. If we look at personal loans, etc., I think a lot of corrective actions have already been taken by every lender, and there's a very cautious approach. So that is being taken care. I think if you talk about certain other segments, I think people are shifting about asset-based lending and more of a secure lending. So there is a lot of talk happening on micro LAP, etc., which are by design a less sort of risky assets. So there's a shift in the industry happening towards that. And even overall lending portfolio, you see the growth which is happening is towards that, right? Gold loan also has been, the highest growth has been in the gold loan.
Yes.
In fact, if you see the portfolio growth, there has been a decline in almost everything except gold loan. And gold loan, RBI has already come out with saying that you need to have even a bureau check there, which most of the people are not doing, right? So with all this keeping in mind, I think the industry ecosystem, the guardrails, the RBI guidelines, the liquidity, the changes which have been done in the allocation for the MFIs, the measures are being taken. I think if you keep the portfolio as it is, I can definitely say that this portfolio will improve. But what definitely happens is that portfolio is never it's a going concern, right? So if I say that NTC customers will come in, certain customers will go through certain other changes in their lifestyle, their earnings, etc. But even the underwriting things are improving. So I would say some in substance of this is, I think we will definitely have improvement in the portfolio quality. But yes, there are new lenders coming in the market. They want to gain more market share. They want to have, so there could be always a mixed bag.
Fair point.
But same portfolio, if you keep it, definitely portfolio is going to become better.
Shares of Trent fall as much as 7% as the company warns of slowing growth at its annual general meeting and tells the exchanges that the first quarter revenue grew by 20%. Nuvama has downgraded the stock to hold with a revised target of 58.84 rupees.
Capital market players, BSE, Nuvama, Angel One and Motilal Oswal trade sharply lower as market regulator SEBI bars US trading firm Jane Street Group from accessing the local security market. Additionally, Angel One's gross client acquisition for the month of June falls 41%.
On the way up, we have Bajaj Finance trading with gains as the company's reported a 25% year-on-year increase in assets under management, approximately 4.4 lakh crores in its first quarter business update. The customer base too has grown by 21%.
Marico reports consolidated year-on-year revenue growth in the low 20s for the first quarter of FY26, supported by a strong volume trajectory in India business and double-digit growth in international markets.
Defence stocks, they are abuzz in today's trading session as the Defence Acquisition Council has cleared capital acquisition proposals worth nearly 1 lakh crore rupees. The nation's military seeks to onboard new defence equipment. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Vinny Motiwala. You know, if you looked at the first hour of the market and just the index, you would be saying that, okay, there's nothing which is happening. It's a slow Friday morning. But tell you what, beneath the surface, a lot is moving in either direction. Even if you look at the Nifty, we spoke about Trent on the way down. We spoke about Bajaj Finance on the way up. The broader markets, we have 1,600 stocks advancing for about 895, which are declining. So much happened. Yet on the index, we don't have much to show for. A lot of stocks in focus.
Absolutely. A lot of individual stocks in focus. Q1 updates that are coming in as well. News flow updates that are coming in as well. Among the top sectoral gainer today, let's just keep an eye out on some of these real estate names. Nifty Realty among the top sectoral gainer. Pharma is managing to hold on to gains today as well. So Nifty Pharma, 0.7% of gain up is what we're watching out for right now. So that is something interesting to watch out for. While on the downside, we have Nifty Auto as well as metals that is not doing well. So that's how we're seeing in terms of the moves coming in sector-wise as well, but a lot that's happening on the broader end of the market because that's where the outperformance is coming in as well. But on that note, let's welcome Manas Jaiswal, also of manasjaiswal.com, for a technical check on the market as well. Manas, good morning and thank you so much for joining in with us. Nifty, as of today and as of now, 25,400. How important is that level going to be now? And if we close below that mark, then what are we watching out for?
See, good morning. See, Nifty is correcting, but it is still trading above 10 and 22 moving average. Until Nifty is trading above 25,200, which is its 22 moving average, I'm not worried. I think the main trend is positive. So if you're long in this market, you can definitely hold it. Keep your stop loss below 25,200. However, if you want to create fresh long, then I think you should wait for a breakout. If Nifty breaks 25,600, then you can go long aggressively in the market, because after that you can see almost 400 to 500 points rally on Nifty. So I'm still bullish, and I think long position can be held with a stop loss of 25,200.
All right, we take that point. Stay long. You know, as we speak, a bunch of these broader market stocks are spiking. We have Z Entertainment, which is now moved to the high point of trade. It's a 5% up move, and a large part of that has come by in just the last few minutes. There was a brokerage note where the management has laid out some medium to long-term targets. Remember, the company's promoters are issuing some warrants to themselves as well at around 133. So we'll keep an eye out on Z. The other one is Godrej Industries. We spoke to the management yesterday. They did guide for nearly 2,000 plus crore worth of additional sales on the back of capex that they're doing. Higher share of revenue coming in from the specialty chemicals, which would positively impact their margins. The street's taking note of that as well. That stock up nearly 6%. You know, Manas, individual stocks, are you playing on the long side since your tilt is bullish?
Good morning, Mangal. So I think, yes, you can create some long position in strong names, especially pharma names, because many pharma stocks are looking strong on the charts, especially Lupin, where the stock has given a confirmation of higher tops and higher bottoms, and it is trading above 200 moving average. So I think in Lupin, one can create long position. Stop loss should be around 1970, and here the target would be around 2030. And second is the Biocon MGL, where stock has given a black pattern breakout, and the stock has been making higher tops and higher bottoms from the level of around 1300. So here also one can create long position. Stop loss should be around 1520 and target would be around 1600.
Okay, keeping an eye out on those levels over there. But in terms of today, some of these volume movers, we're seeing even Sapphire that is buzzing in trade, or Devyani International. Anything you're looking at over there also on the technical front?
In Devyani, I think stock has been taking support near 160, 165 for quite some time. Now, since stock has broken its 200 moving average, you can take a trade here on the long side. Take a long position here. Stop loss should be around 168. However, on high level near 185 to 190, I think you should book profit in Devyani.
Okay, book profit in Devyani is what you're saying. But let's shift focus now. And Manas, thank you so much for joining in with us. We're going to shift focus to our special segment now, where we will get you a few ideas of profit from Money Control Pro. Jitendra Gupta, Money Control of moneycontrol.com, is joining in with us to talk to us about the stock that he's tracking closely. Jitendra?
Hi, thanks. KEC International, a leading player in power T&D, is navigating through a mixed execution cycle while headwinds in non-T&D business is easing. Its core T&D business is expected to propel growth, supported by strong 33,000 crore orders in hand. In Q4 FY25, KEC posted a healthy 12% year-on-year growth in revenue, and that was driven by strong execution in T&D and cables business. EBITDA surged by 39% with margins expanded 110 basis points to 7.8%. This was supported by operational efficiency and better revenue mix. Management expects FY26 revenue to grow at 15% with EBITDA margins inching towards 8.5%. By FY27, margins are projected to exceed 9% on the back of strong profitability in T&D business. Importantly, 70% of the targeted 30,000 crore order inflows for FY26 is likely to come from T&D. Non-T&D verticals, including civil, railways, are also expected to see turnaround as KEC focuses on capital light, margin accretive projects. Of course, it will also focus on tighter working capital management. At about 20 times its FY27 estimated earnings, KEC is trading reasonably valued. It is reasonably valued given its strengthening fundamentals and improving margins profile. With execution challenges easing and non-core segments poised for recovery, the stock presents attractive re-rating opportunity.
All right, that's about KEC International. Just keep an eye out on Northern Arc as well from the broader markets. That stock is up around 8.5% here too. The management joined us on Tuesday. They said that they are targeting 22 to 25% AUM growth for this year. Along with that, they're looking at nearly 30-40 basis points NIMS expansion this year, another 30-40 basis points next year as well. So that would be an overall expansion of nearly 80 basis points in the next 2 years or so. The NIMS would cross double digit and sustain above that on a 22 to 25% AUM growth. That stock continues to do well. Good updates coming in from the financial sector that has a further tailwind on all these names. Take a short break, but as we do that, let's tell you about CNBC-TV18 Prime, the all-new offering that we have, which brings you insights from policymakers, business leaders, economists, all of them shaping, both India and the world's future. CNBC-TV18 Prime decodes global shifts and decodes their impact on Indian businesses, which gives you unparalleled insights. You can tune into the channel CNBC-TV18 Prime at 12 noon for the global reset. Thereafter, we have at 1 p.m. the Big C, which is on commodities, crypto and currency. And then every evening, we have Global Lens at 8:30 p.m.
Welcome back to Chartbusters on CNBC-TV18. Now let's shift focus and talk about an important news flow that came into today, and talking about few of those capital market players, namely BSE, Nuvama, Angel One, are trading lower, and this came in after the market regulator SEBI barred US trading firm Jane Street Group from accessing the local securities market. Now Hormaz is joining in with us to give us more details on this one. Hormaz, over to you.
Well, what is a Friday if it is not crazy? And the SEBI order on Jane Street has ensured that for all of us today. The market regulator has banned Jane Street and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street made unlawful gains to the tune of 4,843 crore rupees through trades between August of 2023 and May of 2025. This entire amount will now be impounded, the largest in India's capital market history. SEBI has ordered that this impounded sum will have to be deposited in an escrow account which can be opened in any scheduled commercial bank, and that no debit will be made without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions, or until the expiry of such positions, whichever happens earlier. Now, this matter goes back to July of last year, when SEBI, the market regulator, had asked the National Stock Exchange, or NSE, to examine the trading activities of Jane Street to ascertain any market abuse. The report for this was submitted by the exchange in November of last year. Now, a month later, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in F&O terminology is liquid instruments that is easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was engaged in activities which were in violation of the regulator's PFUTP, or Prevention of Fraudulent and Unfair Trade Practices regulations. As a result, SEBI asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. However, the regulator found in May this year that Jane Street was in complete disregard of the caution letter and still running large cash equivalent positions, which was not only a violation of their regulations but also their own undertakings that Jane Street had given to the regulator. And it is this what led to the issue of the order last evening. That's not all. Last year, SEBI had put out a study stating that 9 out of every 10 retail traders lose money in the F&O space. How much did Jane Street earn? Not 1, not 2, but 36,500 crore rupees between January of 2023 and March of 2025. But what is Jane Street? Now, a global proprietary trading firm, 2,600 employees across the US, Europe and Asia, uses algorithms to identify trading opportunities in the market, and it's trading in over 45 countries. Now, does this order bring us to the end of this issue? Well, not yet, because Jane Street has contested the findings of the SEBI interim order and will be reaching out to the regulator regarding this. So it's only part 1 that has come to an end. We'll await to see more as the events unfold.
All right, Hormaz, thanks a lot for that. We will definitely keep an eye out on this story. But before we move on, SEBI tells CNBC TV18 that Jane Street was the largest position in the Nifty bank options market, and fear of manipulation from other similar players may not be that much. They've added that no more similar investigation or orders like Jane Street is expected, but they do remain on the lookout for newer risks, if any, emerge. So we'll watch out for how this plays out. For now, Jane Street is the isolated problem that SEBI has acknowledged, with no other problems coming in from other similar players. We're also keeping an eye on a couple of these consumer names. The biggest loser on the Nifty today is Trent, and that's because the company has given its first quarter update, where the revenue for the company has grown just by 20%. So the reported revenue is a little over 5,060 crores. Why is this a concern, and why is the stock down 7% on the back of that? Because Trent's own history, the last 5 years, revenue has compounded by almost 35%. In fact, very recently, the company itself said that, the business will grow upwards of 25% on a sustainable compounded annual growth rate basis. And as a result of which, the street had made its expectations to that extent. And now, because the first quarter, for whatever reason, has grown at 20%, the street has had to cut their estimates for FY26 and FY27 as well. Nuvama, for one, has cut their, this year's estimate by 9 to 12% on the EBITDA, a little lower on the revenue front as well. And that takes their target price lower from 6,600 earlier to around 5,800 odd thereabouts. They've downgraded the stock to hold. Stock, which had already seen a rally from the lows of around 4,500 all the way up to 6,000, is now correcting post this first quarter update. On the way up, however, we have Marico, which is higher by about 2.5%. That on the back of their first quarter update. They've said that, consumer sentiment has been fairly good when it comes to rural, and even urban has shown steady improvement, on the back of which their India volumes have actually been a multi-quarter high when it comes to growth. And that's led by value-added hair oil. And that, to me, is the biggest positive, because value-added hair oil was subdued and under pressure for the last 8 quarters, if I remember correctly. This growing in double digits is telling you that consumer sentiment, indeed, at the broader end, is picking up. We've seen their international business perform well as well. So add all of this together with the increase that we've seen in oil prices, their revenue growth has been in low 20s. What's the only reason which is keeping the stock from rallying a lot more is the gross margin, because gross margin pressure, they believe, continues. They expect it to ease out in the second half. But, EBITDA margins will see a compression. Operating profit will not grow as much as the revenue has grown. They'll only show a moderate increase, which is why the gains on the stock at one point were up 4%, but now has moderated to just about 1.8%.
So moderating operating profits, or modest operating profit growth, is something that is keeping the stock from the day's highest point, and we're seeing it just with a uptick of 2% as of now approximately. But a slew of other updates that came in from the banking and financial space as well. Gaurav is joining in with us to give us details on Bajaj Finance, Bajaj Housing Finance, Credit Access also among the names coming in. Gaurav, over to you.
Let's talk about Bajaj Finance, because a good set of numbers is what we saw from the company. In fact, it was actually a positive surprise for investors, because AUM growth was at around 6% on a sequential basis, which also results into 25% growth on a year-on-year basis. Now, let's not forget that customer base has also increased almost in the tune of 21% on a year-on-year basis. And after that, now brokerages are also being a little bullish. What they're saying is that asset quality is the next checkpoint for the company, because loan book growth has been strong. When we talk about Bajaj Housing Finance, there also we have seen a similar trend. The AUM growth has been at around 24%, with the disbursement growing somewhere in the tune of around 22% on a year-on-year basis. Now let's also focus on Credit Access Grameen. A good set of numbers is what we saw from the company in terms of the asset quality for this quarter's update. When we look at the overall disbursements, or rather gross loan portfolio, there was a little muted performance, and this was because of the write-offs worth 690 crore rupees. But if we exclude that, the gross loan portfolio increased almost by 3% on a sequential basis. What remains positive for this company is the asset quality, because when we look at the PAR 90 days product and its overall ratio, it has come down almost by 100 basis point. PAR 0 days portfolio has also come down almost by 100 basis point on a sequential basis. And at the same time, let's also not forget that for FY26, company has said that they will be growing their AUM somewhere in the range of 14 to 18%. And the disbursements have also been strong as per company's overall management commentary. So definitely on the back of this, we are seeing some uptick in this counter and a positive number as well coming up from the company.
Okay, Gaurav, thank you so much for that. But on that note, we're actually going to slip into a very short break. But here's some good news coming in for our viewers, as India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store, Google Play Store, or you can just scan the QR code on your screens.
Welcome back. Let's talk about the Jane Street story itself. We do have Yash joining in shortly to tell us about what SEBI has said to CNBC-TV18. But meanwhile, just keep an eye out on the defense stocks. They're buzzing. The Defense Ministry has cleared 10 proposals to buy weapon systems and military equipment worth nearly 1 lakh crores. Which stocks benefit from this? Ria joins in with more.
Well, yes, Mangalam, yesterday the DSE has approved 10 capital acquisition proposals worth over rupees 1 lakh crores. So let's take a look at the large projects and the likely beneficiaries of the same. The first one is the QRSAM order, which is the order value is expected at about rupees 30,000 crores, and BEL, which is Bharat Electronics, is expected to be the lead integrator for this. Of this, 40% of this order will go to Bharat Dynamics for the production of missiles, which comes out to be about rupees 12 to 13,000 crores. Two other companies, Apollo Micro and Astra Micro, are also expected to get smaller orders for components and subsystems for this order. Coming to the MCMVs, which is the mine countermeasure vessels, 12 units of these have likely been approved at an estimated cost of about rupees 44,000 crores. All three shipyards, which is Mazagon Dock, Cochin Shipyard and GRSE, are expected to bid for this tender, and the order may likely be split between the two lowest bidders. Some other projects that have been cleared yesterday, the armored recovery vehicles, the estimated value for this one is about rupees 10 to 14,000 crores, and BEML and Bharat Forge are the likely beneficiaries for this. Some other projects have also been cleared: moored mines, electronic warfare systems, integrated common inventory management systems, and super rapid gun mounts have also been cleared yesterday. And the likely beneficiaries for these are also BHEL, BEL, Data Patterns, Astra Micro, and Apollo Micro. So on the back of this, all of these defense stocks have been trading higher in today's session.
Okay, Ria, thank you so much for that. We'll keep an eye out on all those defense names. But with that, we are going to wind down this edition of Chartbusters on CNBC TV18. Thank you so much from Mangalam, myself, as well as the team who put this show together. Leaving the Nifty at 25,420. But don't go anywhere. Your trading hour up next to take you through all that market action.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormuz Vatakia. Good morning, Hormuz. Last day of the week, but it is such an action-packed day so far. It's just 11, and we've spoken about in greater detail a lot of things that have happened, and we'll discuss that through the course of the show as well. What's happening with the capital marketplace, what's happening with Q4 updates, and also we are kicking in earnings from the next week. So a lot to talk about. For now, the Nifty up 17 points, mid-caps are outperforming, the bank up around 0.1%, and majority of the sectoral indices, they are in the green right now, and we've seen that recovery from the opening lows as well on the Nifty. So we'll have to track whether that continues or not, and Nifty Bank is the one which has led to that recovery for now.
Oh, it's a Friday if it's not crazy. That's the Nifty Bank leading the recovery last week, pulling the index lower all through this week, but it is the one that is outperforming today, at least around 80 points higher. It's traded in a 200-point range today as the Nifty Bank, so keep an eye out on that one. It's been the principal market mover so far. Of course, we still continue to remain in that range, still awaiting more clarity on that India-US trade deal. So there is still a lot of uncertainty that is in the market, which may be keeping the market participants on the sidelines though. But the capital marketplace, as Sonal was just mentioning, they were the ones that were under pressure earlier in the day, and they are seeing some bit of recovery from the day's low, be it Nuvama Wealth, be it Angel One. Angel One, of course, also reacting to its business updates. So that is also an added factor for Angel One. You can see Nuvama Wealth at one point was down around 7%. So slight recovery from the lows. Angel One continues to remain at the lows of the day, 6% lower there as well. Showing some bit of resilience is CDSL. Yes, BSE2 down 4.5% in today's trading session. And Motilal Oswal seeing a recovery from the lows of the day. But yes, the big talking point though has been the entire Jane Street issue and the resultant SEBI order.
Yes.
And apart from that, of course, the PNGRB orders also, that one has just flashed on our screen. So
yes, so that's a press release. Though they are talking about what will be done with respect to unified tariffs, there is no final tariff number that has come about. That will be the most important thing for GAIL. They are talking about how they will reduce the zones in unified tariffs from 3 to 2. They will also be asking these companies to take up, the pipeline companies, to go ahead and reserve their pipeline capacity or pipeline supply, from a long-term process or perspective, so that there's no volatility in gas prices. We'll discuss that in greater details, though these tariff regulations for now still need the final tariff number for us to understand what the impact could be. But for now, this is an important aspect to track. But a host of IT stocks are in focus after a Macquarie note. Rima is joining us to tell us more. Rima?
Thanks so much for that. So the first change Macquarie has done is that they've added Macquarie to their marquee sell list. The target price stands at 1,090. They're saying that Tech Mahindra will find it difficult for them to achieve their FY27 goals on revenue and on margins. So on margins, their goal was to hit 15%. On revenues, their goal was that by FY27, which is 3 years after they effect that turnaround plan, they will be able to achieve higher than industry growth rate. Now, according to Macquarie, this will be difficult because anyway, Macquarie, Tech Mahindra is a large company, and plus to do it with the kind of telecom exposure TechM has, and telecom has been under pressure for the entire industry. So that's the reason why Macquarie has put Tech Mahindra in their marquee sell list. The other change is that they've removed HCL Tech from their marquee buy list. One reason is the stock has done very well. So they're saying it's given an 81% return since Macquarie added it to their buy list in May of 2022. But also going ahead, in the near term, the EPS growth will be in single digits. And therefore, that is likely to limit the re-rating, PE re-rating for HCL Tech. Even though on growth, it's likely to do better, it's still going to be a single-digit kind of an EPS growth rate. The third update that they've given, which is not a change, but they've retained TCS as a Macquarie buy idea, marquee buy idea, because according to them, TCS can return to their operating target margin band of 26 to 28%, which can be a re-rating catalyst. Back to you.
We'll keep an eye out on these IT names. Of course, they will be the ones kickstarting results next week. And TCS, just as we speak, is at the highest point of the day, just a 0.5% higher, but still doing fairly well for itself and contributing to ensuring that the Nifty remains in the green. But the big talking point of the morning, as we were also mentioning, was Jane Street and SEBI's order regarding the restraining order that has been issued against Jane Street and its associate companies from accessing the capital markets. Let's listen in to what experts like Prakash Diwan and Complete Circle's Gurmeet Chadda had to say on this issue.
This will cleanse the system. They will cleanse the system, make sure that capital destruction that was happening rampantly for small investors stops, which is good, but it will impact some of the capital market infra plays, right? We've seen how in the last 18 months they've done so well, whether it's exchanges, brokerages, a lot of those elements. So there will be an impact on that, but I don't think the overall market gets bullied by this. It'll probably be much healthier, and the regulator has made it very clear that they will not be sitting down just because somebody is kind of out there with much more money to be traded into these options.
Quite a landmark order, and I think by the sheer size, I think probably I don't recall anything like this. And if you see the order, it clearly mentions, obviously it mentions Bank Nifty incident, where on 17th of Jan, the HDFC Bank is the market reacted. Bank Nifty opened down post the update from the bank. I think the key word here is manipulation and being unfair in terms of prices. And I think to me it's just the right order. I'm sure there will be legal recourse done, and it will be a long drawn battle.
And to take this conversation forward, we are now being joined by Mr. Sailesh Haribhakti, the chairman of Sailesh Haribhakti Associates, who is joining us. Mr. Haribhakti, good morning. Thank you for joining in. You just heard from some of our experts calling it a landmark order, enabling cleansing of the system. Do you agree to that? What do you make of this SEBI order which came in last evening?
I think it's an order which is drawing a line in the sand. It is telling people that while we are a liberal capital market regulatory framework, we will not tolerate egregious behavior. And look at the way egregious behavior has been demonstrated in this particular case. There was a cautionary order by the NSE earlier. There was very clear indication that they were asked to restrain their activities. But despite all these warnings, they decided to continue. And so what this order says is that they will have to deposit 4,843 crores with SEBI, which is approximately 10% of the purported gains that they have made in the markets. And they've been asked to not access the capital markets anymore until the full investigation has been done. I think this is an appropriate way in which a regulator like SEBI must make sure that the integrity of the markets is protected. And while we understand the whole idea of why there should be index options and futures and option trading and all of that, I think it has to be done under constraints. And this is what this order is saying.
Okay, so you say it is a good step which is taken by the regulators. Mr. Haribhakti, this is just an interim order that has come in from the SEBI, right? What do you think could be the next course of action for them? And this is one of the highest, or I think the highest which has been penalized in terms of a figure in the Indian market in terms of an order. Do you think there could be an addition to this number since this is just an interim order?
Yeah. I mean, this is just not a penalty at all. It is just an impounding of some of the gains that have purportedly been incurred. So full investigation will be done. Practices will be looked at. There is layering, which is very clear. Multiple entities acting in concert, which is clear. There is also a very significant amount of at expiry manipulation that seems to have occurred. So all of these will be taken into account when SEBI finishes its complete investigation, and I'm sure a landmark judgment will be delivered. This is not yet a penalty. This is just an interim order to impound some of the gains.
Mr. Haribhakti, you mentioned that this is drawing a line in the sand for a lot of these market participants. But the kind of order that has been issued by SEBI, it mentions the amount, the extent of which the manipulation was done, particularly in the banking index by Jane Street, as the order highlights. Now, does that also show that there are certain regulations that still need more tightening from the regulators and to prevent any further such issues from cropping up in the future?
No, to the credit of SEBI, it must be said that as soon as the first hints of Jane Street's activities was visible, they came up with regulations which tightened the F&O process, as we are all aware. And it is these regulations which will now be looked at. From the sandbox of these regulations, SEBI will now conduct the investigation and reach its conclusions.
Okay. Okay, so Mr. Haribhakti, just taking the point forward to what my colleague was saying as well. So according to you, there are no more corrective actions that need to be taken, generally asking from an industry perspective for now.
So basically, I feel SEBI's regulations will continually be tightened as they start seeing different kinds of egregious behavior, as it has been coined in the context of Jane Street's activities. And that will continue. It is not as if something that is done at a point in time is going to be valid forever. So there will be a continuous evolution of regulation. There will be far more deeper scrutiny of things which look out of line, and the integrity of the capital markets will be preserved. That confidence has been given to market participants.
Absolutely, a credit where it's due, of course, Mr. Haribhakti. Thank you so much for sparing time and sharing with us your insights on this order, which is the big talking point of the morning. Thank you so much for joining in. The markets, well, they continue to remain where they are. The Nifty absolutely at the flat line, 25,400 is where the index stands. We take a short break. On the other side, the management of Pearl Global joins us to discuss the impact of the trade deal that took place between the US and Vietnam on the other side. Stay tuned. Welcome back. Shifting focus now to global trade. The United States has announced a trade deal with Vietnam and said that it will levy a 20% tariff on Vietnamese goods sent to the US. Now, to discuss the impact of this deal on India, Pallab Banerjee, the Managing Director and Group President at Pearl Global Industries, is joining us. Mr. Banerjee, good morning. Thank you for joining in. What do you make of this deal? How does it benefit you as a company, considering the fact that you have quite a few manufacturing facilities in Vietnam? Is this a positive for you, or will it still result in an incremental increase in costs because the tariffs are still gone higher from 10 to 20%?
Thank you. Thank you, first of all, for having me on this call. Yes, I think Vietnam is looking at it very positively. From a 46% initial number that President Trump had spoken about, it has come down to 20%. And keep in mind that what's happening is China is at a much higher percentage of tariff at this point of time. So what happens is what Vietnam is looking into, a lot of shift that might happen from China into the Vietnam in terms of the apparel manufacturing. And yes, Pearl Global being having a significant presence in Vietnam, we are looking at it very positively. And of course, we are seeing a huge amount of interest from our buyers who are looking to book this capacity and place more orders with us.
Okay. Mr. Banerjee, just to follow up on that, when you say you have a significant presence in Vietnam, what is the percentage of revenues that come in from Vietnam? And while the tariffs are lower than China, but they are still increased from the previous levels, right? So what kind of impact would that have on the P&L? You will see more order inquiries coming by, but still the tariffs are higher. So if you can tell us what could the impact be there in terms of cost?
So, see, the kind of apparel which is made in countries like China and Vietnam, the segment that we are in is much more value addition, much more strategic in terms of the customers that we are supplying to at a higher portion of the pyramid, if you talk of the product pyramid that we supply to. So, yes, there is at this point of time, if you see from the MFN, the tariffs were at a level of 17% for average for cotton products and 26% for synthetic product. And so far, the MFN still continues to stay. And this 20% tariff, which I think President Trump has spoken about, is something like which will be in addition to that. So yes, that means there could be more tariff for the retailers and the brands who are importing goods from Vietnam into US. But keeping in mind the whole deal that has been discussed since April, it is valid for all the countries. The lowest that we have seen is 10%, a baseline tariff that US has spoken about, and the highest have been in the 60s. So if you look at the whole spectrum, 20 seems to be quite reasonable. And that's where I think the industry celebrated, because if you remember, a majority of garment exports, almost about $40 billion plus, is garments is getting exported from Vietnam into US. The dependency on the brands and the retailers in US for countries like Vietnam and China or Bangladesh is very, very high at this point of time. So keeping that in mind, it's a good deal. That's why most of the brands, if you saw their market valuation went up after this information came into the market.
What does that do to you as a company, Mr. Banerjee? How much of your overall business comes from the Vietnamese market? And with this deal, have you analyzed it would benefit your top line, bottom line margins in a particular way, or you yet to come up with that number?
So yes, the details of the deal would be more clear on the next few days, I guess. What has happened now at this point of time, our business, our total top line, almost about approximately anywhere between 15 to 18% is coming from Vietnam. And what we have seen with all this deal and whatever was going on, the whole China exodus that has been really accelerated in this last few months, that had seen that quite a huge amount of interest for these buyers for that particular segment of product that we are talking about, what we manufacture in Vietnam, that has gone up significantly. So yes, the order books are looking quite good, quite strong for the rest of the year. In fact, we are almost booked for the rest of full year in Vietnam. So that's a positive sign. In terms of the bottom line that you're talking about, yes, some of the retailers had come back to us asking for some kind of burden share or the tariff burden, the extra tariff that they have been paying, this 10%. They wanted to share certain of the burdens with us, which is a part of a negotiation. So we negotiated the kind of a smaller amount to do that. And also the apparel, what happens is quarterly, US negotiates and places business every quarter. The price fixation is happening every quarter. So that means you can really negotiate and build some of this negotiated price or whatever you are giving to the customer that can be worked on between us.
Okay. So, Mr. Banerjee, since you're saying you're fully booked in Vietnam, will that also mean that more capacities could be added there? And considering that it has come in as a tariff relief, the capex that you had planned on Bangladesh and India, could you move some of it to Vietnam?
So we have already had planned a capex in Vietnam as well, and we have been working on it. So that's getting captured. That means like already our capacity has gone up by high double digits, like almost 25-30%. We have been already working on that. So that's something we had factored in, that this kind of movement is possible, and we have been ready for it.
Mr. Banerjee, to take this point further, now with this, the other bit that was signed other than this trade deal was the UK FTA that India had signed. Now that reduces the textile import duty from around about 8 to 12% to 0. Now, how does that benefit you as a company? Would this be a bigger positive for you compared to the trade deal that has been signed with Vietnam?
Comparatively, UK is a much smaller market if you compare with US. So US is almost, I would say, significantly, I think 6 times bigger than the UK market that we are talking about. And so, yes, there is an advantage both in India. India, I think, as we are waiting anxiously for the next, I hope, 24 or 48 hours, or maybe till Monday, about the deal with the US and India, that would definitely move the needle significantly if it's a favorable deal for us. But yes, UK has been a positive step. Definitely, it will grow the Indian potential more. But I think the Vietnam one, the exodus that is going to happen from China into Vietnam, that will be much more significant and much bigger.
Okay, we get that point. So we never know how things change when it comes to trade deals and tariffs, right? So it continues to be in a wait and watch mode. Mr. Banerjee, thank you so much for joining us and telling us what this tariff on Vietnam means for the industry and a company like yourself as well. But with that, we'll slip into a break. But remember to tune into all new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and the impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, we've been talking about how PNGRB has been planning to make changes in the Unified Tariff Pipeline regulations. There is a note that has come by. However, important to note, there is no Unified Tariff number that has come. For GAIL, it is very important to know what the final tariff number would be. They've asked for a 33% hike at 78 rupees. This amendment says that the number of Unified Tariff zones is reduced from 3 to 2. So basically, there'll be 2 zones. One zone could be west or east, and there'll be only just 2 tariffs overall that the government or the PNGRB will put out. The second would be that the unified zonal tariff of Zone 1 will be extended nationwide to CNG and PNG segments. So gas from GAIL goes to CNG or PNG segments, that's to IGL, MGL. So they'll have just one tariff for that, so that for the consumers, there's not a lot of volatility. The third one would be that they've introduced a dedicated pipeline development reserve where a lot of investments will be made. And they also say they are mandating these pipeline operators from the listed space, the biggest one is GAIL, of course, to procure 75% of their gas via long-term contracts, again, to avoid any sort of volatility. It is a lot of it in terms of procurement is already in place, but they have mandated it right now to avoid any volatility for the end consumers.
Interesting. We're still awaiting the final tariff number from the PNGRB. So interesting developments there on the gas utility space. But so much action has taken place all through the morning that we are yet to discuss the slew of banking, financials and other business updates that came out last evening. So we have Gaurav joining in to talk about those and in specifics on Bajaj Finance, Bajaj Housing Finance and Credit Access Grameen, which is doing very well for itself today, Gaurav.
And it also opened trade today, and the reason being that a good set of numbers is what we saw in terms of the total AUM growth. Now, Bajaj Finance reported 25% growth on a year-on-year basis, which also translated to around 6% growth on a sequential basis, which is actually positive because when we look at the market and the overall sentiment, we have already seen some credit growth slow down. Another factor to highlight is that the customer base is also increasing for Bajaj Finance, and from here on now, brokerages also believe that asset quality is something to be looked at, but overall on the AUM front, it has delivered a strong set of number. Bajaj Housing Finance, on the other hand, also delivered same set of numbers. AUM growth was at around 24%. Disbursement grew almost by 22% on a year-on-year basis, which was again a strong set of number from Bajaj Housing Finance. Lastly, let's also focus on Credit Access Grameen. When we look at the loan book portfolio, it was actually stable on a sequential basis because there were some write-off impact of around 690 crore rupees in this quarter. But at the same time, if we exclude this, the growth was around 3% on a sequential basis. And on the other hand, what remains positive for the company is the asset quality, because the early delinquency trends have been actually easing off. We are seeing some kind of 100 basis point of easing in the early delinquencies, and at the same time, although Karnataka portfolio still remains a little cautious to be looked at, but excluding Karnataka, the 90-day delinquency pool has come down almost by 100 basis point on a sequential basis. So definitely this is one thing which is driving the stock price right now, and on the back of the good set of numbers, we are also seeing some kind of uptake in Bajaj Finance and Bajaj Housing Finance.
All right, take that point, Gaurav. Thank you so much for joining in. So a lot of these financial names on our radar today. It's time to slip into a short break. When we come back, we'll discuss the market fundamentals with Sailesh Jain from Tata Asset Management. Stay tuned for that.
Welcome back. A quick chart check then from Mitesh Thakkar, who's joining in. Mitesh, thank you for joining again. We're still holding on to that 25,400 mark, which you had mentioned is going to be a key pivot point a couple of days ago when we spoke to you. You still hold on to that view? If we slip below 25,400, where does the index head now?
To me, good afternoon. To me, I think the structure is slightly getting weak. The momentum indicators have started to shrink. So maybe 25,400 will give away, and we might actually go down to as low as about 25,200 to 20 zones. That is a very strong support area. So my belief is that any correction or pullback should, get reversal or should get strong bounce from levels of 25,200 to 50. But I'm still not sure whether we're heading over there or not, because last 3 days we have had about, last 2 days we have had about 3 or 4 attempts, and 25,400 wasn't taken out decisively. So just in that wait and watch kind of a mode on the index. But yeah, I think there's a chance and there's a good probability of that happening. So we must be open to that. Having said that, right now I have one buy and one sell call. Poonawalla Finance is a buy with a stop at 470 for targets of 500. And SBI Life, that's the stock which is going into a corrective kind of mode. So sell there with a stop at about 1820 for targets of 1740.
Okay, all right, Mitesh. Thank you so much for joining in with that chart check and technical picks as well. Let's get to fundamentals now. Sailesh Jain, fund manager of Tata Asset Management, is joining us now. Sailesh, good morning. Thank you so much for joining in. Well, we've already seen that rally that has come by, but we do have important events coming up as well, be it the US-India trade deal, be it earnings. In August, we'll have the RBI policy again. What is the next thing that markets could react to now?
I think, thank you for having me here. So you have summed it up well in terms of the events ahead. I think the event the next week where the tariff, the 90-day period will get over, I think is a critical event. As we have been hearing that US has signed up some, or they are on the verge of signing bilateral treaties between countries. I think that will be a key event to be watched. Monsoon progress is a significant event which we are anticipating. The earnings season will start this month now. I think that will be a key to watch as if you really analyze what happened in Q4 when we had least expectations from the earnings. The earnings were actually way better than what we were anticipating. We just want to see that whether the momentum is intact for this earnings or not. I think if you really and also what is also critical is basically the pricing, the commodity prices. So if this commodity prices is where it is and there is no spike in it, I think India is set to for a good going as well here on.
Sailesh, good morning. Thank you for joining in. Since you mentioned earnings, which are the sectors that you are watching out for in terms of those that can spring up a positive surprise this time around, especially considering the fact that we'll be having a low base from last year?
So yeah, so I think what I personally believe could actually do, one is banking, which I personally believe can actually do very, very well from here on, considering the fact that valuations have been low. Though the full benefit of CRR will not flow into this quarter, it may drag on to next quarter. But a cut in the CRR will actually help the banks to improve their margins. It could actually benefit both the PSU and the private, but maybe I am banking more on, or I am putting more trust on the private banks. IT is one sector which can actually throw surprises. I think the order book has been pretty decent. The whole idea is that how the commentary is that looking at where the IT stocks have been moving globally, I personally believe that these stocks can actually, IT as a sector can throw positive surprise.
Okay, that's about IT and banking. What about the FMCG or the consumption space, Sailesh? How are you looking at it? Because it has been in focus since tax cuts in the budget, but now that we have some updates coming in, trend today saying it could be a weak Q1. The next focus, of course, as you said, would be on monsoons. How are you looking at this entire piece?
No, so fair enough. I think what can drive or why we are seeing so much of positive momentum in the FMCG or the consumption space is two things. One, the tax benefit which is given by the government in the last budget or the previous budget, and also what was also important, the liquidity. Now, see, if you really see after the RBI rate cuts, the liquidity in the markets have improved tremendously. In fact, if you start analyzing the deposit rates, also has started moving. What is really critical is basically the credit growth needs to pick up, which has been tepid till now. I also have been hearing that we have seen some amount of slowdown in rural. But the point is that with this rate cuts and this tax benefit, the disposable income in the hands of the consumers will definitely improve. With this, I personally believe that consumption sector, which has been lagging for a while, can definitely see some boost in the coming days. Also, what is also critical is basically the rain. At least whatever forecast I have been hearing on the rain, we believe it will be in line with the long-term average. Once you have those rain forecasts, which has been fortunate, we've been fortunate to have good rains in last 2 to 3 years. A continued good rain will definitely boost the consumption sector across the country, which means the rural and the urban both in perspective.
What about the capital?
So definitely, consumption sector, it looks definitely good. I think what can also drive with the lower interest rate is also the real estate sector. I think with the lower interest rates definitely pushes the real estate and the consumer durable and the auto sector as well. So.
What about capital markets, Shailesh? A lot of these listed players, the BSEs and the CDSLs and the likes, they run up quite a bit in the last 5 to 6 months, and now with this recent Jane Street order that has come in, a bit of under pressure in today's session. Would you use any of these declines or any near-term weakness as an opportunity to add on to your positions if there are any, because of the fact that there is a long-term growth runway that's lying ahead?
So I think, obviously I can't comment on stock specific, but let me be very, very generic on that. The valuations of most of the capital market stocks have actually, increased in the sense they have started becoming expensive now. What had happened was that last 6 months when market corrected from the month of September to the month of March, because you saw a drop in significant volumes, most of the stocks corrected. In this last 3 months, right from the April to the current scenario, as markets recovered, most of the stocks recovered very sharply, running ahead of some of the stocks actually running ahead of their valuation. My view is that with the market going into a tepid zone, maybe we will see some drain on the volumes. That may give either some time correction in other stocks. But having said that, fundamentally, most of the stocks are actually market leaders and they may continue to do well in the long run. But for a short-term period, I personally believe that valuations have slightly run ahead of the fundamentals.
Okay, all right. So we take that point. That's about capital markets. Thank you, Shailesh, for joining in today with your thoughts on different sectors and the markets overall. Interesting times to look forward to what would happen with so many macro events lined up. With that, we'll slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Some more selling pressure coming in on the index now, 50 points lower and convincingly below the 25,400 mark. And Mitesh was just mentioning, if we do slip below, there is a possibility of slipping below towards the 25,200 mark. So another 150 point downside that still is left open on the index. Some of the big losers have extended their losses now. Trent is down 9%. Nuvama Wealth is now down 7.5%. Angel One down 6.5%. BSE is down 6%. So these capital market plays are now coming under pressure. The ones that were not coming under pressure, too, are seeing some pressure now, with CDSL now down 3%. So that is extending their losses. And look at some of the other losers like Bandhan Bank, LT Foods, seeing losses of anywhere between 2.5% to 3%. What's bucking the trend, though, are two names. Sapphire Foods is one of them, 10% higher on that stock, the top gainer on the Nifty 500. Credit Access Grameen, after their business update, is up 7% in a wobbly market like this. So that is doing well for itself. Good going. And the other one is Chennai Petro, 6.5% higher on that stock. And if you take a look at it on a weekly basis, that too among the top gainers this week, up 11%, is Chennai Petro, and that spike has come in just the last few minutes as in today's trading session. But some of the other movers today are the defense names, after the defense ministry cleared 10 proposals to buy weapon systems and military equipment worth over 1 lakh crore rupees. Rhea is joining in with more on this. Rhea.
Well, yes, Hormuz, yesterday the DSE has approved 10 capital acquisition proposals over rupees 1 lakh crores. Taking a look at some of the large projects and the likely beneficiaries of the same. The first one is the QRSAM project. Estimated value for this is about rupees 30,000 crores, and Bharat Electronics is expected to be the lead integrator for this one. Of this, 40% of this order is expected to go to Bharat Dynamics for the production of missiles, which comes out to about rupees 12 to 13,000 crores. And two other names, Apollo Micro and Astra Micro, are also expected to receive smaller orders for components and subsystems for the same. Moving on to the MCMVs, or the mine countermeasure vessels, the estimated cost for this one is about rupees 44,000 crores, and all three shipyards, which is Cochin Shipyard, Mazgon Dock and Garden Reach Shipbuilders, are expected to bid for the tender, and this order may likely be split between the two lowest bidders. Some other projects that have been cleared, the armored recovery vessels, estimated value about rupees 10 to 14,000 crores for this one. BEML and Bharat Forge are the likely beneficiaries for this. They've also cleared acquisition proposals for moored mines, electronic warfare systems, integrated common inventory management systems, as well as super rapid gun mounts. And the other beneficiaries include BHEL, Data Patterns, Apollo Micro and BEML as well. So on the back of this, all of these defense names have been trading higher in today's session. In fact, even the Nifty defense index is trading up around 1.2% today.
All right, so those stocks are in focus. Thank you, Ria, for joining us with those updates. A sharp fall is what we are seeing in the broader markets, though. Hormuz, of course, did indicate that. But look at the mid-cap index. It's down around 260 points as we speak. This further fall that we are seeing, it's a sharp fall from the highs of the day. If you look at the Nifty as well, it's down 70. The Bank Nifty is the one which is putting some pressure right now. And in terms of stocks, if we look at which are the ones which are at the day's low, something like an Ultratech Cement, we have Adani Ports, there's Aisha Motors, Adani Enterprises, NTPC. Pretty much anything you name is seeing that cut. Of course, you spoke about it as well. But I think that it's just continuing from those levels as well. Let's get more stock specific now. Marico and Trent are in focus. Mangalam is joining us to tell us what's the update here.
Well, from let's start with Trent. That's the big gainer, loser on the Nifty today, down almost 9%. And that's on the back of their first quarter update that has come in, where the company said that they've grown at 20% in the first quarter of FY26. And that's not all. In fact, if you look at the absolute number as well, at around 5,061 crores. This is a lot lower than their 5-year CAGR of 35%, and a lot lower than what the company had spoken about as well, which is a sustainable CAGR of 25%, on the back of which brokerages have pared their estimates. Nuvama, for one, has cut their FY26 revenue estimate by about 6% and their EBITDA estimate by close to around 9%. FY27 EBITDA estimates too have been trimmed by 12%. As a result of which, they've downgraded the stock to hold, and they've cut their target price from a little over 6,600 rupees to around 5,800 rupees itself, and that explains the big gash that we've seen on Trent. The other one that we're looking at, Marico, holding mildly in the green today. A good first quarter update coming in, where they say that rural demand is good, urban steady as well, And at the same time, they have seen multi-quarter high volume growth in India this time around. It's been led by the value-added portfolio. Value-added hair oil portfolio had been struggling for the last 8 quarters, and that recovering to low double digits is something that the street definitely likes. Importantly, even the international business continues to do well. All of this aided with some price growth means that the revenue of the company in the first quarter has grown on a consolidated basis in low 20s, which is a good number given the sector's anemic growth that we've seen in the last few quarters. The only reason why the stock gain is contained right now is because gross margins are under incremental pressure. They are expecting to ease in the second half, and as a result of which, despite a 20% plus growth in the revenue, the operating profit will only see a modest year-on-year growth, telling you that there is some margin compression. But no real worries given this, because commodities are likely to ease in the second half of this year, and in light of that, they are growing extremely well. That is, the stock is taking heart from that.
Taking some heart from that, yes. And just as you spoke of Trent, it's now down in a 10% circuit at the lowest point of the day. The top loser on the index today is Trent, a 10% lower circuit now coming in for the stock. We'll take a short break. On the other side, what's buzzing in the commodity space? Manisha joins in with an update. Stay tuned.
Welcome back. You're still tuned into Trading Hour. We have been talking about that big fall in the stock markets. It's time to talk about the commodity space as well. Manisha is joining us now, and today we are focusing on crude. Manisha, over to you.
Well, yes, I'm looking at the gold prices, which lost 1% overnight, but even with that, are trading in the positive in the markets right now and headed for a second weekly gain, up by nearly 2% for the week right now. Well, it is about the U.S. tax cuts and spending package headed for the White House for signing. It has passed Senate and Congress, so that is what the gold seems to be taking in, because with this bill now, there is an expected deficit increase of around $3.4 trillion. The second thing is about the U.S. tariff letters, which the U.S. president keeps talking about, that will be sent to various countries with tariffs anywhere between 10 and 20 and 50%. Remember, 9th of July is a deadline for tariffs agreements to happen between U.S. and various other countries. And we do understand that many countries still are working towards it. So if there are higher tariffs, that means some safe haven buying coming back in case of gold. The third point really is about the dollar index itself, which is also headed for a second weekly decline, in turn supporting the dollar-denominated gold. The reason that you're looking at some cap in case of gold prices, that is because the U.S. payroll data came in higher than what the street was anticipating, at a number of around 147,000 jobs for the month of June. The estimate was for 110,000, and for the month of May we saw a number of 144,000. So the number is quite better than previous month and from an estimate as well. The other thing really is about the markets now looking at some profit taking, because we continue to see resistance at $3,400 an ounce. So every time you see gold prices going there, there is some profit taking, and that is what is leading to the gold prices trading within that range of $3,250 to $3,400 on the higher side.
Manisha, thanks a lot for that. We'll keep an eye out on the gold prices as well. We'll take your leave on this edition of Trading Hour. We leave you with the Nifty at the lowest point of the day. Extreme volatility seen in the markets currently. Trent being at the lowest point of the day as well. 25,337 is where the index is. 70 points lower now as we speak. So a 10% circuit on Trent. Halftime report takes the action forward on the other side. Stay tuned.
The market slips to the day's low, with Trump expected to start sending out tariff letters to partner nations from Friday. An interim India-US trade deal is also in the final works. Realty and healthcare notch some gains, while auto drags mid-caps fall more.
SEBI has issued an interim order barring Jane Street Group from the Indian equities market and impounding gains of over 4,800 crore from index manipulation. SEBI continues to investigate the matter.
Bajaj Finance posts a strong Q1 amid a bunch of mixed lender business updates, with AUM growing 25% on the back of a 21% increase in customers. Even arm Bajaj Housing Finance puts up a good show.
Trend slumps after the company trims its growth guidance to 20% from the 25% indicated earlier. This comes after the retailer clocked a heady growth of 35% per annum over the past 5 years.
Reliance Industries has moved NCLT to hive off its consumer products business from Reliance Retail and Reliance Consumer to a new entity. Reliance points to the need for specialized, focused attention and large capital investments to back its move.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Ekta Batra. We come to you live from the CNBC-TV18 Motilal Oswal studio. And a big cut is what we're seeing on our indices. Yesterday, the last hour of trade, we saw a big cut. This morning, it was relatively stable until 25 minutes ago, where the Nifty fell below the 25,400 mark and now is at the lowest point of today's trading range. It's actually been taken lower by a bunch of sectors, be it the Nifty bank, or you look at all the other sectors have seen a big gash, most of that coming by in just the last 20 minutes. The mid-caps have had it worse. In fact, up until the time the market was stable, the mid-caps were outperforming. But now we have the mid and small cap indices as well, which have taken a big knockdown. 280 points lower for the mid-cap index. The small cap index comes up for you as well, telling you there are way more stocks which are now declining than the number of stocks which were advancing. So the green and red lines also come up for you on the screen. Ekta, not looking like a very good Friday so far. Up until now, it was great, but just the intersection of those lines.
Yes, absolutely, Mangalam. Well, it's turning out to be a little bit of a disappointing Friday or the end to the week. Let's see, because maybe the weekend could be action-packed when it comes to the US-India trade deal and what we could probably expect in terms of news flow. And that's maybe why the street is going into it a little cautious at this point in time, though we don't know when the details will be out. So we have the mid-cap index, which is down around 0.4%, like we mentioned. And on a week-to-date basis as well, it was rather resilient, you'd have to say, for the mid-caps. But now it's given up most of its gains and is just about holding its head with a little bit of an uptake at this point in time. The Nifty 50, however, on a week-to-date basis at current reckoning, is probably going to go home with a cut of around 1% or maybe at this point in time. But that's what's taking place in the markets. But let's now talk about a few capital market players. Namely, BSE, Novama, Angel One are trading lower after market regulator SEBI has barred the US trading firm Jane Street Group from accessing the local securities market. Hormuz is here with more on this story.
It's a crazy Friday indeed, with this SEBI order that came out on Jane Street, and the market regulator has now banned this US listed trading firm from the group and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street has made unlawful gains to the tune of 4,843 crore rupees through trades between August of 2023 and May of 2025. Now, this entire amount will now be impounded, the largest in India's capital market history. Now, SEBI has ordered that this impounded sum will have to be deposited in an escrow account, which can be opened in any scheduled commercial bank, and that no debit will be made without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions until the expiry of the contract, or if they choose to close these existing positions further, whichever whatever happens earlier. Now, this matter goes back to July of last year when SEBI had asked the National Stock Exchange or NSE to examine the trading activity of Jane Street to ascertain any market abuse. Now, the report for this was submitted by the exchange in November of last year, and a month later, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in FNO terminology is liquid instruments that are easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was engaged in activities which were in violation of SEBI's PFUTP or Prevention of Fraudulent and Unfair Trading Practices regulations. And as a result, SEBI had asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. Now, however, the regulator found out in May that Jane Street was in complete disregard of the letter of caution that was sent to them and is still running large cash equivalent positions, which was not only a violation of SEBI's regulations but also to the undertaking that Jane Street had given SEBI in response to the letter of caution. And it is this what led to the issue of the order last evening. That's not all. Last year, SEBI had put out a study saying that 9 out of every 10 retail traders lose money in the FNO space. But how much did Jane Street make? Not one, not two, but over 36,500 crore rupees of profit between January of 2023 and March of 2025. But who is Jane Street? A global proprietary trading firm, over 2,600 employees across the US, Europe and Asia, using algorithms to identify trading opportunities in the market, trading over 45 countries as well. But does this order bring us to the end of this issue? Well, not yet, because Jane Street has contested the findings of this SEBI interim order and will be reaching out to the regulator regarding this. So it's only part one that has come to an end. We'll await to see more on this as the events unfold.
We will most definitely keep an eye out on this as the events unfold. But before we move on, we've gotten from SEBI, which has told CNBC-TV18 that Jane Street was by far the largest position in the Nifty bank options market, and fear of manipulation from other similar players may not be that much. In fact, no more similar investigation orders like Jane Street are expected, but they remain on the lookout for newer risks, as the SEBI always does, if any emerge. So they're basically isolating this case only to Jane Street, and that too to the largest positions that they had in the Nifty bank. In fact, we also spoke with Shailesh Haribhakti, who was the chairman of Shailesh Haribhakti Associates, about this unlawful gains. He believes that there will be a full investigation on the group and practices will be looked at. Listen in.
What this order says is that they will have to deposit 4,843 crores with SEBI, which is approximately 10% of the purported gains that they have made in the markets. And they've been asked to not access the capital markets anymore until the full investigation has been done. I think this is an appropriate way in which a regulator like SEBI must make sure that the integrity of the markets is protected. And while we understand the whole idea of why there should be index options and futures and option trading and all of that, I think it has to be done under constraint. Full investigation will be done. Practices will be looked at. There is layering, which is very clear. Multiple entities acting in concert, which is clear. There is also a very significant amount of at expiry manipulation that seems to have occurred.
Okay, and in fact, let's listen into what market expert Prakash Diwan and Complete Circle's Gurmeet Chadda had to say over this matter as well.
This will cleanse the system. They will cleanse the system, make sure that capital destruction that was happening rampantly for small investors stops, which is good, but it will impact some of the capital market infra plays, right? We've seen how in the last 18 months they've done so well, whether it's exchanges, brokerages, a lot of those elements. So there will be an impact on that, but I don't think the overall market gets bullied by this. It'll probably be much healthier, and the regulator has made it very clear that they will not be sitting down just because somebody is kind of out there with much more money to be traded into these options.
quite a landmark order, and I think by the sheer size, I think probably I don't recall anything like this. And if you see the order, it clearly mentions, obviously it mentions Bank Nifty incident, where on 17th of Jan, the HDFC Bank is the market reacted. Bank Nifty opened down post the update from the bank. I think the key word here is manipulation and being unfair in terms of prices. And I think to me it's just the right order. I'm sure there will be legal recourse done, and it will be a long drawn battle.
It indeed will be a long-drawn battle, but just keep an eye out on the IT space. Even as the frontline index is lower, it's the IT index which is supporting the frontline index. So Infosys has moved higher. The Nifty IT index is one of them, which is actually outperforming in an otherwise very weak market. Three reasons for that. One, the global market outlook looks a lot better given the jobs data that came in from the US yesterday. Also, Trump's big spending bill has been passed, which implies that maybe some of the beneficiaries of that would spend a little more on IT and the resources. And then the third part is the fact that we have IT results coming in next week. So we'll watch out for this index and a lot of these stocks. With that, let's tell you about the CNBC-TV18 Prime, all new CNBC-TV18 Prime, no less. It brings you insights from policymakers, business leaders, economists shaping the world and India's future. CNBC-TV18 Prime decodes global shifts and their impacts on Indian businesses, gives you unparalleled insights. You can tune into CNBC-TV18 Prime at 12 noon every day for the Global Reset, at 1 p.m. for the big commodities, and Global Lens at 8:30 p.m. on weeknights.
Welcome back. Well, a tad bit of a recovery for the markets, you'd have to say. So the mid-cap index is currently just about lower by around 0.3%. But overall, the texture of the market is on the weaker side. The advanced decline ratio just about even keel. So maybe the graph will show up for you, and we'll see how exactly that is trending. That'll give you a sense in terms of the day. Seems as though there's a little bit of improvement which has taken place. So let's see whether that's sustainable and whether there is any further improvement or not. But let's talk about stocks then. IGL, MGL gain in trade after the PNGRB amended unified tariff zones, and the number of unified tariff zones has been reduced from 3 to 2. Sonal is here with more details on this. Sonal.
Thank you so much for that. Well, there is the new release which has come by from the PNGRB. This talks about the unified tariffs. This is something which was expected as well. However, still important to understand that the final tariff number has not been released, where GAIL had asked for a 33% increase. This one says that they've reduced the number of unified tariff zones from 3 to 2. So 2 zones will have 2 different tariffs, and there will not be more than 2 tariffs that the PNGRB will come out with. The benefit of the unified zonal tariff of Zone 1, once it is actually, given out in terms of the region, that will be extended to all the CNG and PNG segments. So basically, all the gas which is given to CGDs, which will have only one tariff, that will mean that there will not be a lot of volatility in terms of pricing for the end consumer, because there are different geographies for different city gas distribution companies as well. They also say that PNGRB has introduced a dedicated pipeline development reserve. Additionally, they've asked or mandated pipeline operators, the biggest one of course is GAIL, to procure minimum 75% of annual system usage gas via long-term contracts. They already tried to do that, but now it has been mandated that 75% of sourcing will be via long-term contracts to avoid any volatility for the consumers, because if the gas prices go up for GAIL, it might be higher in terms of CNG procurement as well, and that's why they've gone ahead and said to avoid any volatility for the consumers, such regulations have been put out. However, important to note, the final tariff number, that is still important, and that is something that the street will be watching out for.
All right, the final tariff number is still awaited, but on the back of the update so far, we are seeing some bidding in the prices of city gas distribution companies as well as the oil and gas companies too. Defense stocks, they are buzzing as well. The government has cleared proposals worth nearly 1 lakh crore rupees. What does that mean for the listed players and who stand to benefit? Ria joins in. Ria.
Well, yes, Mangalam, yesterday, as you said, the DAC has approved 10 capital acquisition proposals worth over rupees 1 lakh crores. So let's take a look at the large project and some of the likely beneficiaries of the same. The first one is the QRSAM project. The estimated value for this one is about rupees 30,000 crores, and Bharat Electronics is expected to be the lead integrator for this one. Of this order, 40% is expected to go to Bharat Dynamics for the production of missiles, which comes out to about rupees 12 to 13,000 crores. 2 other companies, Apollo Microsystems and Astra Micro as well, are also expected to get smaller orders for the manufacturing of components and subsystems for this one. Moving on to MCMVs, which are the mine countermeasure vehicles. The estimated cost for this one is about rupees 44,000 crores, and all 3 shipyards, which are Cochin Shipyard, Mazgon Dock and Garden Reach Shipbuilders, are expected to bid for this tender, and the order may likely be split between the 2 lowest bidders. Some other projects that have been cleared, the armored recovery vehicle with an estimated value of about rupees 10 to 14,000 crores. BEML and Bharat Forge are the expected beneficiaries from this one. They've also cleared proposals for mode mines, electronic warfare systems, integrated common inventory management systems, as well as super rapid gun mounts. So of these, BHEL, BEL, Data Patterns, Astra Micro, as well as Bharat Forge are the expected beneficiaries from these. So all of these defense names have been buzzing in trade today, and the Nifty defense index is also up over 1%.
Okay, yes, absolutely. Just look at the way Paras defenses move now, 85% higher for the year. So that's the kind of move that you've seen for these kind of stocks. But any which way, we'll take a short break. Sudeep Shah of SBI Securities will join in with some trading calls. Stay tuned.
Well, there is consolidation and grind lower, which is currently underway for the Nifty. It's down almost 50 points, though it's recovered a tad from the lows of today. The IT index is outperforming. The Nifty bank is lower for the last couple of trading sessions. The broader indices, which were outperforming earlier, have now taken a turn for the worse. So both the mid and the small cap indices are lower right now, with the advance decline firmly favoring declines as against advances just about 20 minutes ago. The only couple of stocks which are doing well belong to the oil and gas space. We've spoken about IT already, and defense, which Ria has been talking about through the course of the day as well. We have Mahanagar Gas, IGL, both of them coming up for you on the screen. So with the market moving lower, what is it that we're looking at? The 25,400 put writers, which have been active for a premium of 150 rupees, hope for a support coming in for the Nifty around 25,250. And on the way up, call writers have begun to, write calls aggressively at 25,400 and 25,500, telling you that the support for the market has moved lower, as has the supply. So the ceiling of the market has come down from 25,600 to around 25,550 to 25,600 itself. A lot of stocks on the downside today, seeing a lot of short positions being added. Capital market plays in particular, Angel One, BSC, we're watching out for weakness out there. Trend down 10% for a Nifty stock, seeing a lot of short positions being added too. Let's welcome Sudeep Shah of SBI Securities for a quick check on the market. Sudeep, we've been consolidating and grinding lower. Where do you think we go from here on the Philanthropy index, and what would your individual stock calls be?
Good afternoon. For the last 4 or 5 days, we have seen a consolidation or some kind of a grinding from higher levels. But despite that, there has not been any major cut. So what I feel is it's post that earlier move from 24,800 till 25,600. This consolidation is kind of normal, and we feel that 25,100, 25,200 zone will act as an important support. So another couple of 100 points from here, 25,100 could be a base new zone as a support. And till this holds, there could be a range-bound move between 25,100 and 25,700. We still feel that sectors like banking and financials, minus the capital market plays, could once again take the lead post this consolidation. And selective mid-caps could do well. So overall, from a Nifty standpoint, 25,100 will act as an important support. And from a Bank Nifty standpoint, 56,100, 56,200 zone could act as a strong support on the downside.
Okay, well, you mentioned select mid-caps. Sudeep, tell us what you're picking in terms of stocks.
A couple of them. One is from the private banking, mid-cap private banking, CSB Bank. So here what we have seen is the stock has been doing fairly well in the last several weeks. CSB has been consistently outperforming the Bank Nifty, and all these mid-sized banks have seen a decent move in the last several weeks. So here we feel that the stock could move up to 430, 440 on the upside in the coming few weeks, and this can be bought with a stop loss at 390 on the downside. The second stock that is there on our radar is Engineers India Limited. Now, this stock has given a decent breakout in the last few sessions, and now we are feeling that the stock is ready for the next leg of the up move. Trading above all its technical indicators, the medium to long-term structure also has improved considerably. So we feel from here on, this can be bought with a stop loss at 235, and the potential targets on the upside looks to be in the range of 265 to 275 in the coming few weeks.
Okay, all right, Sudeep, we're going to let it go on that note. Thanks very much for joining in and taking us through all of those strategies. Well, that's Sudeep Shah of SBI Securities talking about the market. Well, as of now, we have the mid-cap, which is absolutely static from the last time we checked, so down around 0.3%. Bank Nifty down around 0.2% at this point in time. We'll take a short break, but on the other side, Manisha Gupta will join us on the commodity segment. She has with her Sandeep Bajoria of Sunwin Group. Stay tuned. Welcome back. Well, for the markets, like we've been pointing out, it's just quiet at this point. So we have the advanced decline ratio, which is just about 1:1, completely even keel. A couple of stocks which are moving is obviously a couple of these financials. So Bajaj Finance is up around 1.5%, but a few of the auto stocks are not doing too badly. So Bajaj Auto is up around 0.6% and Hero Moto is up around 1% as well. But let's talk about the commodity space and what's taking place there. Manisha joins in to tell us more. Manisha.
Well, thank you so much for that, Ekta. And joining us on the show also is Sandeep Bajoria from Sunwin Group. Mr. Bajoria, hi, thank you for joining in. And we were reading the latest reports which do tell us that for the month of June, the palm oil imports into the country are nearly 60% higher on a month-on-month basis. How would you look at the overall number? And is it because it's at a discounted rate? Also, as we start into July, move on to August, it's the festival season as well, which is waiting.
Yes, Manisha, you're absolutely right. I'll just give you a background. In January, February, March, April, all the 4 months we imported overall only 9 lakh tons of all the oils put together, 9 lakh tons per month. And out of that 9 lakh, the palm was between 3.5 to 4 lakh tons. So Jan to April, 9 lakh tons overall, all the oils put together, and palm was only 3.5 to 4 lakhs. May, we got total 12.5 lakh tons, and June, we got 14.5 lakh tons imports. And in May, the palm imports were something around 7 lakh tons, and June, the imports are about 8.5 lakh tons. So palm has increased from 3.5 lakh tons to 8.5 lakh tons. Overall import has increased from 9 lakh tons to 14.5 lakh tons in June. These are the main factor is palm oil became very cheap because the season in the palm oil started in Malaysia and Indonesia from June onwards. And that's the reason, May, June onwards. That's the reason more supply was available. And the palm, which was costliest oil in January, February, March, which was trading higher than sunflower oil and soybean oil, it came down drastically. And today, I can tell you, the crude palm oil is quoted in India at $1,055 per metric ton for July shipment. Soybean oil is $1,170. Sunflower oil is $1,190. So palm is cheaper by $100 to soybean oil and $140 to sunflower oil. That's why the palm imports have increased. And coming months also, in July, August, September, October, all these 4 coming months, which is main festival season, where we require more edible oil, because domestic oils are now getting exhausted and low stocks are there. Your rapeseed oil is also very high right now in India. Groundnut oil, palm oil, all these 3 domestic oils are at higher level. Imported oil are much cheaper. So imports will increase, and palm oil import in July, August, September, October will be also something around 8.5 lakh tons per month. And overall import per month, I believe 14.5 lakhs to 15.5 lakh tons per month will come. So we are matching the need, we are matching the requirement. Supply is matching the need in India, or matching the need of the festival season also. So I think overall we are quite balanced. Neither we are importing less nor we are importing more. This is the right way we are managing our supply chain as a nation.
Sure. Mr. Bajoria, also, what's your sense on the per capita consumption now? Because a lot of conversation has been around that as well. In 2010-11, it was 8 to 9 kgs per person. Now it's at 23 to 24, and conversations about lowering it.
Yes, Manisha, you are absolutely right. Per capita consumption, if you say, you rightly said, about 15 years back. So India, if you see the Indian economy, which was at that time roughly about 1.5 trillion, 1 trillion, 1.5 trillion. Now it has become 4 trillion economy. So same way the per capita consumption was 8 kgs, 9 kgs has become 18.5 kgs per person per year. On a population of 1.46 billion, what we require is 265 lakh tons of vegetable oil per year in the country at 18 kgs per person per year. And out of 265 lakh tons, which is demand, our domestic production is maximizing only at 100 lakh tons. And 165 lakh tons we have to import. And in 165 lakh tons, Manisha ji, India is a pretty price sensitive country. So whichever oil prices are competitive, prices are lower, we see the higher import of that oil. So palm oil, when the prices were higher, the palm oil import annual was only 75 lakh tons. Now when the prices are lower, palm oil import on an annual basis can go up to 90 lakh tons. Soybean oil import is hovering around 34 lakh tons to 44 lakh tons, depending on the price. and sunflower import is between 30 lakh tons to 35 lakh tons. So this is how our composition is, which is there of 3 oils. These are the major 3 oils which India is importing. And very happy that in the world we have this kind of availability from where we can get soybean oil from Argentina, Brazil, and sunflower oil from Russia, Ukraine, Argentina, Romania, Bulgaria, palm oil from Indonesia, Malaysia, Thailand, Papua New Guinea. These are our main trading partners from, they have surpluses from which we are getting these oils. Although recently US has increased the biodiesel mandate very big way. Brazil has increased B14 to B15, the 15% biodiesel mixture into diesel. So that is absorbing more soybean oil in their own system. But still Argentina is our friend. Argentina has great, whatever surplus Argentina has of soybean oil, India buys 50% of that surplus.
Sure.
So our main trading partner in soybean oil is Argentina.
Argentina as of now.
Okay, all right. The key word being trading partners. That's the buzzword. But thanks very much, Manisha, for joining in and taking us through that conversation. We need to take a short break, but up next, we'll get chatting with the management of Moltech Packaging on demand trends. Stay tuned. Welcome back. Let's get you an exclusive conversation. Deutsche Bank CEO Christian Sewing tells Shireen Bhan that India is always on top of the list for them, and German companies are very excited about opportunities in India. Listen into excerpts of that conversation.
Let's talk about why you're here in India and how India is playing itself out in this era of volatility. You've just met with India's Commerce Minister Piyush Goyal. What's the read on India at this point in time?
Well, first of all, thank you very much for having me. It's a pleasure being here. It's a pleasure being in this country. To be honest, it is. That meeting was very positive, but the overall spirit in this country is outright positive. I've been here now for 3 days, and I have to say I'm amazed by the steam, by the drive, by the passion, and you know, it's an economy which is obviously outright growing. It's actually with whomever you talk, the story is growth. And it is also coming, obviously, from Germany, being one of the leading European banks, looking at our clients. Our clients are actually looking to India out of the lens of this is an opportunity. A lot of global clients, a lot of multinationals, but also family-owned companies are in the process of reorganizing their supply chains, their production chains, and India is always top on the list. And that is, from a Deutsche Bank point of view, a huge opportunity for us. We have been here for 45 years. We have 23,000 people. We are growing immensely. We just put $800 million of capital into India. So we want to grow and our clients want to grow. So it's a very positive story. So I'm excited.
Well, you know, let me build on that excitement that you just gave us a snapshot into. When you talk to your clients and you say that they're looking at opportunities in India, what are the opportunities specifically that they've been able to identify and that they want to zero in on?
The nice thing is it varies. Look, first of all, it's a market with 1.4 billion people. Number two, it's a market with such young demographic. You can see in which direction it goes. So simply from a market's point of view, it's an opportunity, in particular for a lot of European and German export-oriented companies. And there is lots to grow in this regard. Number two, the skill set which India is offering for all kind of industries is superior to a lot of other countries. And let me argue it from a financial point of view, financial services point of view. You know, we have overall 90,000 people in Deutsche Bank, 23,000 are in India. Now, approximately 19,000 people are actually in our innovation, risk management, finance, operations teams. They are, so to say, the backbone of Deutsche Bank as a group. And the technology, innovation, and skills we get are core for the overall bank, and therefore a lot of other corporates are also looking at India not only as a huge market, but also as a source of innovation, technology, and hence it's actually your strength that it's very much broad-based, and therefore I'm very positive on the development.
All right, that's an interesting conversation with the leadership of Deutsche Bank. All the frontline indices marginally in the red right now. The mid-cap index a little more. With that, we'll take a short break. But as we do that, some good news for all your viewers. India's business news leader, which is CNBC-TV18, now just a click away, which is on the CNBC-TV18 all-new app, which gives you instant access to breaking news, in-depth articles, all the financial world updates at your fingertips. All you got to do is download the CNBC-TV18 app from either the Apple Store or the Google Play Store, or just scan this QR code, which is there for you on the screen. Welcome back. Let's welcome the corporate on our show. We have Moltech Packaging joining in. Remember, the company supplies packaging to a lot of the paint companies, and increasingly the growth drivers for the company are increased share of revenue coming in from both FMCG and pharma X of paints. Well, we do have Mr. J. Lakshmana Rao, the CMD of the company, joining in. Thanks a lot, Mr. Rao. Always a pleasure speaking with you. I just wanted to understand from you how demand for paints has been because of your supply to the paint companies. You've been looking at growth coming in from the Aditya Birla Group, and recently we saw this big deal between JSW Paints and AkzoNobel as well. How does that change things for you?
Yeah, coming to Aditya Birla Group, there has been a substantial increase in their volumes, basically because last year was their first year of operations. And we were also setting up facilities and expanding them during the last year itself. The first expansion took place in the last quarter of the last year itself. So partial utilization of that capacity also has started. So we see a considerable jump in business from ABG that's expected. Coming to JSW deal, we have been supplying to AkzoNobel for more than 2 decades now. They have a plant in Balanagar, which is on the way to our factory. So our relation with them is very long holding. And also our team works closely with them on a day-to-day basis just to make JIT supplies. So this may give us an opportunity to enter JSW also. That's what optimistically I look forward to.
So just to give us some numbers, I remember you had said that, ABG Group, your capacity for them is close to 5,000 tons. Have you achieved full capacity? And secondly, how much does AkzoNobel currently account for in your sales? And with JSW coming in, how much more can your sales increase from here?
See, currently ABG is occupying around about 500 to 600 tons of sale per month, which is reasonably good because we have almost set up 1,800 to 900 tons capacity, of which 600 being utilized is a good utilization for us. Going forward, it may further improve. Coming to JSW, at this stage, I can't comment, but definitely our association with AkzoNobel should enable us to enter with JSW for their paint supplies, especially in IML category.
Okay. All right, let's move on from the paint sector then, sir. The entire pharma segment has done very well for you. It broke even on an EBITDA level, at least in the previous quarter. Tell us what is resulting in this growth besides the fact that it's a low base?
Yeah, the numbers are increasing rapidly because we are adding on new clients. Several clients are testing our products for mission suitability, stability of their products. And one by one, they're clearing those products. In fact, from Q4 to Q1 of this year, we added another 3-4 clients who are either releasing commercial orders or testing our products online. And we also have another 3-4 clients willing to start testing our products in an experimental way. Once those also happen, cumulatively, we'll progressively increase our numbers. That is what we are seeing in Q1, and hopefully the trend will continue in the full financial year.
So what are you projecting in terms of sales? Are you projecting, say, around 30 crores of sales in FY26 and possibly building on that to 50 crores in FY27?
Yes, I think during the last press note and last discussion, I mentioned 30 to 35 crores as a target for this financial year in pharma, and probably 50 to 60 crores is possible next financial year.
And what about, the other FMCG pack? Because I remember you said that you were looking to supply to other companies as well in the food space. Where has that reached? What are the kind of approvals that you've gotten? And what's your projection from this sector?
Yeah, last time I mentioned Nestle and Mankind, and Marico also added, and those 3 new products have been already started supplying in the Q1, and their numbers are reasonably good, and hopefully it will ramp up once the packaging comes in IML. There will be definitely a better traction for the products. That is what my past experience. So going forward, those numbers will be adding as I expected. There will be a good growth in thin wall, that is our food products as well in the current financial year. Because Bharat also will going into thin wall products production from end of July. and that should add numbers in the northern region. So overall, we are hoping we'll be in a good mid, double-digit growth, back to double-digit growth in Involve.
Double-digit growth in thin wall. So from this near 800 crore revenue last year and 18% margins, what is your aspiration for FY26 with more capacities coming in and FY27 overall?
Yeah, last time also I mentioned we are aiming at 12 to 15% volume growth and sales growth. We generally look at things in quantity terms, in tonnage. Tonnage terms, we will be growing around 12 to 15% definitely. And going forward for the next year also, I have a feeling that we should be able to achieve similar growth. But given the pharma's traction and also given the new plant coming up at Panipat for thin wall and all the ABG plants ramping up their capacity utilization, things will only be better for us in the coming couple of years.
And margins?
Margins should improve because once the better utilization comes in, your fixed cost per kg will come down and your utilization improves, your labor efficiency, mission efficiency catches up, and margins also should inch up year on year.
Okay, when you say inch up year on year, what are you projecting?
Today, I don't know whether we can talk in this window period, but certainly from 37, 38 last year, we will be definitely seeing it in 40s.
Okay. Tell us a little bit about your expansion plans, considering that you're seeing such strong growth coming into segments such as the pharmaceutical space.
Yes, we already started the phase 1 of expansion in pharma. Already new machinery has been ordered. Some molds have already arrived. 2 new products are being launched in this month. Already commercial orders have been received from 2 well-known pharma companies, and those supplies might start in July or August. So like this, every year, every quarter, we anticipate a couple of client addition, which will keep ramping up the numbers in pharma. In anticipation of that, we have acquired a land very nearby to the existing plant, just walking distance, about 2.5 acres of land from the government of Telangana. And that land will be purely utilized for further expansion. We have plans to grow in ophthalmic containers for ophthalmic use, nasal and ophthalmic bottles. We are coming out with a very novel designs which will be able to attract the market attention, client attention. So those product plant will be set up in that new plant. Or if it's in a hurry, we may start in the existing land itself where we have enough space for the time being. But keeping in mind,
companies looking at?
We are adding the extra land.
Okay. If you could just break up, where exactly do you think that the maximum growth will come for you going forward? You've spoken about specific segments. You've spoken about how you can acquire new clients in the paint segment as well. But if you had to put your money down into, the best performing sectors for you and your key focus going forward in terms of, say, revenue and margins, what would it be and why?
Definitely in pharmaceutical packaging and in food and FMCG, that's where we wish to invest more and more as we progress. Whatever we did in the paint industry for ABG, it's substantial during the last 2-3 years, and that should be suffice to take care of our future needs of paint supplies. However, whatever additions are required in the brownfield projects, that won't be substantial. So those additions will be kept on done as per the client demands. So while the plants for Asian Paints and ABG are dedicated, there are also other products we are now manufacturing in those plants to ensure better utilization in seasons where paint may not be having full demand.
Right. Are companies looking at other solutions than what you have to offer when it comes to packaging? Because everyone's talking about ESG and, reducing the amount of plastic, poly, which is used in overall packaging. Are you looking at alternatives here as well, or are you offering some of them?
Yes, actually, I mentioned in our previous press note also in the discussion that recycled plastic utilization is becoming mandatory. Almost 30% of the plastic that is being produced should use 30% RCP, recycled polymer. So we are now not only sourcing, but also creating with a vendor here a unit to produce RCP as per our recipe, which will be enable us not to increase the rejections, at the same time able to use the RCP as per the statutory norms. And I'm sure given our technical knowledge and our contacts abroad, we'll be able to bring that RCP production also to the requirements of the industry and stay ahead of other players who may be depending on outside sources which are not reliable, because one lot of RCP can be having a very good characters which will be similar to virgin material, but the next lot can have really bad composition, which can lead to a lot of rejections. So keeping that in mind, we are enhancing, we are supporting a RCP plant here in Hyderabad, which will enable us to control the quality and ensure that whatever RCP we use is of best quality and consistency.
Okay, all right. So we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Moltech Packaging sounding quite positive in terms of growth within the FMCG as well as the pharma segment going forward. We need to wrap up on the show with the news that the mid-caps are now back under pressure and the advanced decline ratio, however, still holding at 1:1. So let's see how that progresses. The Nifty just about lower by around 45 odd points. We'll take a short, or rather we'll wrap up on halftime report. Business Lunch up next.
The market slips to the lowest point of the day with Donald Trump expected to start sending out tariff letters to partner nations from Friday. An interim India-US trade deal is also in the final works. Realty and healthcare notched some gains while auto stocks drag. Mid-caps are the bigger losers. SEBI has issued an interim order barring Jane Street Group from the Indian equities market and impounding gains of over 4,800 crore rupees from index manipulation. SEBI continues to investigate the matter. It's a strong first quarter update from Bajaj Finance amidst a bunch of mixed updates from lenders. Assets under management grew 25% on the back of a 21% jump in customers. Even its arm, Bajaj Housing Finance, puts up a good show. The big loser of the day is Trent, and this is after the company has trimmed its growth guidance to 20% from 25% indicated earlier. Now, this comes after the retailer clocked heady growth of 35% per annum over the last 5 years. And Donald Trump's tax cut package clears its final hurdle in the US Congress as the Republican-controlled House of Representatives narrowly approved the massive bill and have now sent it to the president to be signed into law. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios in what has been an absolutely action-packed Friday. I am Hormuz Fatakia. The markets too are showing that sign of volatility, having slipped below that 25,400 mark just a few minutes earlier, and since then have hovered around the lows of the day. The Nifty currently 50 points lower. It has been the Nifty Bank that has been the principal culprit and to drag the Nifty lower. It's 100 points down. At the earlier part of the day, the index was up 80 points, so it's a 200-point fall from the lows of the day. The broader markets are not faring any better. In fact, they are seeing steeper cuts in comparison to what the benchmark indices are seeing. The Midcap index down 0.5%, but is down 300 points, and that's a 500-point correction from the highs of the day. The small cap index too has seen a correction of well over 100 points from the day's high. And the capital market names are the ones that continue to remain under pressure. Nuvama Wealth is now down 9.5%. Among the top losers on the Nifty 500, BSC down 6.5%. Angel One is down 6%. Angel One, of course, is also reacting to its business update that it shared earlier in the day. And CDSL was fairly resilient in the early part of the trading session, but is now seeing some selling pressure, 3.5% lower on CDSL as well. But the big news of the day was the SEBI order on Jane Street, and the market regulator has now banned Jane Street and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street made unlawful gains to the tune of 4,843 crore rupees through trades done between August of 2023 and May of 2025. Now, this entire amount will be impounded, the largest in India's capital market history. Now, SEBI has ordered that this impounded sum will have to be deposited into an escrow account, which can be opened in any scheduled commercial bank, and that no debit will be made from this account without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions, or until the expiry of such positions, whichever happens earlier. Now, this matter goes back to July of last year, when SEBI had asked the National Stock Exchange, or NSE, to examine the trading activity of Jane Street to ascertain whether there is any market abuse. The report for this was submitted in November of last year, and a month later, in December, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in F&O terminology is liquid instruments that are easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was indeed engaged in activities which were in violation of the regulator's PFUTP, or the Prevention of Fraudulent and Unfair Trade Practices regulations. And as a result, SEBI has asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. However, the regulator found in May that Jane Street was in complete disregard of this caution letter and was still running large cash equivalent positions, which was not only a violation of SEBI's regulations but also of their own undertaking that they had given to the regulator. And it is this what led to the issue of the order last evening. And that's not all. Last year, SEBI had put out a study stating that 9 out of every 10 retail traders lose money in the F&O space. And how much did Jane Street earn? Well, not one, not two, but over 36,500 crore rupees between January 2023 and March 2025. What is Jane Street? Well, it's a global proprietary trading firm Over 2,600 employees across the US, Europe and Asia, uses algorithms to identify trading opportunities in the market, is operating in over 45 countries. But does this order bring us to the end of this issue? Well, not yet. But that is because Jane Street has contested the findings of the SEBI interim order, and they said that they will be reaching out to the regulator in this regard. So it is only part one that has come to an end so far, and we'll see as more events unfold as to what happens next in this issue. Now, in an additional update, SEBI has told CNBC-TV18 that Jane Street by far was the largest position holder in the Bank Nifty options market, and the fear of manipulation from other similar players may not be that much. Now, they also added that no more similar investigations or orders like Jane Street are expected, but they remain on the lookout for newer risks, if any, emerge. On to the other big story then. Reliance has moved the National Company Law Tribunal for internal restructuring to house the FMCG business under a new arm. Ashmit is here with more details on this. Ashmit, what are you picking up?
Well, what we're picking up is that Reliance clearly feels the need to house all of the FMCG ventures under one branch, under one arm. And that is what is essentially intended. This application has been filed before the NCLT. Currently, the status quo is that there are two subsidiaries for Reliance Retail, which essentially house these FMCG businesses. This will now be put together under a new entity called New Reliance Consumer Products. Now, that's the application that has been made. The rationale that has been put forth before the NCLT is that, look, these are independent businesses. They operate very differently from retail. FMCG is very different from retail. The dynamics are very different. The investments required, the nature of focused investments required will be very different. They will need their own strategic autonomy to realize their own goals. And for all of these corporate reasons, I beg your pardon, the rationale that has been expressed is that it's needed. A need is felt for housing it all under one roof. And therefore, this application has been made. The NCLT on its part has directed these entities of Reliance Group to reach out to their shareholders, to secure their approval, to reach out to the lenders, to secure their approval. Also having been asked to, in fact, send a notice to the government entities as well to see if they have any objections on the matter. The NCLT will continue proceedings in this case.
Ashmit, stay on because the Supreme Court has declined to quash the FIR against the Managing Director and CEO of HDFC Bank. Tell us more on that.
Well, this is an issue which is, in fact, impacting the HDFC leadership CEOs, Mr. Jagdishan, to be specific. Now, what's important is that an FIR was filed against him on bribery charges. This FIR had been filed in what he claims is a private dispute within the trustees of the Leelavati Trust. What's interesting is that his application for quashing of that FIR had been listed on 4 separate occasions before the Bombay High Court, and 3 separate judges of the Bombay High Court had recused themselves. It is only after that we had Shashidhar Jagdishan moving the Supreme Court today. He said this is frivolous litigation. This entire issue is with respect to a private dispute between trustees, that he's being dragged through the muck because of this. His reputation is getting impacted. The Supreme Court, however, at this stage said that it's not fit for the Supreme Court to intervene. However, asking Shashidhar Jagdishan to go back to the Bombay High Court. This matter is listed on July 14 before the High Court, saying that it hopes and trusts that the High Court will take up this case and maybe grant some relief.
Ashmit, thanks a lot for sharing that update. And then shifting focus then, the government sources have said that the waiver for interstate transmission system charges are now be considered for renewable energy projects. Abhimanyu is here to bring us all the details. Abhimanyu.
Well, the interstate transmission system, as far as the charges are concerned, there was a waiver which used to exist till the 30th of June and it lapsed. There was no continuation, no renewal from their side. However, the government sources have indicated that it is likely that a waiver is going to be considered, particularly for projects which have already been completed but are yet to be commissioned due to lack of transmission infrastructure, because that's beyond the control of renewable energy developers. So a case by case, a piecemeal waiver waiver may be considered for all projects. Now, private estimates till now have pegged an estimate of around 1.5 lakh crore rupees of investment which is stuck in green energy projects, which is likely to benefit or possibly which is likely to be impacted adversely in case the ISTS waiver is not extended. It remains to be seen how early this decision would be taken by the government, even as the waiver has already lapsed and there is no continuation so far, and any case-by-case or piecemeal approval as and when it takes place is going to decide the fate of several renewable energy projects in the solar and wind energy sector. Now, these waivers would be decided for commercial and industrial projects by the CERC and for other renewable energy infrastructure projects by different agencies, including the SECI, the NTPC, NHPC and SJVN. So all eyes, of course, for renewable energy developers would be on the government's possible decision and the current consideration of any such projects.
Abhimanyu, thanks a lot for that. And as we slip into a short break, remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impacts on Indian businesses, giving you unparalleled insights. You can tune in to CNBC-TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and the Global Lens at 8:30 this evening. Welcome back. Now, US President Donald Trump's 90-day pause in the global reciprocal tariffs is set to expire on the 9th of July. Now, he said that he was not planning to extend it. Instead, he would rather notify each country starting today, telling them what they are going to do to pay to do business in the United States. Take a look at this report.
Donald Trump says Washington will start sending letters to countries Friday, informing them what tariff rates they will face. Speaking to reporters before boarding Air Force One, he said it was too much to expect full deals with every nation.
So we're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs. But they're going to be starting to go out sometime tomorrow. We've done the final form, and it's basically going to explain what the countries are going to be paying in tariffs. And it's very important. It's a lot of money for the country, but we're giving them a bargain. But we have probably 10 to 12 tomorrow. And then after that, we'll be sending 10 or 12 a day. And as we get along, as we get to the smaller countries, we're pretty much going to keep the tariffs the same. The money will start to come into the United States on August 1st.
The move marked a shift from his earlier pledge to strike scores of individual agreements. Top aides had said in April that they would work on 90 deals in 90 days, an ambitious goal that met with skepticism from trade experts. Now Trump says he expects a couple more agreements before his July 9th deadline. Treasury Secretary Scott Bessent told Bloomberg TV that about 100 countries would now face tariffs of 10%. That would be well down on Trump's original list, which saw 123 jurisdictions get that rate. Many major trading partners now involved in talks face much higher duties under the original plan. That includes 20% for the EU, 24% for Japan, and 26% for India. Some countries that have not engaged in talks face even steeper levies. Thailand could see 36%, and the tiny African kingdom of Lesotho 50%.
And the other top global headline we are tracking closely is the One Big Beautiful Bill. And US President Donald Trump's tax cut legislation cleared its final hurdle in the US Congress last night as the Republican-controlled House of Representatives narrowly approved a massive package that would fund his domestic agenda and push millions of Americans off health insurance. Now, what exactly does this Big Beautiful Bill entail? NBC's Ryan Nobles has more on that.
A major victory for the Donald Trump agenda.
The motion is adopted.
The House passing his multi-trillion-dollar sprawling spending bill designed to fund a wide range of campaign promises, including extending tax cuts passed in his first administration, new military spending, and money to fund a mass deportation plan, paying for it in part with steep cuts to food aid benefits, clean energy funding, and Medicaid. President Trump celebrating the win before flying to a victory rally in Iowa.
This is a great bill. This is going to be a great bill for the country.
The bill passed largely on party lines, with only 2 Republicans voting against it. One of those, Pennsylvania Representative Brian Fitzpatrick, who dodged NBC News' questions.
Why did you vote no?
Hi, how are you?
Good, how are you? Why did you vote no?
House conservatives balked at the changes made in the Senate, holding back their votes for hours, before they finally relented without a single thing in the bill changing. House Speaker Mike Johnson. Do you think they caved?
No, I don't think they caved. Look, I think every member made a thoughtful and informed decision.
President Trump working the phones until the early morning hours. The holdouts say they got what they wanted. Are you concerned that in the future, though, people won't believe that you guys are going to be a no on big issues like
I think
this?
they know we better be ready ready to deal.
Democrats did everything they could to delay final passage. Their leader, Hakeem Jeffries, setting a record by holding the floor for more than 8 hours, attacking the bill's overhaul of social safety net programs like Medicaid and SNAP, which could lead to millions of Americans losing access to coverage.
We were a hell no last week, a hell no this week, a hell no yesterday, a hell no today.
But Republicans argue Medicaid is in need of reform, and the bill is filled with the president's priorities, like eliminating taxes on tips and overtime. Republicans taking a victory lap following the vote. All Smiles is one of the signature songs from the Trump campaign rallies played in the room.
In fact, after the bill was passed, US President Donald Trump addressed supporters in Iowa and celebrated the victory, calling it America's birthday present. Listen into that.
There could be no better birthday present for America than the phenomenal victory we achieved just hours ago when Congress passed the one big, beautiful bill to make America great again. Deport the illegals and slash hundreds of billions of dollars of waste and fraud, and that's what we're doing. With this bill, every major promise I made to the people of Iowa in 2024 became a promise kept. This bill includes the largest tax cut in American history, the largest spending cut in American history, the largest border security investment in American history, although I must tell you, if you saw last month, they had 0 people coming through our border, 0.
We'll take a short break here on Business Lunch. More news and updates on the other side. Stay tuned. Welcome back. Moving on to news from Kerala's Trivandrum, where a British F-35B stealth fighter has been grounded for over 2 weeks due to technical issues. In the latest, the F-35B will now be dismantled and transported to the UK for repairs after British authorities tried to repair the aircraft but could not. The jet is over $110 million worth and is known to be one of the most advanced fighters. And with that, we call time on this edition of Business Lunch. From me and the team that put this show together, thank you so much for watching. A slight recovery from the lows of the day for the markets, and Midcap Radar on the other side takes all that action forward.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Good afternoon, Vivek. Some recovery in the Nifty from the lows, but there was a sharp fall as well around 11:30. It's the last day of this trading week, so I don't know about you. I'm going to sleep over the weekend.
Absolutely, same here. Need to catch up on sleep. Well, what a strong start we had, especially in terms of news flow, given the fact that a very large, very big trader will now be restricted range-bound trading as far as the Indian markets are concerned. But along with that, we have a lot of discussions lined up on this show. So let's start off with the top headlines. Range-bound trade on D Street, with Trump expected to start sending out tariff letters to partner nations from Friday. An interim India-US trade deal is also in the final works. IT and pharma notch up some gains, while metals drag. Mid-caps fall more.
Credit Access Grameen gains after reporting their Q1 business update. Company sees early signs of improving asset quality, even as write-offs impacted loan growth.
SEBI has issued an interim order barring Jane Street Group from the Indian equity market and impounding gains of over 4,800 crore due to index manipulation. SEBI continues to investigate the matter. Capital market stocks like BSE, Angel One and Nuvama are under pressure.
Defense stocks are abuzz as Defense Acquisition Council cleared capital acquisition proposals worth nearly 1.05 lakh crore rupees as the nation's military seeks to onboard new defense equipments. Okay, all right. Those are the top headlines that we are tracking for the markets. As I pointed out earlier, it's in the red. There's been some recovery from the morning lows. However, it's been volatile in terms of the moves that we've been seeing. At a point in time, we were down as much as 70 points. From those levels, we did see a recovery. But the mid-cap index, that is the one which continues to be under pressure. 0.4% gone there. We do have a lot of sectoral indices which have turned red. There was a point in time when most of them were in the green as well. So Nifty Pharma is batting for the bulls, but metals, auto, consumption, all of them are in the red right now. A lot of stocks from the broader markets moving around as well, be it the standalone refiners like Chennai Petro, be it JK Paper. Some of these names are buzzing in trade today. No specific news flow per se, but keep an eye out on them. We do have some of these movers in the broader markets.
That's right. Quite a bunch of strong movers, especially as far as the broader end of the markets are concerned. One sector that's under quite a bit of pressure today is actually the life insurance space. So names like LIC, Maxfin, HDFC Life, these are some of the names that are under pressure. But these stocks, along with a whole host of other stocks, is what Hormuz has on his list. He's standing by the wall to take us through the mid-caps that are moving around in the session.
Some recovery in the benchmark indices. You can't say the same for the broader market. So we'll start off with the losers then before we get to specific names. And Sammaan Capital is among the top losers in today's session, 9% lower. Now look at Dream Folks and continuing to extend losses, 11% lower now on that stock. DCM, Shriram, Crisil also among the top losers today. It is the capital market plays that are bearing the brunt of this Jane Street order that came from SEBI last evening. Nuvama Wealth is now down 10%. BSE, Angel One down 6 each. Angel One, of course, also reacting to its business update, and CDSL, after being fairly resilient in the first half of the trading session, has now collapsed, is now down 3.5% as well. Some of the other newsmakers today, though, Credit Access Grameen too reacting to business updates, a positive reaction there, bucking the trend, and Bandhan Bank, though not quite falling to the lows, is down 3%, and MCure, after the block deal that took place earlier in the day, is down 2.25% as well. On the volumes front, Sapphire Foods among the top gainers on the Nifty 500 today, 8% higher on that stock. And look at Vedant Fashion. Bosch continues to extend gains from yesterday, and Mastech is up 4% on very strong volumes. And as you mentioned, pharma is one sector that's done well today, bucking the trend. And look at Mankind, Aurobindo, Laurus, Natco. In fact, Laurus and Natco are up almost 10 to 12% this week. So they continue their outperformance. Pharma among the sectors bucking the trend today. Back to you guys.
Okay, all right. Thank you so much for joining us with those names, Hormuz. With that, let's move on. Rajesh Palvia from Axis Securities is joining us for a quick technical check. Rajesh, good afternoon. Thank you so much for joining in. Well, tell us, what are the charts suggesting now? Will it continue to be a little volatile towards the end of the trading session as well?
Good afternoon. So there is volatility in market, and Nifty is now trading below to the important put-based support area of 25,400. So which is also creating some pressure on the unwinding side of trade for Nifty. The call writers have now shifted and adding the position at 25,500, 600 strikes. So which clearly shows that, yes, maybe some pressure would be there in indices, but still, if we analyze on the short to medium term perspective, Nifty is very well placed about to all its near term, short term moving averages. So there is no as such major weakness which we are expecting in the Nifty in the near future. But yes, could be it would be a range bound 25,300 on the downside, and on the higher side, 25,550 may act as a supply zone. So maybe some range bound activity for some couple of days, and then Nifty will resume back to its uptrend, and we may see further higher level. For Bank Nifty, again, Bank Nifty is now slipped below to the major put-based concentration of support area of 57,000. So here the structure is, slightly turning on the weaker side for near-term perspective. So if it continues to trade below 57,000, maybe we may see further more selling in Bank Nifty. And on the downside, 56,500 would be the next level where the put writers are, now making some, positions around those levels. So 56,500 may act as a support for this decline. Bank Nifty is looking a little weak compared to Nifty at this juncture. But looking at the stock specific action, we do believe that, after some brief consolidation, Nifty is likely to extend its gain, and we may see continuation of upward momentum in coming days.
Rajesh, what are your individual trading picks for the day?
So I think pharma is a sector where we are focusing at this juncture, and Glenmark Pharma, the continuation of uptrend is there. So Glenmark Pharma can be looked at for buying side. The way stock is moving in higher top, higher bottom formation, we believe that, here we could see a rally towards 1870, 1880 in a short-term perspective. So one can buy with stop loss of 1790. Another sector where we are focusing at this juncture is, oil and gas space. And I think from that space, one can focus on BPCL. Stock managed to view breakout on the weekly chart also. And looking at the long built up in the week-on-week basis for this counter, we believe that, BPCL may extend its gain. 355 to 360 would be the next target. On the downside, 332 should be kept as a stop loss.
Okay, all right. Thank you so much, Rajesh, for joining in with those details. With that, we'll slip into a break. Remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. Well, we've been looking at the oil and gas space. MGL, IGL, GAIL, all these stocks are in focus. Now, remember, GAIL has been in focus of late because there were talks of PNGRB going ahead and increasing the tariffs. GAIL has asked for 33%. Now, there has been a press release and that talks about how there are some changes to the unified tariffs. The PNGRB, they will go ahead and change the tariff zones from 2 to 3. That means there'll be 2 tariff rates for pipelines across the country, which will be divided into 2 zones. The second will be the benefit of unified zonal tariff of Zone 1 will be extended to nationwide CNG, PNG segments. That means that all these CNG distributors, CGD companies, they will get gas at only one rate. There will not be multiple tariffs that they'll have. So that it means the gas prices could also be uniform in the country overall for the consumers. The third thing, there'll be a dedicated pipeline development reserve introduced. And the PNGRB has also asked the pipeline operators, the biggest one, of course, is GAIL. They have been asked to procure minimum 75% of their annual gas via long-term contracts. This again is to ensure that there's no volatility in the final price to the consumers. So this is an important update that has come by. The next most important thing will of course be the price or the level of tariff. Remember, GAIL had asked for 33%. Brokerages saying it could be as much as 20%, and anything above 10 to 15% is something that the street will like.
So all eyes on the quantum of the tariff that is expected soon. Thank you so much for telling us about all of the details as far as the oil and gas space is concerned. But moving on, defense stocks are buzzing as the Defense Ministry has cleared 10 proposals worth around ₹1 lakh crore. Ria joins in with more details.
Well, yes, Vivek, as you said, yesterday the DSE has cleared 10 capital acquisition proposals worth over ₹1 lakh crores. So let's take a look at the large projects and some of the key beneficiaries that may arise from the same. The first one is the QRSAM project, which is worth about ₹30,000 crores. Now, Bharat Electronics is likely to be the lead integrator for this project. And of this project, 40% is likely to go to Bharat Dynamics for the production of missiles, which comes out to about ₹12,000 to 13,000 crores. 2 other companies, Apollo Microsystems and Astra Micro, are also expected to receive smaller orders for the manufacturing of components and subsystems for this order. Moving on to the MCMVs, which are the mine countermeasure vessels. The estimated cost for this one is about ₹44,000 crores. And all 3 shipyards, which are Cochin Shipyard, Mazgon Dock and Garden Rate Shipbuilders, are expected to bid for this tender. And this order is likely to be split between the 2 lowest bidders. Some other projects that have been cleared are the armored recovery vehicle with an estimated value of about ₹10 to 14,000 crores. BEML and Bharat Forge are the likely beneficiaries for this one. They've also cleared proposals for moored mines, electronic warfare systems, integrated common inventory management systems, as well as super rapid gun mounts. And some other beneficiaries that can arise out of this are BHEL, BEL, Apollo Micro, Data Patterns and BEL as well. So all of these stocks today have been buzzing in trade, and the Nifty Defense Index is also up over 1% on the back of this.
All right. Thank you so much, Ria, for joining us with all those details. Defense segment continues to be in focus. The other pocket that we're talking about is the financial space. A lot of Q1 updates coming in. Ujjivan Small Finance Bank and Credit Access Grameen are reacting to those updates. Gaurav is joining us now with those details. Gaurav.
Let's talk about Credit Access Grameen. This stock is soaring up in trade, and the reason being that when we look at the loan portfolio, it is not actually up. In fact, the loan portfolio growth was flat on a year-on-year basis, but there is an uptick of around 3% on a sequential basis if we exclude that one-off impact. Now, let's not forget that in this quarter, now company has said that they have a one-off impact of 690 crore rupees, which they have written off. But apart from that, there is another thing which is actually pushing the stock up, and this is basically the asset quality, because the early stage delinquency pockets are actually improving as per the update. When we look at early stage delinquencies, they are improving almost by 100 basis points. Karnataka is still a pain point for company, which contributes around 30% of their growth. But at the same time, if we exclude this part, the delinquencies have been improving on a sequential basis. Other than that, Ujjivan Small Finance Bank also came up with their quarterly update. It was actually a muted update is what we can say, because the loan book growth was at around 11%. This was because the micro group loan that was actually falling on a year-on-year basis. On the other hand, affordable housing is something which is actually pushing the growth. When we look at the secured portfolio, they have increased their secured portfolio almost by 200 basis points on a sequential basis. This is actually a little concerning in terms of margins, and that is the reason when we look at stock performance, we are seeing some kind of pressure. On the other hand, deposit growth have been healthy, but gross NPAs have also been rising on a sequential basis, and as a result, we are seeing some pressure in this counter today.
Thank you so much, Gaurav, for joining us and giving us a sense of what exactly has transpired as far as the quarterly updates are concerned in the BFSI space. But before we slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back to Midcap Radar. Well, one stock from the FMCG pack that's doing very well is Marico. This is surging on the back of a good Q1 business update. Mangalam joins in with the key details.
Well, you know, in a sector which is parched for growth, Marico has been outperforming for the last many quarters, and this quarter they've actually done a lot better. And here's the biggest reason why. Because on the one hand, you know, rural demand has been improving. The urban trend is also fairly steady. And as a result of which, the volumes that the company have reported in terms of growth has been at a multi-quarter high. Value-added hair oils, which was a segment which wasn't doing well for them for the last 8 or 9 quarters, has now come back and reported double-digit growth. And as a result of which, we've seen good growth in the overall industry itself. International business also has done well, constant currency growth in high teens. And with that, we have a higher price element as well because of the increase that we've seen in palm oil prices along with copra prices. So consolidated revenue growth has been in low 20s. The reason why the stock is, contained in its gains and is not surging away is because one, it has already outperformed, and secondly, gross margins are likely to be under pressure, even though the company expects it to ease in the second half of this year because of the commodity cycle. In this quarter itself, with a 20% plus revenue growth, the operating profit is just a moderate growth year on year, which implies there would be some sort of margin compression. Nevertheless, good update coming in with prospects of margin expansion in the second half of this year, the stock holding up with gains.
Okay, yes, it is. Thank you, Mangnam, for joining us with those details. Let's talk about global trade now. United States has announced Vietnam trade deal and announced that it will levy 20% tariffs on Vietnamese goods. To discuss the impact of this deal on India and especially Pearl Global, which has a lot of exposure to Vietnam, we spoke to Pallab Banerjee, who is the Managing Director and Group President, Pearl Global Industries. Listen into what he had to say.
So we have already had planned a capex in Vietnam as well, and we have been working on it. So that's getting captured. That means like already our capacity has gone up by high double digits, like almost 25-30%. We have been already working on that. So that's something we had factored in, that this kind of movement is possible, and we have been ready for it. China is at a much higher percentage of tariff at this point of time. So what happens is what Vietnam is looking into, a lot of shift that might happen from China into the Vietnam in terms of the apparel manufacturing. And yes, Pearl Global being having a significant presence in Vietnam, we are looking at it very positively. And of course, we are seeing a huge amount of interest from our buyers who are looking to book this capacity and place more orders with us. Yes, the order books are looking quite good, quite strong for the rest of the year. In fact, we are almost booked for the rest of full year in Vietnam. So that's a positive sign. The apparel, what happens is quarterly, US negotiates and places business every quarter. The price fixation is happening every quarter. So that means you can really negotiate and build some of this negotiated price or whatever you are giving to the customer that can be worked on between us.
Well, that was the management of Pearl Global telling us about the impact of the tariff imposition and the deal that was struck between Vietnam as well as USA on their own operations as well as the Indian operations. But as we wrap up this edition of Midcap Radar, we leave you with an exclusive conversation. Titan is focusing on the premium watches segment with the launch of their first ultra-luxury watch. Our colleague Shilpa spoke to C.K. Venkataraman, MD of Titan, about their watch business and what Titan is doing in terms of premiumization, especially at a time when consumers are also upgrading. Let's listen in to that particular conversation. Your stocks post this particular conversation.
So the overall market for premium and particularly premium watches is exploding. And our belief in the analog watch as an expression of multiple dimensions for a person, that belief has been there from actually day one. And it's been becoming stronger and stronger. And therefore, there has been a relentless rate of innovation in products, in retail, in marketing that we've had over the last 5-6 years in particular, and really taken the game to very new level. At the moment, we are sort of keeping our focus in the up to 2 lakh rupee price, and we believe there are millions of discerning customers waiting to and already buying.
Just trying to understand the market scenario right now, because gold prices, they really hit the peak and they haven't really corrected as such. And in the last quarter, also post results, you had spoken about how you could see a short-term impact in consumer sentiment, in demand as well, especially when it comes to gold purchase and jewelry purchases. So how are things currently? Are you seeing any revival in the market, in the industry in general, when it comes to consumer demand?
And not really worry so much about what's happening around, because it's very difficult to figure out what actually is happening around. So if I were to speak for Titan, one big advantage we have is most of our business comes from the top 2 income classes. And those income classes are typically removed from the problems of job losses or inflation, which means that in general they're okay. The second is most of our categories where we participate, we have low single digit or high single digit market shares. So the formalization acceleration that also will happen, is happening, is to our benefit.
9-carat segment and an 18-carat segment part of that innovation?
I mean, that would be, I mean, we have not yet innovated in 9-carat, but
I think carat lane
a 14-carat would be a big play in 14-carat would be an innovation too.
Right.
Very good afternoon. You're watching Your Stocks live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra. Well, it's turning out to be a day where we are seeing some amount of a recovery which has taken place for the markets. We have the Nifty, which is just about lower by around 19 odd points, and the Midcap Index, which is trending with a cut of around 0.2%. Overall, you'd have to say it's a quiet day of trade today. And we do have the advanced decline ratio, which in fact has now surpassed the decline. So if you look at the crisscross between them, there was one which took place midday, but then it's surpassed the just about going to surpass the declining stocks, as you can see on your screen. Bank of Maharashtra, their Q1 updates, total deposits up around 14% to 3.05 lakh crore, and the other details should show up for you. The gross advances up around 15%, just about lower by around 0.3% currently for that particular counter. But joining us today is independent market expert Shaina Mukaddam and Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all of your queries. Shaina as well as Vaishali, welcome to the show and good to see you all in. Well, let's just start with a quick check, Vaishali, in terms of the technicals of the market before we kick off the show. If you could just give us a sense, considering that there has been a recovery which has taken place intraday.
Hi, good afternoon, everyone. So I guess, yes, market does have the inherent strength. So for intraday purpose, I would say 25,350 acts as a crucial support. If we see Nifty sliding below that, then we can see some more profit booking coming in. But till then, it is a consolidation to a sideways move with 25,350 as support. And likewise, even in Bank Nifty, we will say 56,500 is the support. And that's what we have been witnessing, that yes, market is attempting to bounce from there on. So I guess wait and watch. If levels break, then that could trigger further sell.
Okay, all right. Well, we do have a lot of queries coming our way. So let's start with the first one. A. Subramanian writes to us from Chennai. He holds 35 shares of Cochin Shipyard, which he's bought at around 2,311 odd rupees. So he's sitting on a loss there of around 9,000. He's asking whether to book his losses or to stay invested. Well, Shaina, over to you on this one first.
Hey, as we are hearing even today, the order book for these companies in defense, shipyard as well as the other defense companies is very strong, and valuations are expensive. So, if you combine the two, it makes it a bit difficult to give you a short-term call. Short-term, it could, go down by 300, 400 rupees. It could go up by that much. But in terms of longer-term fundamentals are in place. They have done very well in FY25, and going forward also, I believe given the order book position of more than 22,000 crores as of now, I'm not even factoring in what they're getting. Valuations short-term are expensive, but if you go down to FY27, it's about 35 times P and a price to book of 7 times, which is not too stretched for a company of the size and quality of Cochin. So I would say it's a hold.
Okay, what about you, Vaishali, in this?
So I would say, well, there is no damage to the trend right now. The near-term support lies at 2,000. So as long as 2,000 level is held on, I think one can expect a bounce coming in, because today what we witnessed is that these stocks are in a new round of momentum. So if the momentum continues and sustains, then we are back on track, and perhaps we can look at a target of 2,400 in times to come.
Okay, all right. So that's on Cochin Shipyard. That stock has performed well, up around 28%. Any which way in the past 6 odd months. Let's get to another query now. We have S. Jaykumar, who writes to us from Tamil Nadu. He holds 100 shares of Oracle Finance, which he's bought at around 9,079 odd rupees, sitting on a bit of a loss there. And 100 shares of Linde India, which he's bought also at around 6,658. And he wants to know the future prospect of both these investments. So future prospect of both these investments. Vaishali, let's get to you on the technicals first.
So I think first let's talk about OFSS, and I think, it's showing signs of improvement. So I would say near-term support lies at 8,500. And since stocks in all this sector is attempting to do better, this too should do well and look for a target of 9,500. And Linde also, if we talk about it, I think, very well placed. One can add at every decline and look for higher targets of around 7,000, 7,200.
Okay. What about you, Shaina?
Well, these are long-term stable investment companies. I don't think there's too much of trading possibility in them. But if you see both of them, the companies have very strong balance sheets. They are debt-free. They have got high cash-generating businesses. Promoters hold about 75% equity stake in both. But if you see in terms of near-term valuations, they are expensive. At the same time, I would say that both of them have got unique businesses. Like Oracle is doing and likely to do much better because of they're doing very well in the cloud. In the cloud services, I think there is a big growth area. India, in fact, global is expected to grow about 20%, that whole segment. And Oracle is very well placed over there. In terms of Linde, of course, like oxygen, the industrial gases, they are very strong. They, of course, peak was in the COVID time, 22, 23, they did very well. They have not been able to match those type of revenues even now. But given the fact that they have good order book position, very strong balance sheet, I would say you can continue to hold both.
Okay, all right. Well, now we have Prabhu who writes to us from Chennai. He holds 250 shares of HCC, which is bought at around 36.26. He's asking what to do, whether he should hold or sell at these current levels. Well, just sitting on a bit of a loss. In fact, we've got all of our queries where people are making losses today. But nonetheless, Shaina, over to you on this one. HCC, what would you recommend?
Yeah, see, so the stock has corrected if you see the last couple of weeks. And some from say 38, 39, 40 levels, it's come down to about 30. Now at current levels, I would say that it is a hold. You could look for a bounce to exit. I would say do exit at a bounce because while the stock is a turnaround and it's made very good profits in the fourth quarter of last year, I think a large part of it is in the price. The main issue over here is the balance sheet. The debt is very high, and to meet the huge projects that it's got on hand, dilution is going to be an issue, so I don't know how they're going to do it and fund those projects. So I would say take the bounce, whichever you get, which I think they should, and then you could switch.
Okay, and what about you, Vaishali? The stock has been a complete underperformer. It's down 38% in the past 12 months. From that context, what would you recommend?
Totally agree. Actually, the recent high that we saw was 48 levels. From there on, it has been just sliding. And now we are seeing there is hope of recovery. So I would say 28 should be taken as stop loss because we would still say chartically it is still in the process of higher bottom formation. So as long as 28 levels are held on, I think this stock can bounce to 38. And from there on, we can have a relook because if it moves past 38, then we are back on track to look for targets of 45, 48. So that's the way to look at this stock.
Okay, all right. That's on HCC. We now have Pratibha Raj, who writes to us from Hyderabad. She holds 300 shares of Idea Forge, which he's bought at 952 odd rupees. She wants to know what the long-term view on this particular counter would be. Again, sitting on a loss. First, wanted to understand that are you in specific, Vaishali, looking at a lot of, or are a lot of your clients coming with a lot of the, more losses recently or of late?
Well, yes, Idea Forge has always been a troublemaker in the recent data, whatever we've seen, right from 900 levels. And now it is showing strength. In fact, today also we are seeing some volume pickup and all. So I think hold on. I mean, let's not panic. Keep 550 as a stop loss and at least look for a trading range of 650, 680. And once we see those levels, then I think it's again back on track as I just mentioned. But there are a few stocks. Most of the stocks have really run up in this sector. But there are 2 to 3 stocks which still look promising. One is Zen Technology, one is HAL, and Idea Forge. So these stocks, if the direction goes right, I think you can see further on returns from these stocks.
Okay. What about you, Shaina? Idea Forge?
Idea Forge, unfortunately, is one stock in defense, which I'm not too sure about of investment. There are issues out here. It was listed 2 years back around July 23. Post that, it has never seen those type of levels. Secondly, the promoter has very low holding, about 29%. And the main part is the problem is the order book position. If you see a year back, or I would say 6 months back, the order book was almost about 176 crores. But if you see recently, at least a couple of 2-3 months back, it has fallen down to 13, 14 crores. And if you see the numbers also, it's making losses in FY25, it made losses versus good profits in the previous year, the year of listing. So I would say it's extremely risky, but it's a defense stock. It's in drones, engineering. So I'm not too sure about this stock. I wouldn't hold it. I would relook at it, keep relooking at it.
Okay, all right. What would be a good level for you to probably enter the stock?
I really don't know because, with the order book position of just about 13, 14 crores, I don't know when it's a good time to enter.
Okay. All right. Well, that's an Idea for just about higher by around 5% just in the past few weeks odd. We'll take a short break, but remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Your Stocks on CNBC TV18. We have with us independent market expert Shaina Mukaddam and Vaishali Parekh of Prabhudas Leeladhar to answer all of your stock queries this afternoon. Well, before we get to that, just a quick word on the markets. We have the Bank Nifty, which has recovered quite a bit, so just about higher by around 54 odd points. Nothing to write home about, but nonetheless, it is still a positive momentum that we're seeing for the Bank Nifty. A couple of paper stocks are doing well. So JK Paper is doing well. It's up around 9 odd % on huge volumes. Padamji Paper is also seeing some amount of momentum on the upside. So that stock is up around 3 odd % at this point. But let's continue our focus on specific stocks then. We now have Vaibhav Rathore, who writes to us from Mumbai. He holds 18 shares of Siemens Energy at around 2,782, and he wants to know the potential of the stock for the next 5 years. He also wants to know if he can add more shares going forward. Well, Shaina, it's definitely a breath of fresh air to see a positive stock or positive returns come in today. So what would you recommend on Siemens?
Yeah, so the stock was demerged and relisted. It was listed after breakout from Siemens. Siemens Energy was listed just recently, couple of days back in June. So here, he's making money. So I would say it's better to take some money off the table as of now. While the prospects are very good because they will focus on the energy business. T&D, the order book will be good. They have got a good order book. They have got good growth coming forward. They have got order book of about 15,000 crores, which is about 2 times their revenues for the current year. So everything is okay for the company, but valuations are too expensive. If you look at it, current levels, you have it is about market cap is about 10 times their FY26 estimated turnover and their 30 times EV by EBITDA. So I think these levels, we could see the stock consolidate for some more time, couple of quarters. So relook at it at that point in time.
Okay, all right. Well, let's get to another query now. We have Ravi who writes to us from Chennai. He holds 250 shares of Biocon, which he's bought at around 123 odd rupees, and that's a good profit that he's making. He wants to know the long-term outlook on the stock. Well, Vaishali, let's get your view in terms of the the technicals of Biocon?
Sure. So Biocon, I think it is a stock for ones who have patience, because this is not the one which really gives you a consistent up move. But seeing the current scenario, I think this is looking very positive, and I think we are looking at a projected target of 410 to 420. So at least for these levels, one should hold on.
Okay. And what about you, Shaina?
Yeah, it's a hold with a stop loss of say something like 340. That was the price at which they raised 4,500 crores just recently. Now, and a large part of this will, of course, Ekta, you're an expert. You know this will, and you have discussed with the management number of times. I've heard you that this will go to partly repay some of the debt. But at the same time, the debt still fully reflect on reduced cost and interest. It will take a couple of more quarters. So I think FY27 will be the time when we'll actually see the implications of this debt reduction, which is an issue for Biocon as of now. In terms of products, of course, they are doing very well in their biosimilars. They are doing very well in peptides. They've got 5 biosimilars in the US market as of now. Peptides, the GLP-1, they are launched in UK. They have got approvals going forward for the developed markets going forward. New product pipeline is good. So I think in terms of valuation also, it's about 4 times EV by turnover, which for the size and type of Biocon is not expensive. So I would hold, but hold with a stop loss, because as you know in pharma, things can change overnight, one. And two is, I think most of the upside will come only starting FY27.
Okay. Well, Suresh now writes to us from Chennai. He holds 1,000 shares of IRB Infrastructure, which he's bought at 69 rupees. He wants to know the future prospects of this particular stock. He's sitting on a loss there. Vaishali, any target that you would probably have? Do you think that it could probably get back to that 69 level in order to exit?
Well, it's really very hard to tell, because right now there is no clarity on the trend. But all I can say is that one can keep a support of 48 levels. Now that he is so close to the support, continue holding, and let's see how the stock performs, because it needs to cross 54 levels technically. 54 and 55 levels, it's a tough resistance band. So once it sustains above that, then I think this can come towards its target of 65, 68. So for now, I would say continue holding and let's wait for a bounce.
Okay. What about you, Shaina? IRB, it's not done too great. It's down around close to 20% in the past 6 months odd. Your recommendation, Shaina?
At current levels, valuations are not too stretched. It's about 12 times EV by EBITDA. It's got 38% market share in the toll, operate and transfer, the TOT business. This market share has actually gone up if you see last 1 year. They've done pretty well in FY25 in their toll business. They have grown by about 23%. They've got good, projects in hand. So I would say hold, hold with stop losses that have been given to you.
Okay, all right. So that's on IRB Infra. Now let's get to Malik, who writes to us from Hyderabad with an investment question. He wants to know some defense stocks he can invest in for the long term. Well, who doesn't, Shaina? So tell us, which one would you recommend at these levels?
Yeah, so we already discussed Cochin. So that would be one on the list, Cochin Shipyard. I personally hold BEL, and I'm very positive on the business going forward. Even today, they got a huge announcement of huge new orders. It's a high-tech business. And in terms of valuation, it is expensive. But these are stocks in defense that you really have got to, keep your faith and hold it for the long term. Similar cases, HAL, which I think, you need to create a portfolio of defense stocks. You have HAL, which I think is another strong, growth company over the long term. They've got good order book position, good products. You can also look at Majgaon Dock, which recently acquired the dock in Colombo. And in terms of performance also, it's doing pretty well. So I think execution, I don't think order book is such a problem over here for all these defense companies. They've got huge order book positions. The issue is whether they will be able to execute and actually give a good return to the investors. So here I think most of these companies which we discussed are likely to do well. So, you could make a portfolio of a combination of couple of stocks.
Okay. All right. What about you, Vaishali, in this case?
So I do agree with China for a few of the stocks like Cochin and Masgao Docks, etc. But well, I still feel that HAL, as she mentioned too, and I do agree that yes, it has a lot of scope for upside. So HAL is one of the stocks which even now can be bought. The other one, well, even Bharat Dynamics. So that can be done as an SIP strategy because these stocks have really run up. So I would say keep accumulating at every decline because long term still looks very positive.
Okay, all right. So that's on a couple of these defense stocks which have really been in focus. If you look at Paras Defense, for example, it zoomed today. But now we have Suresh who writes to us from Telangana. He holds 663 shares of ITC sitting on a loss, as you can see, which he's bought at around 449 odd rupees. He wants to know what to do, whether he should continue to hold or sell at these levels. Shaina, let's you take this first. ITC.
Yeah, so I also hold ITC for a very, very long time. And I noticed that it is a stock which actually gives you a good return and then consolidates for a long period of time. So I believe now, as of now, it is in its consolidation phase. But, with the valuations being attractive, it's about 25 times earnings. The cash business, I mean, their tobacco business is a cash generating business, doing very well for them. At the same time, if you see the numbers actually were pretty disappointing. If you see the last year, we saw high prices of some of these commodities like food stuffs. Also you have tobacco prices that were high, which impacted their profitability. So I think it's going to be in a consolidation phase for a couple of more quarters, but if you're a long-term investor, it can be part of your portfolio. You can see the stock going up by 15-20 rupees, go down by 15-20 rupees. So you've got to keep your long-term investment strategy in place.
Okay, what about you, Vaishali?
I do agree. I mean, actually, it is not a stock meant for traders. Only for long-term perspective, continue holding. And along with that, I would suggest also ITC hotels. That also looks positive at this level. I would say accumulate both and enjoy when it moves.
Okay, all right. Well, that's a wrap then, Vaishali as well as Shaina. Thanks very much for joining in and taking us through all of the queries that we have. That's all the time that we have on the show, but do remember to email us your questions and we will address them with our experts. Stay tuned. Closing Bell will take you through the last hour of trade for the week.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Most of them have opened up on the positive footing. Now, Taiwan Index and Hang Seng on the flip side have opened up in the red.
This is big, and it's in terms of regulatory action, perhaps as big as it gets.
Reliance Retail now looking to hive off the part of the business that dealt primarily with FMCG.
The market's up. Markets actually opened higher. It's opened better than what the implied open was indicating.
Last day of the week, but it is such an action-packed day so far.
They will have to deposit 4,843 crores with SEBI.
This is a lot lower than their 5-year CAGR of 35%.
The skill set which India is offering for all kind of industries is superior.
At a point in time, we were down as much as 70 points. From those levels, we did see a recovery.
Well, that was the day so far. Things continue to remain very quiet as we come to the close of this trading week. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Surbhi Upadhyay. And Surbhi, once again, we've pretty much oscillated within a tight band. It's just that we're ending closer to the lows.
That's right. I mean, and the silver lining is at least that we've not, for now, we're not at the lowest point of the day. We've tried to kind of, muster our way back up, at least somewhere around the 25,400 vicinity. That's been the trajectory. At 12 o'clock, it was looking rather bleak. But since then, there's been some recovery. We still have an hour to go, so let's see how it plays out. Globally, of course, the action is quiet because of the 4th of July holiday in the US. But even otherwise, I mean, the Wall Street rally that we had even last night, that didn't quite rub off on, our market or on a market like Hang Seng. So it's very, very different. It's very, very range-bound. The market waiting for clarity on big events like perhaps earnings and, what's coming ahead on tariffs. Just to talk about the large-cap action, beneath the Nifty, you have lots of individual newsmakers, and that's what the next 1 hour is going to be about. We'll talk to you about stocks like Trent, about how a lot of the capital market stocks are sulking big time. Let's pull up Trent. It's still down. Look at that, 12% down on Trent. It's been quite a disappointment with the Q1 update. BSE is a case in point, or even if you're looking at a Nuvama or many of these other capital market plays, big cuts coming in. Now, how much of this is some sort of nervousness around the Jane Street impact? How much is it just because, some of the quarterly updates are pointing to a little bit of sluggishness? We'll have to wait and see. But these are two pockets which have definitely seen weakness, even otherwise on the Nifty. Tata Steel, Eicher Motors, Tech Mahindra, IndusInd Bank. I'm just reading out the list of Nifty losers. And you can see there's hardly a pattern today. It's literally all over the place, to say the least. Reema?
Indeed. By the way, Europe, I was just checking that out. Europe has opened sharply lower, 1% gone now on the benchmark European indices. So I'm just saying compared to what rest of Asia and Europe is doing right now, so even in Asia, you had cuts of about 0.7% coming through for some of the indices. There you have the French index is down over 1%. And here there appears to be some battle brewing between the spirit makers in France and China. So French spirit stocks are under pressure as China has slapped high duties on an EU brand. So Pernod Ricard, etc. are trading with cuts. So I guess it's tariff, not just US versus the others, but it's happening in various different pockets as well. So keep your eye on Europe. But as Surbhi pointed out, that even though at the index level we're not doing too much, in fact, we've affected about a 50-point recovery, intraday recovery from the day's low, there are so many individual pockets. She spoke about capital market plays, defense stocks are higher, and Trend that clearly stands out as the biggest accident of the day, and the stock is still reeling with a cut of about 12-13%. But how should you position yourself in the last hour of trade? Mitesh is now with us with a few closing strategies. Mitesh trying to get back closer towards that 25,400 mark. Intraday, we dipped to about 25,330, 340. So from there has been a bit of an up move. But still, it's been a weakish week for us, down 1% at the index level for this week.
Good afternoon. I think that's true. The markets are hanging on to 25,400 somehow, while we are dipping below this level on an intraday basis. somehow it's always climbing to close around or just above this 25,400 level. So we'll keep watching this. As of now, I think my belief is that if that gets broken, we'll have some more declines and possibly 25,200 to 20 zone could be tested. I think that's where I think, for me, the bigger supports kick in, and we might not see a play below that. But for the time being, it's a market which is just surviving at 25,400. Therefore, the index can possibly be avoided for the time being, and individual stocks should be the way to trade in the markets.
Okay, so let's talk about those individual stocks, Mitesh. What's catching your eye this afternoon?
Yeah, good afternoon, Surabhi. Hindustan Unilever, I think, is something which has come on the radar. I think that's moving very nicely. I would look at a target of around 2365 here. I recommend buying with the stock just below 2320, 2318 is what I recommend actually. And that apart, I think, the other FMCG stock which is on my name is Godrej Consumer. That's a buy with the stock just below levels of 1166 and a target of around 1225 is what I'm.
Okay. By the way, Mitesh, before we let you go, trend, has it violated a lot of important technical levels today? Do you see supports in sight? I mean, a lot of people would have bought in with the recovery, expecting stability on overall numbers and sales, but today has been quite a shocker. Next levels?
I think very clearly the news flow was bad, but this gap down, see, yesterday I think we got a low of around 6140 and today the high is around 5785. So about 330 point kind of a gap down. And, that typically means that now, one, the stock will face a lot of supply on any pullbacks or rallies. I don't think the stock will have the strength to get past 5800. And the minimum level which I'm looking at is 5120, which is where the stock had done some consolidation way back in April. But in the worst case scenario, expect levels of even 4,900 or just below that.
Okay, all right, 4,900 possible, looking at the charts. Got it. That caution has been placed on the table. Thanks for that, Mitesh. We'll come back to you a little later for some final strategies. But now let's get to the fundamentals on trend. What has made the stock take such a sharp knock? Yes, we got the Q1 update. They're talking about 20% growth. Mangalam, make sense of it for us. I mean, why is the market so disappointed? And actually, even at lower levels, buyers are simply not seen.
Well, there are a couple of reasons for this. One, yes, the stock has seen a big run-up from the lows earlier. Secondly, the market itself has been a little, jittery when it comes to high valuation names. And thirdly, no one wants to catch a falling knife yet. So these are three factors that are exacerbating the decline that we're seeing on trend. I wouldn't be surprised if at lower levels someone buys it or if there's a brokerage that comes in saying that, okay, now things are in the price. We would see an equally sharp up move on the stock as well. That's something that we've seen on trend in the past. When it falls for a few trading sessions. When it rises for a few trading sessions. So today is one of those days where it's declined. The trigger for all of this was the 20% quarterly update that the company has reported in terms of growth. They've added one West Side store, they've added 11 Zudio stores. The street was hoping for better growth coming by in this year, especially at a time when the company just 2 weeks ago in the analyst meet said that 25% is a revenue CAGR that we will do. The street was adjusting itself to that 25% CAGR, which is sustainable at a time when the last 5 years CAGR has been 35%. So it's not that they weren't expecting, a lot. They were just expecting a reset lower, and the actual number has come in a lot lower than what the earlier reset was as well. So it's just that uncertainty in terms of the very near term, clubbed with the big rally that we've seen from the lows and no valuation comfort coming in for Trent, which has actually led the stock to be lower in today's trading session. Nuvama, for instance, has cut their EBITDA estimates by 9% for this year, 12% by the next year, and they've cut their target price as well from over 6,600 rupees to a little around 5880 rupees itself, and they've downgraded the stock to hold. But it's a matter of time before, the company, once it reports its results, that's baked in, brokerages will start adjusting to the new normal for Trent as well. And there are, perhaps, if the stock moves higher, we'll continue to see it move higher from here on.
Thank you very much for explaining that so beautiful. Sudeep Bandopadhyay, Group Chairman, IndiTrade Capital, is now with us. Sudeep, you've liked consumer discretionary in that Trent was a favorite for so many people for the kind of wealth it generated, for the business that it's built, and the way it pivoted from West Side to Zudio. But now things are slowing down. So what should investors do? Is it a good time to buy or wait for things to settle down? What would be an appropriate level to enter in Trend, and what should existing shareholders do?
Well, I think for quite some time we have been cautious on trend, and we have been advising caution. And we've been very clearly saying the valuation does look rich. Look, trend has got too much of competition now. There are multiple other players who have gone into the same Zudio format, and they are also expanding rapidly. Apart from this, there is this online competition which is going to come, and which has already come from multiple players, including the large Chinese names which have now tied up with Reliance Retail. So competition has intensified in that same segment where the growth was coming, and absolutely, it's a no wonder that the growth rates have come down significantly. As opposed to a 40% kind of a growth, they're talking about a 20-25% kind of normalized growth going forward. So obviously the market is disappointed. The valuation, doesn't get justified with that kind of a growth. So the valuation adjustment is happening. And at this stage, I don't think there is any point to rush and buy a trend. Let things settle down, and let's look at the valuation then. And only then we should take a call on trend. That's our view.
Okay, all right. So trend, a bit of a wait and watch on this one. Let's look at some more movers and shakers in the market. The Midcap index is also completely flat, so not really giving us any sense of direction at an index level. It's all individual level stock action. So there are gainers. It's not like it's not a day of any gainers. Some examples would be a Credit Access. Credag is up 6%. As we're speaking, there are defense stocks which are rising, which we'll come to. Paras Defense, of course, is one of them. You have some of the other financial names like CSB Bank. CSB Bank came out with the first quarter update, and it seems to be a fairly decent quarter for them. That stock is up about 6% as well. So these are SML Isuzu, a smaller name, up about 8-9%. So at a very individual stock level, there is stock picking that's going on. But the index is absolutely flat. So Deep, since we're talking about some of these movers and shakers, in tier 2 financials, all the updates that have come in, whether it's AU Small Finance or CSB or any of the others, did you like anything that really stood out for you?
Well, I did like CSB. I think they are trying to create a differentiated bank, and they are really going about very systematically. The management also has, stabilized. Some of these smaller banks based in South used to have a volatile management, situation, but things have stabilized with a credible investor and stable management. The gold loan portfolio is doing well, and it's growing, and of course, to my mind, it's a fantastic business to be in from a point of view of the geography they operate in. So I think CSB definitely looks good from a long-term perspective.
Okay, so that's a thumbs up to CSB. Credag is also up after the update. So let's do one thing actually. Let's go across to Gaurav and take stock of a lot of these financial updates that have come in banks and non-banks, because the market is very clearly reacting to the good ones. Gaurav, tell us more.
Well, let's talk about HDFC Bank. A good set of number is what we saw from the bank, and why I'm saying good set of number is that the bank is actually moving towards what the management had guided. When we look at the loan book growth, that was at around 7% on a year-on-year basis. Now, let's not forget that management has said that in FY26, they will be moving more towards inline growth in terms of advances growth. In terms of CD ratio, also we are seeing the CD ratio is coming down. Management had guided that it will come down gradually, and in this quarter, we are seeing some improvement there as well. Other than that, Bank of Maharashtra recently came up with the numbers. The loan book growth came at around 15%. It was actually a decent set, but deposit growth actually was a muted set of number in terms of sequential growth, and that is the reason why we are seeing some kind of muted reaction from stock as well. Ujjivan Small Finance Bank, on the other hand, came up with a little weak set of number. The loan book growth was at around 11%. This was because of the slowdown in the micro loan segment, although affordable housing is something which is actually driving the loans. What is worth highlighting is that now the secured portfolio has increased almost by 200 basis points on a sequential basis. Now there is some kind of concerns, and the reason being that there may be some kind of pressure in terms of net interest margins because of the secured loan portfolio. On the other hand, let's also talk about NBFCs. So first, let's talk about Bajaj Finance. A very good set of number. 25% growth is what we have seen on a year-on-year basis, and 6% growth on a sequential basis in terms of AUM. The customer base also increased, and now brokerages believe that credit cost is the only checkpoint remaining because the growth was very strong for the bank. Lastly, let's also focus on Credit Access Grameen. Now this stock is soaring up in trade today, and the reason being that although the loan book growth was muted for the quarter because there was a one-off impact of 690 crore rupees, the credit cost and specifically in terms of the asset quality, we are seeing some kind of green shoots. The delinquencies early trend is showing some improvement. 100 basis point of improvement is what we have seen in the delinquencies. And when we look at excluding Karnataka, there also we are seeing some kind of improvement. So definitely on the back of the good set of numbers in terms of asset quality, we are seeing this stock soaring up in trade today.
Thank you very much for that. Sudeep, any of the stocks that Gaurav was talking about you like?
Well, I do like credit access, Grameen, quite a bit. Of course, microfinance went through a really, really bad phase. And I think their numbers show a very interesting fact that the asset quality finally have started slowly improving. And that's a very, very interesting, fact which has come out because pretty much the entire industry and the market has been talking about the microfinance woes. So if the recovery is already there, I think then we have probably seen the worst already, and things should start improving from here on. Of course, we are seeing also a trend that as opposed to increasing microfinance unsecured loan book, most of these players are focusing on creating a secured book along with the unsecured book, and RBI has allowed now up to 40% non-qualifying assets to be included, and that gives them a significant flexibility of creating a secured book along with an unsecured book. I think this is very interesting, and we will keep watching this space, the microfinance space, particularly credit access and some of the other listed microfinance players.
Okay, all right, got that. Sudeep, stay on. If we look at defense stocks as well, we've got RIA joining in. Yesterday, of course, the big headline was the Defense Acquisition Council approving acquisition proposals worth over 1 lakh crore rupees. So India continues to spend top dollar or top rupee on defense. And the excitement is for all the suppliers and the vendors. That's the index that's doing really well. RIA is joining in with more details. RIA, in addition, I think for Paras, there's also stock split, right? Paras is up 9% or so, 9-10%. But tell us more.
Well, yes, Surabhi, Paras Defense is up because of the stock split. It's up about 10% today. But the big news yesterday was that the DSC has cleared 10 capital acquisition proposals worth over rupees 1 lakh crores. So let's take a look at some large projects and the likely beneficiaries of the same. The first one is the QRSAM project. This one is valued at about rupees 30,000 crores, and Bharat Electronics is the lead integrator for this one. Of this, 40% of the order is likely to go to Bharat Dynamics for the production of missiles, which will be about rupees 12 to 13,000 crores. Two other companies, Apollo Micro and Astra Micro, are also expected to receive smaller orders for components and subsystems for the same. The next one is the MCMV order, which is the mine countermeasure vessels. This one is estimated at about rupees 44,000 crores, and all three shipyards, which are Cochin Shipyard, Mazgon Dock and Garden Reach Shipbuilders, are expected to bid for this tender, and this order may be split between the two lowest bidders. Some other projects that have been cleared yesterday, the armored recovery vehicle, estimated value about rupees 10 to 14,000 crores for this one, and BEML and Bharat Forge are the likely beneficiaries for this. Apart from this, we have the moored mines, electronic warfare systems and integrated common inventory management systems, as well as the super rapid gun mount that has been cleared yesterday. So some other beneficiaries can be BEML, BHEL and data patterns, in addition to Apollo Micro and Bharat Electronics. So today, all of these counters have been buzzing away in trade, and even the defense index was up over 1.2% and 1 point in trade today.
Thank you very much for that. Sudeep, a quick comment on defense stocks from here. If you had to pick one, which you like the most, where the risk reward is favorable, which one will it be?
Well, I have been liking BEL for quite some time. Valuation has moved up. It's not cheap, but I still believe that this is a re-rating candidate, and at some stage that re-rating will happen. So if somebody has a long-term view, I think definitely BEL is a good buy, even at current levels. The other stock I would like to highlight is BEML. Again, the opportunities are increasing significantly as we are watching, and performance also has improved quite a bit over the years. So again, a patient investor can look at BEML as well.
Okay, all right, got that point. Stay on. We'll, Sudeep, just come back to you in a bit. There's important news coming in on JP Associates, and I think we've got our colleague Ritu joining in with the latest. We do understand from sources that suitors for JP Associates have submitted conditional offers, and looks like the highest bid has come in from Dalmia Bharat. Ritu, what are you picking up?
Yes, Ruby, it's a bit of a surprise, but as we've been reporting, some of India's biggest corporate houses, Adani, Vedanta, Dalmia, Naveen Jindal and others have submitted offers to acquire Jaiprakash Associates. But there is a major catch because most of the bids really hinge on the outcome of a land dispute that is still pending in the Supreme Court. Now, in absolute terms, and there are many conditions attached to all of these bids, and not all of it is upfront, we understand it is Dalmia Bharat which has placed the highest offer at a little over 14,600 crore rupees. But if JP's Sports City land dispute in Noida is not resolved, they could reduce their offer by around 2,000 crores or even more. Now, our sources indicate Vedanta Group, on the other hand, has offered about 13,600 crores. Again, if the land was not cleared, they may withdraw the bid altogether. And then there is Adani Group's offer at about 12,250 crore rupees, which includes some non-convertible debentures as well that are payable over more than 4 years. And while the bid again is conditional, our sources indicate that Adani's offer may stand irrespective of the land dispute outcome. Then you have Naveen Jindal's Jindal Power, which is bid, we understand, about 10,300 crores, also contingent on the land matter, and PNC Infratech is the lowest at 9,500 crore rupees. Now, here's the core issue to remind the viewers. Around 1,000 hectares of land under JP's Sports City project was cancelled by YEDA, and that cancellation was upheld by the Allahabad High Court, but the resolution professional has challenged it in the Supreme Court, where the case is currently pending. Now, these are still the first round of bids. There will be negotiations with the lenders, and possible revisions are also possible, to these offers that have been made. So we'll have to see who comes out on top. The process is very much far from over.
Thank you very much for that. Sudeep, any thoughts on JP Associates, the potential buyer, or any other stock that you'd like to talk about which catches your attention today?
Well, I think, one stock which definitely catches attention is the Marico results. I think it's a very, very interesting set of update which they have given to the market. After a long time, one of these FMCG company is talking about rural demand being robust and urban demand also being stable. And that clearly reflects in their numbers. While international business has been stable for quite some time, the domestic business was the challenge for Marico for some time, and the premium hair oil category was suffering. Now, with what they have announced today, what the update they have given, I think it's a very clear signal that probably things are improving on ground, and we will have to wait and watch for the other FMCG companies and their numbers. But if the Marico trend is maintained, then I think it's good time coming back slowly for the FMCG universe.
Thank you very much for that. One more stock with a big fall today is Dreamfolks. While the negative news has been known, the stock was every day falling 1%, 2%, 3%, but today it's fallen close to about 12%. So there's a very sharp fall coming through in Dreamfolks. And now from its 52-week high, it's off close to about 63%. So big fall today. And even Global Civil Projects. This is a company which got listed earlier this week. It's still holding up above its issue price. I think the issue price was about 70. The stock is down 5% at 81 rupees, but still higher than its issue price. Ellenbury, HDB Financial Services, all the stocks which listed on the Lal Street this week are seeing a bit of a pullback today. Get into a break. Sudhi, thank you very much for joining in. As we do that, here's a reminder for all our viewers to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Okay, welcome back. A while back, you saw some important updates flash on the screen with respect to Bosch. Now, we know that Bosch, only a part of their business in India is listed, and it's the listed entity. The ABS business, which of course has been catching the headlines of late, because ABS norms will be mandatory for bikes, all bikes, even 125cc. That's been making headlines because Bosch is a big player in that space. But let's understand what is this restructuring that is being spoken of. It's an exclusive that our colleague Vivek is picking up. Vivek, break it down, totally simplify it for us. What are we talking about?
Well, that's right. So what we are picking up from our sources is that the German MNC Bosch Limited is in focus. This is on account of the fact that the company is looking to bring into its listed entity fold two key business entities which are unlisted and which are privately held by the German parent itself. So the two unlisted entities that we are looking at and that we understand will be brought into the fold of the listed arm is Bosch Chassis Systems and Bosch Automotive Electronics India Private Limited. So, Bosch Chassis Systems is the entity that actually runs and operates the anti-locking braking systems business, which was in the news recently, and we'll delve a little bit more into that a little later on, as well as the electronic systems into the listed entity. Now, this particular ABS, or the anti-locking braking system, was in the news recently because the government made it mandatory for two-wheelers to have them. And remember, this particular firm actually has close to 60 to 70% of the market share as far as that particular segment is concerned. So it will be a meaningful EPS accretive, in case this particular transaction does go through. What we understand from our sources is that the company has already appointed a consultancy firm as well as investment bankers are working on the deal. We understand that this deal is in advanced stages. Earlier today, we also wrote to the management of Bosch as well as their corporate communication team. We are yet to hear back from them, but this is going to be an important deal, especially remember, the entire auto ancillary space has been in focus. Even recently you saw a deal, something along very similar lines that came as far as the Gabriel Group was concerned, and also this particular ABS systems are in focus on account of the government regulation that did come about.
Oh, yeah, absolutely, Vivek. And congratulations on that break. This is important. The stock is reacting. It's up about 3.5% on an otherwise flat day. So just reiterating that these two entities, Bosch Chassis Systems and Bosch Auto Electronics, they will become part of the listed entity. Any idea of the size? I mean, they're private entities. So, I mean, I don't know if you would have rough numbers offhand. But you're saying this will be EPS accretive. These are largely positive businesses for Bosch.
Well, let me give you a little perspective. So FY25 end, top line of Bosch was slightly above 18,000 crore, profitability in excess of 2,000 crore. Now, both of the entities that we're talking about, especially Bosch Chassis, that is a profitable business. And again, we don't have the actual numbers because it's not a listed entity, but we understand top line was in the range of 4,000 crores. And it is a bottom line positive business. The other business, very similar 3.5 to 4,000 crore top line, but we understand that it's EBITDA positive, but bottom line may be slightly loss-making. But overall, this particular deal is expected to be EPS accretive simply because of the profitability as far as the Bosch Chassis business is concerned. And also, there are expectations from the management that this should unlock some value in terms of a higher valuation multiple being given. The closest peer will be an Endurance Technology. Remember, that particular stock also was in focus on account of the ABS mandatory rule that was imposed recently.
Yeah.
Okay, thank you.
And Endurance, by the way, just to add, because we spoke with the Kotak analyst, just reminding our viewers, Endurance has a much smaller market share in ABS. Yeah. Bosch has the lion's share of the ABS.
And now that's going to come into the listed entity, Bosch Chassis. So if you want a direct play, if the government indeed does implement mandatory ABS for two-wheelers and you want a direct play, it will be Bosch. So that's the big corporate restructuring that Vivek, our colleague, has picked up from his sources. And that's a CNBC-TV18 exclusive. And the stock is moving up even more now, 4.5% up on Bosch. Thank you for joining in. Mithun Ashwath, Managing Partner, Kiva Advisors, is now with us. Mithun, first, would you have any thoughts on Bosch and this potential corporate restructuring? And come in on the broader auto ancillary space. Any stocks in your portfolio?
Yeah, thanks, Rima. I think on this transaction, one needs to understand what is the valuation that Bosch will ascribe to these unlisted entities. Obviously, the potential is large, but like your colleague mentioned, they may not be that profitable. So we need to understand what kind of valuation will be ascribed to these companies when they are merged. But definitely a positive sign from a multinational company that they want to actually merge unlisted companies into the listed entity. Because earlier times we've seen actually, MNCs trying to go more private and, run their businesses in private companies. So this is definitely a good sign.
Okay, interesting. All kinds of things happening with these large MNCs. Big focus on India, whether it's Bosch, whether it's the other listed peer, Siemens. So much of reorganization going on. And this one, I mean, shareholders will be happy to know that some of the value accretive unlisted businesses now come within the listed fold. Mithun, hi, great to have you on. So just kind of, went on a tangent with that important news break. But let me sort of pull back a little bit and get your sense overall on the space. We're talking about capital goods. I mean, it was the market's darling for a long, long time. Then defense kind of, came and took over. But how do you look at these companies when ABS is just one small part? But otherwise, how do you look at the capital goods play?
I think, if you see the auto components or the manufacturing side, the opportunity is very large. In certain segments, it's actually, you're talking about substitution. Right? It's import substitution. So we're not really looking at, even if the Indian market doesn't grow that much, the opportunity for that substitution itself is quite large. You've seen that on the EMS side. We are seeing it now even on the auto component side. Another space where, there's tremendous focus from the government is on the power sector. And we've seen the kind of growth that the T&D space is witnessing. And there are very few companies listed focused on each of them. And I think these spaces provide good headroom for growth over the next 2 to 3 years.
Okay, got that. Any tactical trades in IT ahead of the earnings season, Mithun?
I think, Rima, obviously, most people are kind of cautious and the expectations are not too high. So I think, and IT is kind of underperformed. So I think we could see some bounce in some of these, even in the large cap names, which are kind of at the lower end of the valuation spectrum, especially considering, I think, even in the US, there could potentially be rate cuts going ahead. So I think there could be some bounce. But in terms of actual numbers, I don't think they're going to be kind of flattish, I think, even in this quarter. Most of these companies are talking about single-digit sort of revenue growth for FY26. I think it's the mid-cap IT companies where the growth is higher. And obviously, valuations also are higher there. But I think that's where the growth is expected.
Okay. Mithun, what about overall markets? Happy to deploy additional money? Or waiting by for corrections? Corrections are not really coming. The market's not running away also, but it's not correcting also. It's been fairly steady. So how are you going about it in terms of deployment now?
Yeah, I think, Surabhi, I think the market is looking at spaces where there's value or where there's very high growth. I think there are numerous opportunities which are coming by in the recent past through a lot of these M&A special situations. So that is a space that we are constantly monitoring. A number of companies have got demerged, so they have fresh listings and potentially can provide good upside. And there are some companies which still to be demerged, even on the MNC side, as we speak. So that's, I think, a space where one needs to really monitor, and bottom-up opportunities will definitely be there in that space.
Okay. The one area that has been sort of something which has always stirred up a debate in the market is defense, Mithun. The stocks kind of look at it. I mean, again, today you have an announcement, more acquisitions by the government, and the stocks are again flaring up. What's your sense? Have you taken exposure? What would the approach be now?
Yeah, so I think we've been quite positive on that space. We have taken exposures and continue to hold them. They're volatile. But again, this sort of comes to that import substitution. The government is also growing the expenditure on defense, plus import substitution is happening across the space. So, I think the opportunity for the private defense companies is going to be very large. It's the public sector companies where, most of the orders do flow in. but they are getting a lot of work done through a lot of ancillaries and private defense companies also. So there are some larger ones where, like a Bharat Forge or someone where, maybe it's not really representing in the stock prices or the market cap right now, because obviously the auto space internationally is not doing that well. It gets kind of masked. But I think, opportunities like those over the next 2-3 years will be, I think, will provide handsome upsides for investors.
So the stocks which you hold in your portfolio in defense would be?
We have, exposures to Bharat Forge. We also have BEL and HAL in, older clients, and we also have BEML.
Okay, so fair amount of defense exposure. Quick, what trend? Was it ever a part of your portfolio?
Yeah, I think for all our historical clients, we do own it. In the recent past, over the last 6 to 9 months, we've not added for fresh clients. But I think, days like these, when a company which can compound at 20-25% over the next several years definitely presents an opportunity. I think one statement at an AGM should not really be read into so seriously. But I think, this will present an opportunity for long-term investors.
And finally, before we let you go, Mithun, capital market stocks. Again, I have to ask you, same thing, always a big debate in the market. What sense do you get? I mean, I don't know whether this Jane Street episode is going to have any lasting impact or not. But in general, positive, negative, neutral?
Honestly, this is one space that we kind of missed, I think, a couple of times. Even in the Jan to March correction, they, I think, all fell 30-40%, then bounced again. But I think what's happening here after this Jane Street issue, there could be changes in terms of regulation, in terms of how many expiries you have. Do you have weekly expiries at all on the Nifty? We don't know what SEBI is going to do. So that is something, because obviously earlier we never used to have that. We used to have monthly expiries. So if they want to actually curtail speculative activities, I think that's what the market reaction is. But I think the wealth management sort of distribution-led companies, I think those are more of a secular trend because of financialization. I think that's a space which I think if there are corrections, one needs to definitely revisit and relook.
Okay, thank you very much for that. Get into a break. We'll come back and get a check on what dealing rooms are saying in our segment, D Street Chatter. Nimesh will join in.
Welcome back. There's some green back on the screen, so it's not so bad. Actually, the market's perked up quite nicely in the last half hour. Look at that. The Nifty, I mean, when we started off was so sluggish, and from the lows of the day where we were almost sort of going down to 25,350, now it's a very nice, smart 100-point recovery on the upside. So good time to bring in Nimesh. Nimesh, I don't know if it's Friday factor or something else, but suddenly the screen is looking brighter.
But you know, you might see that the screen is looking brighter today, but actually consolidation was the buzzword of this week, right? Entire week has seen in a very narrow range. The markets have been, or the Nifty and Bank Nifty both have been in a very narrow range, and there is real lack of participation or lack of triggers as well, so to speak. So I guess the big trigger to watch would be, of course, the US-India trade talks and trade deal. That would be a big trigger for markets, and of course the earnings season. The initial reactions are pretty sharp for the Q1 updates in many stocks. We saw what happened to trend today. But you know, again, I'm not saying a big reaction to in terms of flows or, for that matter, any directional moves in the market, at least in the very short term. I guess the big story of the day was the SEBI order on Jane Street, and we saw a big reaction to the capital market plays today. So BSE, Nuvama, Angel One, all are under pressure today, and there is a sense that maybe you'll see a bit of impact on the volumes in the very near term because of this SEBI order, interim order. So that's one big where we saw a big accident today. From a flow perspective, one thing which has been consistent of late is the buying in the PSUs. Today, for instance, the OMCs stand out in terms of big buying as well as the PSU bank stocks. So the one consistent theme has been a bit of outperformance in the PSU names, but otherwise it's been a week of consolidation, and so is the trend today as well.
Yeah, absolutely. And trend to case in point, I guess, that the market has absolutely no mood for any disappointment at all. It tells us how to prepare for the earnings season as well. Ramesh, what about individual stocks? What buzz are you picking up today?
So the first stock on my list is DCM Shriram. The stock is down 4% in today's market, but yesterday the stock rallied 15%, and the volumes were on the higher side. And the sense I'm picking is that maybe there is a corporate development around the corner in DCM Shriram. It's a kind of a conglomerate. There are a lot of businesses, and there could be potential value unlocking there. So that's the buzz as far as DCM Shriram is concerned. That's the first stock. The second couple of the PSU names, PSU bank stocks, both Union Bank and Canara Bank, both stands out in terms of very aggressive FI buying today. So expect high delivery volumes in both those names today. And the last stock is Z Entertainment. We've seen a bit of a outperformance in Z as well in the last few weeks. Ever since, in fact, the promoters have announced to put money via preferential warrants. But now there are first signs of some bit of institutional interest back as well in Z Entertainment. So there is a very small buy flow, but nevertheless, there is buying interest from larger FIs in Z Entertainment at current price.
Thank you very much for that. Mitesh is now back with us for a few trades. 15 minutes to go. Mitesh, what do you have for us?
See, Infosys, something which is climbed up to the or near the day's high. So BTST there with a stop at about 1631 for targets of 1665. And the other one is the refinery pack is also doing very well. So I've taken HPCL as a BTST with a stop at about 438.5 and a target of around 452.
Thank you very much for that. Now let's get back to the big story of the day, and that's SEBI issuing an interim order barring Jane Street Group from the Indian equity markets and impounding gains of about 4,800 crore rupees on account of index manipulation. We have with us senior advocate H.P. Ranina joining us on the show. Thank you very much, sir, for joining in. Kindly share your thoughts on the subject. How strong a case does SEBI have, or what Jane Street has done is still very much within the rule book? So they've amassed profits, but there's nothing wrong in what they did in terms of the strategy. So legally, what's the standing of both the entities?
Well, making profit certainly is not a crime or illegal, so long as it is made in conformity with the rules and regulations of SEBI. Now, the question is, they have imposed certain very strict orders saying that you cannot trade, your assets will be frozen, will be kept on the check. There must be some reason for this. I don't know exactly what the facts are before SEBI, but obviously SEBI has made an investigation. They must have taken their own time to do so. And based on that investigation, have come to the conclusion that certain things have gone wrong. They have not acted in conformity with the rules and regulations of SEBI, and therefore they have made gains which are not legally justifiable. Therefore, they have frozen them, they have put them under escrow, and they have passed certain orders. Now, what does Jane do? Jane Street Group will have to go in appeal. to the SEBI Appellate Tribunal and prove its case that whatever SEBI has done is wrong because they have acted in conformity with the rules and regulations, and therefore SEBI's action is unjustified in law. So that's all that the Jane Street Group can do and get some relief from the Appellate Tribunal. And if they lose at the Appellate Tribunal, then of course they can also go to the Supreme Court as the final authority.
Absolutely. So this could wind up all the way at the apex courts, or absolutely take that point. Yeah. I think the central point of the arguments, and we'll know more as this moves through the various forums and courts, I guess the central point is going to be whether taking opposing positions, or, trading strategies where your positions in the cash market might be different from your positions in the futures and options market. I mean, technically, as far as we are aware, it's not against Indian securities law. But then market manipulation or market abuse, that's a totally different realm. So do you think the law currently, securities law as it's currently framed, it will give enough powers, or it gives enough powers to SEBI to check what the regulator feels is market abuse?
Gurpreet, the important point is that is a matter of factual data. The rules and regulations are always there. They are very general in nature. It is for each entity to ensure that they fall within the four corners of the rules and regulations. Now, as I mentioned earlier, SEBI has made some investigation because they don't take any action without taking proper steps by way of investigation. At the most, SEBI could have ordered a sort of a forensic audit into the accounts to prove that what Jane Street has done is totally wrong. So it's a matter of facts. Based on facts, they have come to a conclusion that there has been a gain which is not justified in law, and therefore they have taken the action which they have done. So let's see whether the factual position is justifiable. And as I said, the only solution now for the Jane Street Group is to go to the Appellate Tribunal and prove their case before them.
Mr. Ranina, since this is, a big crackdown against a global giant, we've seen SEBI act in the past, whether it's in the case of co-location, etc. But this time, considering that this is one of the largest, algorithmic high-frequency trader in the world, what kind of a signal does it send?
Well, the signal that it sends is that however big you may be, you're not above the law. And if you've broken the law, we'll take action against you. Now, in the past also, as you know, SEBI has taken action. Sometimes that action has been justified. Sometimes the Appellate Tribunal has said the SEBI was wrong. So therefore, the only solution is let them go to the Appellate Tribunal, let them prove their case, let them bring out the facts and figures, let the Appellate Tribunal feel whether the SEBI action is justified or unjustified, and thereafter, of course, the consequences will follow. But this only shows that rules and regulations are rules and regulations all over the world. They have to be upheld, and however big you may be, you may still be in contempt of the rules if you have not followed them strictly in accordance with law.
Which sounds absolutely morally upright, and it's something that I'm sure all investors in India would want to see, an orderly, regulation of the securities market, sir. But the issue is it has to be held up in court. Yeah. So now I go to a wider question, and again, to Rima's point, even I don't remember in memory when India's market regulator has taken on a very sophisticated, very large and deep-pocketed global trading firm. Do you think that, SEBI perhaps will have the teeth, the tenacity that would be required to fight this all the way out?
Well, they'll have to fight it out. Having taken this stand, having taken this action, SEBI will have to justify its action before the Appellate Tribunal. And with all due authority, they'll have to do it. Now, the Appellate Tribunal, as I said, may order a forensic audit in the accounts to ensure that whatever has been done is contrary to law or not contrary to law, that they have acted in conformity with law. And if that audit shows that they have acted in conformity with the rules and regulations of SEBI, then the SEBI action will be set aside. It will be quashed. And of course, Jane Street will be vindicated.
Okay. All right, Mr. Ranina, we'll leave it on that note. Thank you for the perspective. I think we'll require your wisdom again. I'm quite sure if this indeed goes up to the higher courts as you're also envisaging. So we look forward to more perspective and more support from you. Thank you so much for joining us this afternoon. Well, on that note, we'll take a very quick break. And as we do that, here's some good news coming in for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or from Google Play, or you can, of course, scan the QR code on your screens as well.
Welcome back. There's one more stock we didn't chat about, and that's Bharti Hexacom. So today, Macquarie has double downgraded Bharti Hexacom. From an outperform, it's come all the way down to an underperform. And this is after the stock has near doubled in the last 1 year versus a paltry gain of just 6% for the Midcap index. So big gains and big outperformance for Bharti Hexacom. And that's the reason why Macquarie has downgraded it. That said, let me make it clear that they like the company. They like the fundamentals, they like the return improvement, the higher ARPU, and they've in fact kept a target price of 1480. But in the bull case, the target price is actually at 1900, which is where the stock currently is. But base case, they do see the stock headed to 1480. We have with us Hemang Jani joining us on the show. Hemang, thank you very much for joining in. Well, the big stock of the day is Trend. What are you advising clients now to do on Trend? What if the new normal is a 20% growth for Trend? If that is the case, then where should the stock settle at? What would be the appropriate valuation and stock price for Trend?
Yeah, hi Rima. Thanks for having me. So clearly, I think what has happened is that the trajectory of the growth has been steadily coming off Trend, somewhere around 35-40%. Just recently, about a month back, we had indication coming from management that the growth on a sustainable basis would be 25%. And definitely this update came as a bit of a shocker. And in the meantime, the stock continues to trade at very high valuation, somewhere in excess of 60 times FY26. So I do think that there is a case for some sort of readjustment, and also clear is that this is just there is a sense that there is going to be a lower growth trajectory for longer time. So we would definitely avoid buying into it till we get further clarity from the management about the growth trajectory. So for the time, we'll avoid.
Are any of the capital market plays, the Nuvamas, the Angel Ones, the BSCs, which have tanked on the back of this Jane Street? Because this episode is going to play out. It's not done in one day. Tomorrow there could be good news, day after there could be bad news. So in light of that, with this overhang on these capital market plays, what would be the approach to stocks now?
I think definitely some of the listed companies, be it Angel One, Nuvama, of course, because Jane Street had their tight relationship with them, so there is going to be a certain amount of impact. But I think that BSC, the impact looks to be a bit exaggerated, because at the end of the day, when it comes to weekly option expiry, there is not going to be a significant impact on their volumes, and at some point things are going to normalize. So if there is any significant correction in BSC because of this, certainly look at buying into it. But I think discount brokers, we have to wait and see how much the impact could be in terms of volume, because at the end of the day, a large part of the volume that they are getting, the revenue that they are getting, is from the expiry day phenomena, where some of the hedge funds and Jane Street was a major player. So definitely we would like to avoid those names, at least in the near term.
Many of these gas stocks are higher. IGL, MGL, and PNGRB has come out with an amendment. They're planning to reduce the number of zones from 3 to 2, which will bring down the complexity, perhaps have uniform pricing. Explain it to us. How does the PNGRB news impact a company like IGL?
As far as natural gas pipeline tariffs are concerned, are definitely positive for some of the companies like IGL, where we think that the benefit could be to the tune of about 0.7 per SCM. And we do think that more than anything else, it reduces a certain amount of competition, and there is going to be a fair pricing as far as natural gas is concerned. So we think that overall it's definitely positive, but the biggest beneficiary be IGL, given that their margin and earnings upgrade be to the tune of about 12 to 14 rupees per share.
And finally, pharma is doing pretty okay. You've got a Dr. Reddy's with a gain of close to about 1.5%. A couple of the others like Loris, Natco, Aurobindo Pharma, 2-3% up on that. Marksans Pharma, Zydus Life, Lupin, all in the green. What's happening here?
I think, Rima, two things. One is, of course, the quarterly previews, where some of the companies like, let's say, Aurobindo and Lupin, we do think there could be a decent amount of growth. And as far as API players are concerned, I think Laurus Labs, after a gap of almost about 2 quarters, you see a very significant earning upgrade. So that is what is probably driving some of the stocks, and also maybe some sort of if we have trade deal with US, which could happen over the next few days. Of course, pharma may be separately looked at, But there can be some relief for some pharma companies where, because of earlier concerns, the sector itself did not do well. So we do think that there will be some relief if we have, some sort of a treaty with the US, and of course the quarterly reviews. There can be some positive surprise in terms of growth.
Hemang, thank you very much for joining in. Enjoy your weekend. Like a minute to go as we wrap out the trading session and the trading week. The Nifty is closing with a minor gain of close to about 0.6%, though for the entire week, the Nifty is going to end with a cut, a little more than about 0.5% on the Midcap index, while the Nifty is going to see a gain of about 0.5%. Banks did well today, courtesy an ICICI Bank, which lifted the index towards the close of trade. Bajaj Finance, on the back of the 24% AUM growth, was the top gainer. IT stocks gaining ahead of the results from TCS next week. Infosys, Wipro, HCL Tech, all on the buyer's radar. On the way down, Trent was the biggest casualty. The street disappointed with the mere 20% revenue growth, in Q1 as per the provisional update. You've got a Maruti Suzuki, Eicher Motors correcting a bit, Tata Steel under pressure as well. On a couple of the other names which deserve mention, Bosch, Marico, L&T Finance, AU Small Finance Bank. These were some of the updates that we got that the street liked. Capital market plays, Nuvama, Wealth, BSC, Angel One, Weekend Trade. The Jane Street episode played out, and then you had Dream Folks. Another down day, 13% gone on that. We leave the Nifty above 25,450, a gain of about 60 points, but for the week, we're still down close to about 0.6% at the index level. That's a wrap on Closing Bell. Thank you for watching. Don't go anywhere. Editors Roundtable is up next.
market snapped its 2-week gaining streak. The Nifty and the Sensex are down just about 1%, but the mid-cap part of the market has held up rather well this week. Over the next 30 minutes, we will decode the week gone by on Dalal Street, tell you, of course, what the key events are that we need to track and watch out next week. And, of course, the IT space is going to be in sharp focus as earnings season kicks on. So we look at that. And FMCG is the biggest, hottest debate in the market right now. So we'll have Nimesh weigh in on this as well. I'm Surabhi Upadhyay, and you're watching the Editors Roundtable with me, editors Nimesh as well as Reema. Guys, thank God it's Friday. The market has had its fair share of news. But before we get started, we want to welcome in Anand Shah, CIO, PMS and AIF at ICICI Prudential AMC. Anand, you just made our Friday better. So good to see you in person in our office.
My pleasure.
Thank you for coming.
Absolutely, my pleasure.
So, guys, what do you make of the week?
Kind of a lull before the storm, I would say.
You are stealing my words, huh?
It was pretty much quiet. Pretty much quiet. We are not used to, right? We are not used to this kind of a market. So, no major block deals, no major news. Of course, Jane Street was a big news today, but otherwise, it's been even the Nifty, Bank Nifty has been pretty much range bound. True. I guess market is just waiting for some trigger to either go up or go down, right? There was nothing for this week. So I guess earnings will be a big trigger to watch out. We need to wait and watch as to what happens to the India-US trade deal. That will be a big trigger for a lot of sectors and stocks. So I guess lull before the storm. So let's hope it's turned out to be a better week next week. But yeah.
Ranged but resilient.
Ranged but resilient.
Yeah, I think that's how we could just,
that's a good way of putting it. So let me quickly recap the week's numbers and then we'll go forward. I mean, like Nimesh has been saying, completely agree with that. It does feel like this is the silence before the storm. Now, let's hope the storm turns out to be, optimistic and in favor of the bulls. But what we're talking about is a complete consolidation through the week. The Nifty being in all of a 250-point band. I mean, the trading range also wasn't very wild. So it wasn't a very choppy or volatile week. It's just a quiet week. The Nifty, by the end of it, ends down 0.7%. But the mid-cap index and the small-cap index, they've managed to do well. The action has been all about individual stocks. Just to give you very quick color, in terms of the movers and shakers, the ups and the downs, the gainers this week included the consumer durable space. There was a fair amount of defensive play in the market, so pharma and healthcare have done really well. The big news of the week, of course, was Apollo Hospitals with its mega restructuring. That stock is a Nifty winner this week. Then you've got PSU banks that have done okay. Defense was a good shining spot on Friday again, thanks to the big defense acquisition proposal being cleared once again. And IT is actually approaching its earnings in an optimistic way. The IT index is up 1%. What didn't work? Real estate is one, but financials have been uncanny. And across the board, look at the private bank space, look at the Nifty bank underperforming, look at the capital market stocks by Friday. They were also down quite a bit. So that's something to keep in note. Now, why are we saying that this is probably the silence before the storm? Because the market is running into some very, very important events. The first of them will be earnings, and we'll discuss that with our expert in just a bit. The second is going to be the shape and form of US tariffs, and of course, the India-US trade deal. And the third is going to be the GST Council meeting, which could be far more than small tinkering here and there, and it's set for July. Quickly to sum it up, in terms of US headlines, and there's a lot to digest there as well. Now, what has the US president said? We know as of Friday that he said that letters will start going out to countries as soon as Friday itself. And he's saying that the final tariffs can range anywhere between 10% to 70%. And he's saying that countries will have to start paying these tariffs by the 1st of August. The critical question is, where will India be in this context? We know that we're negotiating a hard trade deal. There are still sticky areas like agriculture, like dairy. The key question is, can we, for instance, stitch a more favorable deal than Vietnam? Vietnam got 20%. Can we do better than that? It will suddenly make our export-oriented sectors and maybe stocks like textiles, etc., a lot more competitive. So plenty to digest. Completely concur with Nimesh. Enjoy the silence and a little calm before the storm begins.
Oh, absolutely. But let's ask Anand, you manage a lot of domestic money. What's your sense now? Is the easy money phase out of the way now, and it's going to be very much correlated to what the earnings is going to be for Indian markets?
Indeed, I think while it's all about this week, but let me give you 4 year and 4 month. Actually, since 2020, we had a very, very stupendous earnings growth rate. Profit to GDP moved from 2% to 4.7. So in a way, over a 4 year, we had 35% CAGR growth in the earnings. Now, that's not sustainable.
Okay.
And at this elevated levels of profit to GDP, we believe there's very little room for further profit to GDP to move up. To that extent, yes, we should expect 11 to 12%, which would be nominal GDP growth rate. That should be the overall earnings growth rate.
And that should be the market returns as well, you feel?
Yeah, in the long run, the market returns are, again matching almost within a percentage points of the earnings growth rate, which is logical also.
But this is a safe answer. I mean, naya all-time high hoga ki nahi hoga? You know, that's what people are really fixated on. Ki abhi kitna upar jayega by Diwali?
Few percentages of it.
So on that, I was again saying that this week, while it's boring, but I'm happy it's boring because sometime in February, we were looking at market down 18%.
Mid-caps down 30-40%.
80% of small caps were down 30% from their all-time high. 60% of mid-caps were down 30%. So it was really, we've forgotten all that in 4 months.
That's true.
But we had a good 4 months. And within that also we had Tariff, the Liberation Day. Then we had Israel and India, Pakistan. And then obviously
Middle East.
The geopolitical risks, sharp hike in oil, all those things we have digested. So I think market's been fairly resilient in this.
So, Anand, just to set the context then for today's discussion, you want to quickly tell us your portfolio construct. What do you like? How is your portfolio shaped?
Yeah, so we were actually more overweight manufacturing, which was actually the reason why the corporate profit was fairly low from 2010 to 2020. And the background to that is actually we had a sustained pressure on pricing from China on most of the manufactured goods. As I say, from safety pin to boilers, from tires to tiles, whatever you would need, China would be happily supply you at a very cheap prices. So that was, and the corporate profitability was very low. On top of it, the banks, which is another big leg. There also we had asset quality reviews. So 2015 onward, we had a difficult times in banking also. Around September 19 is when we had a corporate tax rate cut, and then and since then we saw some revival in the profitability. So we were overweight manufacturing, we were overweight corporate banks, PSU banks, capital goods which were manufacturing aligned. That's played out beautifully over the last 4 years. We were underweight FMCG, IT, pharmaceuticals, more defensives which had done extremely well from 2010 to 2020. Over the last couple of years, we have added a few of the consumer services businesses. Telecom we always had. We have added airlines, diagnostics to some extent, or organized retailing. These are the areas where again the growth is a little better than the nominal GDP growth rate.
Okay. Organized retail brings me back to Trent. I know Anand is not going to answer specific stocks, but actually before we get to IT, which is the piece that Rima is doing, very quickly, since you mentioned organized retail, I mean, these are different companies, whether it's D-Mart, whether it's what Trent is doing, and the market gets used to high growth. So when Trent was delivering 50% growth, people were willing to pay top dollar, even 90 times P didn't matter. Now Trent is saying 20-25%, and the market is in no mood to listen to it. So, what is your thesis when you talk organized retail?
So again, the growth, so I was telling Nimesh also that we have seen from the heydays of, when we're just at the infancy of modern trade, malls came through and the organized retail just took off. We have come a long way, all the way, and then we have success stories of D-Marts and quick commerce more recently. So I think the key is it's a difficult business. It's a tough business, a low margin business. And to that extent, your debt needs to be under control. You need to be more equity funded. But more importantly, you need to have costs under control. So you need to survive. And you need to be making money on a very thin margins and remain relevant for the customer value. You'll have to continuously offer value.
Absolutely.
That's some learnings over the last 10, 15 years where we've seen ups and downs in organized retailing. So I think that remains the key. Yes, growth sometimes are too good, sometimes. But I think in the long run, organized retail still will grow faster than the nominal GDP growth rate. As more and more people move from the traditional retail to more modern retail.
That's a long-term thesis that's still intact. More on consumer in just a bit, actually, with Nimesh. But Rima, IT sector, is it going to be a shubh start for earnings season?
Looks tough, right? But it starts on 10th of July, so that's the first date you need to keep in mind. The good news is that at least things haven't gotten worse compared to the March quarter. Yeah. So the situation hasn't deteriorated, but it's not gotten better. And these are the numbers. So usually the June quarter is a seasonally strong quarter. Q1 and Q2 is when IT companies typically deliver very strong numbers, but not this time because discretionary demand is still very much compressed. In fact, 4 out of the 5 Nifty companies, large cap companies, are likely to report a top-line degrowth. That's point number 1. Secondly, in terms of the full year guidance, we're still looking at low single-digit revenue growth. Infy, according to our poll, might raise the lower end of its guidance from 0 to 3. We're looking at 1 to 1.5%. But again, we're talking about the lower end. If the upper end is raised, it's courtesy the acquisition. So again, nothing meaningful. And even for HCL Tech, analysts point out the lower end could be raised. But in a nutshell, what we're looking at is a low single-digit kind of a revenue growth. Here is where things are a little more exciting, and that's the mid-cap performance. As you can see, while large-cap IT companies are likely to report a top-line, degrowth, mid-cap IT companies, look at a Coforge on account of that Sabre deal. That's 6.5–7% kind of a constant currency revenue growth. Persistent has been persistently growing at 3 to 4%. And despite all the tumultuous times, it continues to deliver on that. Now, the question is, now let's stack up the stock price and the valuation. Now, at least this year, the Nifty IT index has trailed the Nifty. It's underperformed by nearly 17 to 18%. Valuations on a broader, if you look at it in a broad bucket, the Nifty IT is trading similar to its last 5-year average. So no aberration over there. But the mid-cap IT companies are trading at a 38% premium to the large-cap IT companies, according to research from Jefferies. But the question is, mid-cap IT companies have done very well. They've outperformed the large-cap peers, and valuations today are very expensive. So what does one do? Now, this is what the EPS growth is for the large-cap IT companies over FY25 to FY27. Basically, we're looking at a mid to high single-digit kind of EPS growth. But for the mid-caps, we're looking at a 20 to 30, 40% kind of an EPS growth, 40% for Coforge. So this is what justifies the premium valuation multiple that many of these mid-cap companies are enjoying. Anand, I know you said that, at least your bias has been more towards the manufacturing themes, the banks, etc., and less towards IT. But now looking ahead for the next 4 years, considering that they've gone through a period of price and time correction, do you think things can get better from them?
Indeed, I think the inefficiencies in the market are actually reduced in the sense what looked like an easy market in 2020, 2021 to pick something which was going to grow faster but was very cheap versus something which was very expensive and was expected. So we were very domestic oriented. Even today, our bias remains for the domestic economy because that's the more resilient part of the economy. I think as soon as you move out of India, you have all sorts of challenges. And US is among the largest customer for IT services, and you know what's happening there.
And there's AI, there's generative AI,
Exactly.
which is changing the game completely.
So as it is your customer and the challenges in US and the rest of the world, which is growing much slower than India, poses a certain risk. But yes, you're right. AI is another uncertainty, or what it means. Whether it will be positive or negative, only time will tell. But I think the important point is what's in the price. I think the other challenge for us, and we've seen IT every now and then rallying 20%, 30%, but it's in the end has done nothing. So it does give that,
trading
risk,
rallies. Yeah,
trading rallies, because the valuations where they trade and the earnings growth rate that we are expecting from them, there's complete mismatch. And that's the key challenge that, if the growth, if they are ex-growth companies, they're not trading as an ex-growth companies. Let me put it.
So IT is in a while, even mid-cap IT, where there is a little bit of growth.
No. So yeah, we are more bottom-up. We have a couple of mid-cap names here and there in our portfolios. But as a broadly speaking, we have never been able to get there yet to buy big way the IT in our portfolio.
Hard for, I guess, Anand to get excited when Rima puts those big numbers on the wall. It hits you. A company like Infosys is 1.5% to 3.5%
I'll give you more numbers.
Oh, okay.
Like some levers and ITs.
Oh my goodness, yeah. We're looking at keeping growth expectations low. No, we've discussed IT, actually the next big sector where actually there's a bigger debate now. And there is a bull camp and a bear camp at play together. That's the FMCG space. Is a turnaround coming, perhaps as soon as this quarter? We'll discuss this after the break.
Well, we all know that the FMCG leaders have really underperformed in the last many years. In this raging bull market, they've not done well, and they've struggled with growth as well because of various reasons, including disruptions as well. But the big question is the tide turning for the FMCG sector finally? I'll come to that, why I'm saying there could be a turn in tide as well. But first, the key numbers on how they've underperformed massively in the last 5 years. This is quite stark, right? Most of the FMCG leaders have massively underperformed in the last 5 years of this raging bull market. The first sets of underperformance will come up on the screen, which includes the likes of Bajaj Consumer, Dabur, HUL, and these are the 4-5 names. Now, this is a 5-year return CAGR. HUL is flat in the last 5 years, and Dabur has actually given negative 2% returns in the last 5 years. So this is the first bunch of companies, stocks which have underperformed. But this is marked by equally the weak earnings as well, or the revenue or profit CAGR as well. Look at Bajaj Consumer, or for that matter, Dabur and HUL. Mid-single-digit growth for both Dabur and HUL over the last 5 years in terms of revenue CAGR, operating profit CAGR, as well as net profit CAGR. So they've actually not done well in terms of numbers as well in the last 5 years. This is the first bucket which has really underperformed. The second set of stocks will be the stocks where you've seen marginal outperformance, but again, in the context of the market, they've underperformed. Colgate, GCPL, United Breweries, Tata Consumers, Britannia, Marico, all have actually done 9 to 12% returns over the last 5 years. I'm talking about 5-year CAGR returns for this company. So again, massively underperform in the context of the way the markets have done in the last 4-5 years. Even here, the story is quite similar. You will see a lot of companies have actually reported very muted growth over the last 5 years in terms of profit, in terms of operating profit, as well as in terms of revenue as well. ITC, United Brew, at least those stocks have underperformed. Now this is the pack which has relatively outperformed. So there has been a few outperformers as well in the FMCG basket, and that's largely the sin stocks. What I mean is the likes of ITC, United Spirits, Global Spirits, Cupid, Tilak Nagar, all have done well in the last 5 years, especially, and here it is backed by earnings growth as well. Look at something like a Radico Khaitan, double-digit growth there. Godfrey Philip, double-digit growth there. So is the case with Tilak Nagar Industries. They've done phenomenally well in terms of numbers. So, as I said, FMCG as a sector has been very selective, but large part of the basket has really underperformed big time versus the market. Now is the tide turning, and that's when potentially from here on what's to watch out for. The big thing is the GST rate rationalizations. That could be a big trigger for the FMCG sector to watch out for. So that's the first reason why I'm saying just watch out for some potential tailwinds. The second is a good monsoon, which typically is good news for second half for these FMCG companies. The third reason is the government focus now finally shifting from capex to consumption. This was a big focus thrust in this budget, so that's something to watch out for. And of course, last but not the least, the income tax cut again is aimed to boost consumption, which might see in the second half of this year. So there are a few tailwinds to watch out for, but the bottom line is in the last 5 years, FMCG sector has really underperformed, and the big leaders have actually not done well. In fact, they've given negative returns over the last 5 years compared to the big bull market that we've seen in the Nifty. Anand, I just put out the data on how HUL and Dabas have actually given negative returns of over 5 years. What's your take? You have a bit of a negative view on the sector, but is it tide turning now for the sector to watch out for?
No, so again, you have to see the 5-year is a long term, but in a way it's also short term, because if you see the previous 10 years,
absolutely,
they were the darlings of the market. So there is, in a way, some bit of a reversal to mean. And you would see that the earnings growth being muted and still the valuations are no cheap yet, right? The other thing that's happening with consumer companies is also volume growth, one issue, competition. And more importantly, organized retail means that the ownership of customer will move slowly, gradually from the manufacturer to the retailer, which means the moats are shifting, and to that extent, eventually you might see a derating in this sector also. I'm not yet, calling it out, but I'm just saying. So those are the risks there. But I think the key point both in IT and FMCG remains that the earnings growth is fairly muted, and they were looking good in 2010 to 2020.
Are there any signs now yet, or you're not still finding any signs of volume uptake or numbers coming back or growth coming back?
Personally, I would want both the companies in IT and FMCG to stop paying out all the profits as dividend and buybacks and put that back into the business. The challenge is they're very large businesses and they're not making enough investments to get new product lines or new revenue drivers. The existing base of customers have consumed products and they're moving to services. If you see, as the per capita income goes up, the incremental spending happens in services, experiences, rather than products. Even around us now, we are spending 30 times more data. Telecom services, we are spending 2 to 3 hours a day. And that's less consumption of products when you're consuming more of telecom services.
On a lighter note, looking at Nimesh's data, I realize that it's less toothbrush and soap and all, more sin. We're sinning more. Basically, that's what's happening.
So all your ITCs and your
tobacco and the Tilaknagar company.
Okay. Anand, we are short of time, but I want to take your view on metals, because that's a bit of a contra view that you have.
Metals and manufacturing.
You've been bullish on metals. So, tell us your rationale.
So again, the genesis is that 2010 to 2020 was very tough for manufacturing in general. And if you have survived those difficult times, means you had a right to win, you had some moat, you had some sustainable competitive advantage to survive. As we move forward, and especially in metals, select chemical companies, and even in textiles, we believe India has, in pockets, there a right to win. We have raw material advantage in cotton textiles. We have raw material advantage in iron, in aluminium, bauxite, iron ore. And to the extent we have a right to win, but we are not winning as much. And because you have China, which is exporting 100 million ton of steel, while they don't have raw material advantage. And if you go back and see the data, they're not even making money on those exports as much one should be making. So our take is that this is economically not sustainable.
So
economically, for a country to export, polluting their own nation and still exporting at loss.
But then metals is still global facing. If there's dumping of steel in China, it's bound to impact Indian companies. So what's the thesis?
So I think it's not a challenge for India, it's a challenge for
China.
China itself. The government wants them to reduce production. Last week, only one of the news flow where they're cutting back production in especially the old polluting steel plants, which are not.
We saw our steel stocks go up.
Exactly. That one particular day globally. The second challenge would be for the not so competitive steel plants in Europe, and they have to figure out how to deal with it. I think India has put the safeguard duty. Is 12.5% enough? Do we need more? That's the debate going around today. So my point is that if we don't protect, then we will eventually have to import steel. So that's not something we should do.
So metals, watch out for metals and manufacturing.
Manufacturing, select manufacturing. Again, there's a lot of excitement in manufacturing at the high end. I believe what will China let go in terms of manufacturing will be more low end, more people intensive, more to be very honest, energy intensive. Whereas they'll keep the high-tech manufacturing and maybe continue to invest in high-tech manufacturing. So I think the old economy manufacturing is the basket we are continuously looking at.
Okay, interesting.
Very interesting.
Very interesting thoughts. And different thoughts, right?
Yeah, very contra views. Nice to hear metals and
old school manufacturing.
Yes,
Okay. Leaves us with plenty of food for thought over the weekend and the weeks ahead. Anand, thank you so much for dropping by. And we hope to do this more often with you. So thanks for being here.
My pleasure.
Thank you.
Thank you.
Well, with that, it's a wrap on this week's edition of Editors Roundtable. Have a great weekend, and we'll see you with the markets bright and early on Monday morning.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the top headlines that we're tracking for you this evening. Sensex and Nifty recover in the last hour to end with minor gains on Friday, but indices snap a two-week winning streak thanks to a sharp fall in financial stocks. SEBI bars American trading firm Jane Street from Indian capital markets alleging market manipulation. Interim order seeks to impound gains of more than 4,800 crore rupees, the largest asset seizure by SEBI till date. Jane Street disputes the findings and says it will engage with the regulator. Reliance Retail moves the company law tribunal for an internal restructuring, seeks to house the FMCG business under new Reliance Consumer Products, which will be directly under Reliance Industries. The move could set the stage for an IPO. Dalmia Bharat is the highest bidder for debt-ridden JP Associates with 14,600 crore rupees, followed by Vedanta and Adani. Most bids are conditional offers and hinge on resolution of Sports City land dispute. President Trump says US will start sending letters to countries specifying what tariff rates will be imposed starting today, floats potential tariffs in a wide range of 10% to 70%. No official word yet on a possible mini trade deal between India and US as the 9th July deadline looms. U.S. lawmakers passed President Trump's sweeping spending and tax bill, handing him a first major legislative victory in the second term. Democrats call it a dark day for the country. The bill is estimated to add more than $3 trillion to the U.S. national debt. India is always top of the list and presents a huge opportunity, says the global CEO of Deutsche Bank, Christian Sewing. The bank has recently pumped $800 million into India. That's an exclusive. More than 60 people are dead as torrential rains and cloudbursts wreak havoc in Himachal Pradesh in the last 2 weeks. The state estimates property damage worth over 400 crore rupees. World chess champion Gukesh beats world number 1 Magnus Carlsen once again. Chess legend Garry Kasparov says questions can now be raised about Magnus Carlsen's domination of the sport. Straight to the day's market action. Sensex and Nifty recovered in the last hour of trade and ended the day with marginal cuts. Nifty held on to the 25,400 mark, and this was largely supported by IT stocks and ICICI Bank. For the week, however, the market snapped its 2-week winning streak, with Nifty and Sensex falling 1% each. The mid-caps outperformed the benchmarks, also gaining nearly 1%. Surbhi Upadhyay joins us now with the day's market action. Surbhi?
Well, it's been a Friday that ended pretty much in sync with how the rest of this week has been, and the week has been all about consolidation. The Nifty moving in a 250-point band and really unable to make a decisive move on the way up. The bias in this consolidation has been slightly negative, though Friday was better. At least we didn't break through on the downside of the recent trading range. So let me talk about how the numbers stack up. The Nifty is down just about 0.7% for the week. The mid-cap index and even the small-cap index, they've done better. Those indices have managed a 0.3, 0.4% kind of a gain for themselves. So the issue with the market largely is the large-cap space, where there's no clarity. It seems the market is pausing ahead of big triggers that are coming up ahead. Number one would be earnings. Number two, of course, would be clarity on US tariffs and our own deal with the US, the India-US bilateral agreement. And number three, the upcoming GST meeting, which could offer far more clearer clues on what it means if there are any major slap changes. FPI flows have been patchy right throughout the course of the week, and that explains the selling on the large cap side of the market. The market's also been reading into a lot of the first quarter updates that came through. Case in point would be Trent, and that gives us a sense of how the market is positioned. Trent came out saying that they have had 20% revenue growth for the quarter, which is far slower than what Trent has been doing in the past. The result, a 12% crack on the stock. So it's telling you that the market has no appetite for poor earnings or for slow growth, especially where stocks have already rallied. Let's talk about some of the key gainers of the week. The gainers included the Consumer Durable Index. Healthcare and pharma did pretty well today, a little bit of a defensive bias in the market. PSU banks did well. Defense saw buying. On Friday, we had the news of the Defense Acquisition Council looking at procurement of proposals worth over 1 lakh crores. So a lot of the defense stocks were up and about. And the IT index has done well, 1% up, as that's the next big event. We start off the season with IT earnings. So IT stocks actually seeing some buying ahead of that event. Talking about the losers, real estate was down a little over 2%. And then it's the entire financial landscape. Whether you're looking at the Nifty Financials Index, the Nifty Bank itself, which has been an underperformer, or the capital market space. By Friday, we had the Jane Street episode, which was further weighing on sentiment, but that remains, a soft area for the market as well. We have to go forward and look at, of course, the big headlines from the US, including how markets will react to the passage of the big, beautiful bill. Because remember, yields have been spiking up right after the jobs report. So promises to be an action-packed week ahead.
An action-packed week ahead indeed. Thank you, Surbhi, for those details. Now, market regulator SEBI has imposed an interim ban on US-based trading firm Jane Street Group and its related entities from accessing the securities market. Now, the entities will be prohibited from buying, selling, or otherwise dealing in securities directly or indirectly alleging market manipulation. SEBI has also impounded unlawful gains of 4,843 crore rupees from the company. Jane Street says it disputes the findings and will further engage with the regulator. Hormaz Fatakia joins us now with more details. Hormaz, take us through this interim order from SEBI.
What is a Friday if it is not crazy? And the SEBI order on Jane Street has ensured that for all of us today. The market regulator has banned Jane Street and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street made unlawful gains to the tune of 4,843 crore rupees through trades between August of 2023 and May of 2025. This entire amount will will now be impounded, the largest in India's capital market history. SEBI has ordered that this impounded sum will have to be deposited in an escrow account which can be opened in any scheduled commercial bank, and that no debit will be made without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions, or until the expiry of such positions, whichever happens earlier. Now, this matter goes back to July of last year, when SEBI, the market regulator, had asked the National Stock Exchange, or NSE, to examine the trading activities of Jane Street to ascertain any market abuse. The report for this was submitted by the exchange in November of last year. Now, a month later, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in F&O terminology is liquid instruments that is easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was engaged in activities which were in violation of the regulator's PFUTP, or Prevention of Fraudulent and Unfair Trade Practices regulations. As a result, SEBI asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. However, the regulator found in May this year that Jane Street was in complete disregard of the caution letter and still running large cash equivalent positions, which was not only a violation of their regulations but also their own undertakings that Jane Street had given to the regulator. And it is this what led to the issue of the order last evening. That's not all. Last year, SEBI had put out a study stating that 9 out of every 10 retail traders lose money in the F&O space. How much did Jane Street earn? Not 1, not 2, but 36,500 crore rupees between January of 2023 and March of 2025. But what is Jane Street? Now, a global proprietary trading firm, 2,600 employees across the US, Europe and Asia, uses algorithms to identify trading opportunities in the market, and it's trading in over 45 countries. Now, does this order bring us to the end of this issue? Well, not yet, because Jane Street has contested the findings of the SEBI interim order and will be reaching out to the regulator regarding this. So it's only part 1 that has come to an end. We'll await to see more as the events unfold.
All right, Harmaz, many thanks for taking us through those details. So how did Jane Street manipulate the markets according to SEBI? Anuj Singhal is here with the modus operandi.
In a nutshell, what was happening, especially on the Bank Nifty, while the other order on Nifty and Sensex may also come. For example, on Bank Nifty, and we always say that Bank Nifty is very lopsided index. Why was this more prevalent on Bank Nifty compared to Nifty and Sensex? Because on Bank Nifty, you have 2 stocks, HDFC Bank and ICICI Bank, which primarily account for almost half of the index. So, you have one HDFC Bank which moves 1%. Now, you move HDFC Bank 1%. Suppose you sell a lot of HDFC Bank, but before that you bought put options of Bank Nifty. And that HDFC Bank falls by 1%, but that put option from 100 rupees becomes 400 rupees. So that's the 4x return. And that is where obviously when HDFC Bank falls all of a sudden, some funds will come and buy HDFC Bank and the price will eventually go back to the equilibrium. And that's what was happening. Even if you look at yesterday's price move, look at what happened intraday in a lot of stocks. And that is where you will square off these positions and make huge money. So if you see the table, in index options, they made 43,289 crore, but they lost 7,680 crores in futures. Because that is where, you ended up losing the trade. The same would happen on the other way around. I mean, if you're buying call option and, you're doing that. So eventually that, in a nutshell, is what was happening. The market impact, you ask me, the market impact would be restricted to 2 or 3 stocks. Yeah. I think BSE, for example, today could be one of the biggest casualties because, a lot of volumes on BSE, I am told, were being generated by hedge funds. So in that sense, there could be some impact, though my sense is at lower level, even that will see some buying because, first of all, this is not a final order. And second of all, I think this is going to escalate.
All right, Anuj, many thanks for those details. Meanwhile, Zerodha CEO Nitin Kamath said if SEBI's allegations are true, Jane Street engaged in blatant market manipulation. He also added that F&O volumes are likely to drop since trading firms like Jane Street account for 50% of options trading volumes. The fears were visible on Dalal Street today, with shares of brokerages like Nuvama Wealth, Angel One and stock exchanges like BSE saw sharp cuts. Moving on, Reliance Retail has approached the National Company Law Tribunal for internal restructuring to house FMCG business under a new subsidiary. The new vertical will be held directly under Reliance Industries. Ashmit Kumar is here with more of those details. Ashmit, take us through how Reliance Retail is planning this restructuring.
Well, clearly a move being made by Reliance to house all the FMCG businesses under one roof, and to that end, we understand an application has been made before the NCLT. In this application, they're essentially saying Reliance Retail then goes on to say that there are the status quo is that there are two subsidiaries of Reliance Retail which are housing these FMCG businesses. The attempt is to move all of them under one roof, under one new entity called New Reliance Consumer Products, which will directly be a subsidiary of Reliance Industries. The rationale that has been put before the NCLT is that the retail business is very distinct, very different from the FMCG business. The FMCG business has its own dynamics. It requires focused investments, which it will now be able to attract if it is now hived off as a separate entity. It requires autonomy to realize its own strategic goals. These are all aspects that were laid out before the NCLT. The NCLT, on its part, as a matter of procedure, has asked these Reliance Group entities to reach out to their shareholders, to secure their approval, to reach out to the lenders, creditors, both secured as well as unsecured, to get their approval going forward. Also asking them to reach out to government entities, GST authorities, income tax authorities, to put on record any disclosures they may want to have in terms of contingent liabilities or litigations. And it's after that that the NCLT will consider this application for hiving off the entire FMCG division under one roof.
All right, Ashmit, many thanks for those details. Now, the race to acquire debt-ridden Jayaprakash Associates continues to gather steam. Sources have told CNBC-TV18 that Dalmia Bharat is the highest bidder with 14,600 crore rupees. However, most bids are conditional offers. Ritu Singh is here with all of those details. Ritu, who's bidding how much and what are the conditions here?
Well, some of India's biggest corporate houses, including Adani, Vedanta, Dalmia Bharat, have submitted offers to acquire Jayaprakash Associates, but there is a major catch. Most of these bids hinge on the outcome of a land dispute that is currently pending in the Supreme Court. Now, in absolute terms, and remember the bid includes many components, we understand it is Dalmia Bharat which has placed the highest offer of more than 14,600 crore rupees. But if JP's Sports City land dispute in Noida is not resolved, they could cut their offer by around 2,000 crores or even more. Our sources also indicate Vedanta Group has offered about 13,600 crore rupees. But again, if the land issue is not cleared, they may withdraw their offer altogether. Then you have Adani Group's offer at about 12,250 crore rupees. It also includes NCDs that are payable over more than 4 years. And while their bid is also conditional, our sources indicate Adani's offer may stand irrespective of the land dispute outcome. Then you have Naveen Jindal's Jindal Power, which has bid 10,300 crores, also contingent on the land dispute, and PNC Infratech is the lowest bidder at 9,500 crore rupees. Now, here is the core issue to remind our viewers. Around 1,000 hectares of land under JP's Sports City project was cancelled earlier by YEDA, and that was upheld by the Allahabad High Court. But JP's resolution professional has moved the Supreme Court to challenge it, where the case is currently pending. Now, these are just the first round of bids, remember, so there will be negotiations and even possible revisions to the offers that follow. So we'll have to see who comes out on top, but the process itself is far from over.
So, Ritu there with the latest on JP Associates' resolution plan. And staying with court action, Supreme Court has refused to grant interim relief to HDFC Bank CEO Shashidhar Jagdishan in the Leelavati Medical Trust case. While hearing a plea filed by the CEO, the court said that it cannot get into the merits of his case and has directed him to wait for the next hearing of the dispute at Bombay High Court. However, the court also said that Jagdishan's plea has been listed 4 times in the Bombay High Court without a hearing, and it trusts that the plea will be taken up in the upcoming hearing, which is scheduled for the 14th of July. Former SpiceJet promoter Kalanidhi Maran has moved the Supreme Court, challenging Delhi High Court's order dismissing his claim for damages worth 1,300 crore rupees. Maran is seeking damages from current promoters of SpiceJet, and this battle has been going on since 2015. The claim had previously been rejected by the Arbitral Tribunal and the Delhi High Court. Apex Court will hear the case on the 18th of July. On May 23rd, Delhi High Court dismissed Kal Airways' plea by calling it a calculated gamble. A hearing has been scheduled to be held on July 18th at the Apex Court. The Petroleum and Natural Gas Regulatory Board has approved the second amendment to the natural gas pipeline tariff regulations. The new regulations will introduce a set of changes to simplify tariffs and improve access to natural gas across the country. The norms also aim at reducing the number of unified tariff zones from 3 to 2. On that note, it is time for us to head into a short break. But coming up next, President Trump says U.S. will start sending letters to countries specifying what tariff rates will be imposed starting today. Details when we come back. Stay tuned. Welcome back. You're still with us on Business 360. In international news, U.S. President Donald Trump has announced that his administration will start sending the tariff letters to countries starting today. The letters will inform these countries what tariff rates they will face. Speaking to reporters before boarding Air Force One, Trump said these countries will be expected to start paying tariffs from the 1st of August. And the tariffs will range in value from 10% to 70%. He also added that negotiating individual trade deals with over 170 countries is a complex process. This comes at a time where India and the United States are inching closer to sign a mini trade deal next week.
So we're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs. But they're going to be starting to go out sometime tomorrow. We've done the final form, and it's basically going to explain what the countries are going to be paying in tariffs.
U.S. lawmakers have passed President Trump's sweeping spending and tax bill, handing him a first major legislative victory in the second term. Democrats have called it a dark day for the country. The procedural rule voting saw one Republican representative joining Democrats in opposition. The legislation will extend tax cuts President Trump signed into law in 2017. The bill is estimated to add more than $3 trillion to the U.S. national debt. And staying with Donald Trump, the U.S. president held a phone call with Russian President Putin last night. Speaking to reporters today, Trump said that he made no progress towards a potential ceasefire during the call, adding that he was not happy with what was happening in Ukraine. He added that both the leaders spoke about many topics, including Iran. Meanwhile, the Kremlin said both the leaders held a frank and substantive chat. Israeli forces have intensified their attacks in Gaza, killing more than 100 Palestinians, out of which 51 were waiting for aid. Hamas has said that consultations have begun on a latest proposal for a temporary 60-day ceasefire in Gaza, and the group will submit its response to mediators. Reports have said that Hamas is seeking guarantees that the ceasefire proposal would lead to the war's end. External Affairs Minister S. Jaishankar will be commencing his 3-day visit to China from the 13th of July. As per News 18, this will be the minister's first visit to China after both nations decided on the patrolling agreement last October. He will be visiting Beijing for a couple of meetings, after which he will attend the SCO Foreign Ministers meeting. Deutsche Bank CEO Christian Sewing has said that India is always top of the list and presents a huge opportunity. Speaking to CNBC-TV18, Sewing added that India is also a strong source of innovation and technology for the world. The bank has recently pumped $800 million into India. Take a look.
Let's talk about why you're here in India and how India is playing itself out in this era of volatility. You've just met with India's Commerce Minister Piyush Goyal. What's the read on India at this point in time?
Well, first of all, thank you very much for having me. It's a pleasure being here. It's a pleasure being in this country. To be honest, that meeting was very positive, but the overall spirit in this country is outright positive. I've been here now for 3 days, and I have to say I'm amazed by the steam, by the drive, by the passion, you know, it's an economy which is obviously outright growing. It's actually with whomever you talk, the story is growth. And it is also coming, obviously, from Germany, being one of the leading European banks, looking at our clients. Our clients are actually looking to India out of the lens of this is an opportunity. A lot of global clients, a lot of multinationals, but also family-owned companies are in the process of reorganizing their supply chains, their production chains, and India is always top on the list. And that is, from a Deutsche Bank point of view, a huge opportunity for us. We have been here for 45 years. We have 23,000 people. We are growing immensely. We just put $800 million of capital into India. So we want to grow and our clients want to grow. So it's a very positive story. So I'm excited.
And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. 6 months of the year are already over, and we've spent the last 6 months, the last many years, of course, talking about the mutual funds that you should have, the trends that you should be wary of, the insurance that's really, really critical for your portfolio and your well-being. Well, today's show is slightly different because it's not about stock tips or even mutual fund or insurance-specific product tips. It's more holistic in nature. Today's show is about how we need to look at our wealth creation journey perhaps differently, sometimes take a step back, look at whether we are doing things right, fix whatever we are doing wrong, and take a wider view of our overall financial journey. And helping us do that is someone who's got several decades of experience in the financial landscape, in the investing landscape, and she's an author also, and she's watched stock picking, money, personal finance up close and personal. Yes, let me welcome on the show Devina Mehra, founder, chairperson and MD at First Global. Devina, thank you very much for taking out the time. I know this is your first Let's Talk Money. We always grill Devina on whether this sector is good or not. What do you do with, stock A versus stock B? But I promised you a different conversation. Thank you so much for joining in for it.
Thank you for having me, Surabhi. Pleasure to be here.
So, let's look at things a little more holistically in your own journey, because you're someone who was working in the big bad world of finance with, I think, a US bank. And then you decided to go your own way to look at, whether it's portfolio management, wealth management separately. So why don't I start with an open floor kind of a question to understand what you have learned along the way?
Oh, that's far too many things, because it was an evolution. When I started this business in 1993, even stock research did not exist as a career. I mean, no company had an investor relations department. Such a thing did not exist. So right from there, and we did not have, you have a course in IIM Ahmedabad on securities research, because that option did not exist as a career. So it has been a journey, and of course you learn many things which are there in the textbooks. Also, you really understand only when you live through it. For example, asset allocation accounts for 85% of your return is there on page 1 of every investment book. But
you're still looking for the stock.
Yeah, you're still looking. You start with looking for the multi-baggers till you come full circle and find out that yes, what was being said made sense.
Yeah, so let me ask you, Abhin, and in your decades of observing the market, observing different types of investors, big, medium, small, how has the Indian investor changed? And I mean not so much from the point of view of the wealthiest, bulge bracket, family offices, but more from, say, the mass affluent. What are the changes you've noticed?
So in the beginning, of course, not that many people invested in the markets to start with. So that has become, you can say, democratized over time, and especially after COVID, which has both pluses and minuses. And people, and very often when people get into the market, they think there is some magic wand which will make them rich quickly, or they will have something where they can get the multi-baggers, or for that matter, which is even worse, that they will become these traders who make money. So that's how all these courses get sold off. And I recently wrote that anybody who has this magic wand where they know for certain what will be a multi-bagger, or for that matter a good trading strategy, why would they share it with you? If they can make 1% every day, that means they can have their money grow 7 times in a year. So they're not going to share it with you. And you can just do the calculation that 1 crore can become 20,000 crores in 5 years, and so on. And
I think that's already the first lesson that we have from this conversation, that don't fall prey to stuff that seems absolutely gold-plated. It probably isn't, right? That's probably lesson number 1 from this conversation. But on that, that's also perhaps a reflection of the essential need to grow wealth in a better way, in a faster way than what we've seen our grandparents do, or even our parents do. That time, I mean, there was less investing, it was more saving. It was all about a bank fixed deposit or the odd LIC policy, right? So now I think it's well understood that mutual funds are one of your very good friends. If you were to advise anyone to look at very holistic portfolio management or wealth creation? What's the starting point?
So the starting point is your asset allocation. And just as in Google Maps, you don't just put in your destination, you have to put the starting point. So first understand where your investments are. And investments, people, as soon as you say investments, they think it means stocks and mutual funds. But no, I mean all those tax saving schemes that you invested in. So those are also investments. Some land you inherited from your grandparents, or apartment that you have booked, gold, if you hold some crypto or anything like that, everything is investment. So first look at all where you are invested, and against that you might have loans, housing loan, car loan. So look at the whole picture and then decide where do you want to be. So do a deliberate asset allocation, and if you do that sensibly, that is 80% of the way through. So sometimes people just freeze, saying only if I understand everything well, I don't know enough about stock markets, then I will start investing. So you don't have to wait for the then. You start with the basics, you get the broad allocation right, and start as quickly as possible. We've all seen those calculations that if you start saving at 25 versus 30, how much more you would have to save, or 35, 40. So start quickly. And one other thing, don't be at extreme ends of the risk spectrum. You spoke about savings. Yes, savings alone is not enough. So if you save a lakh a year and put it in a bank fixed deposit, you will have 75 lakhs after 30 years. If you are
that's scary.
Yeah, if you are in a multi-asset portfolio which gives you maybe 9.5% compounded, you will get to 1.7 crores. If you are a slightly more aggressive with more equity, maybe 12-13% compounding, you will be at 3 crores. So 75 lakhs and 3 crores. So that's the range. So even without taking excess risk. So be sensible about it. Don't be in a hurry to get rich quick. So that I will repeat. So there is no magic formula. Nobody has a magic formula for multi-baggers. Sometimes people ask me that you found HDFC Bank in 1996 or Amazon in 2001. So tell us what is the next Amazon or HDFC Bank that I can buy for my child and forget for 20 years. So nobody has a crystal ball for 20 years. Nobody has ever had a crystal ball for 20 years. I mean, Warren Buffett says that in 75 years, maybe 10 of my decisions have made me all the money. So if he knew which 10 they were to start with, he would have put all his money there. Same with Rakesh Jhunjhunwala, same with anybody. So no one knows in advance what the trajectory would be. So no one knows which company will be a multi-bagger. So you have to take a sensible approach, and you have to manage risk very tightly, because investing is a loser's game. So that's
that's also a heavy headline, right? Investing is a loser's game. You just have to ensure that your winners are bigger than your losers.
You have to ensure that you play not to lose. So winners games and losers games, the difference is that and games change. So aviation once upon a time was a winner's game. When JRD Tata was flying that Karachi-London flight, it was a complete adventure sport, that some part didn't work. He wound a wire into something and made it fly. Now, I mean, it's not a very great example to go presently, but the point is that the only way to fly an aircraft today is to go by the checklist and make no mistakes. So investing maybe, 50 years ago, when even getting a annual report, even 30 years ago, was not easy, and you could unearth gems which no one had heard of. But now that is not the case. Now if information is available, you have to play that not to lose. Not to lose doesn't mean that you don't book losses. In fact, you have to book the small losses so that you don't take a big hit on your capital. That has to be the mantra. So if you don't lose, then you win, because then the compounding will take care of you. But if you are refusing to admit mistakes, and I mean, I say the best thing you can do for your portfolio if you're investing in stocks is when you invest, tell yourself, I may be making a mistake, because I can guarantee you a significant portion of your investments, things will not go as you envisaged.
So be humble about it. Devina saying starting point is that you could be making a mistake. Just admit that, and then cut the losses in
so that you don't take a big hit, because percentages are not symmetrical. If you lose 1/3 of your capital, then your capital has to go up 50% for you to go to zero. If you halve it, then you have to double it. So it like down 50% means you have to be up 100%. That's how it goes.
Mistakes are costly. Make sure you cut your losses and cut those mistakes in time. But Devina, I want to take a step back. Actually, we're talking stocks and investing. I want to ask you about the difference in the DIY approach and the difference in letting it run through a professional fund manager, and then the headache is to pick the right fund manager as well. It's not easy, right?
Right.
Since COVID, because like you're saying, information has been widely available, and we have all these fintech apps. I mean, you can buy a stock perhaps as quickly as you swipe on your Instagram profile, right? It's become that easy in terms of the technicality, the access. Yeah, whatever you're browsing. I mean, in that same microsecond, you can be buying or selling a stock as well.
Right.
I mean, what's the advice you give to people when they ask you? What do you think, personally? Should full-time working people be managing their own stock portfolios?
Do a thought experiment. That's what I tell people. That let's say you want to invest yourself directly in the stock market, and then you are considering, let us say, half a dozen other funds or PMSs or whatever. So consider yourself also a fund manager. So you have these 5 or 6 fund managers, and you are fund manager number 7.
Wow, and you're competing with the best of the best in the country.
So you look at your entire track record. Don't pick and choose, and don't say that last year I found this multi-bagger. No, I mean, now in your DP account, look at everything that happened and look at what were your returns, what was the volatility, and then compare it with all the other 6 fund managers, and then see whether you are the very best. If you are not the very best, then you definitely should not be investing 100% of your investments directly. So that's of even your equity allocation directly. But I mean, this is an interesting thing to do. You want to do it, you want to learn it. So I mean, the only way to learn it is by doing. So if that is the case, allocate a small percentage to yourself, almost like play money, that okay, I will play with 10 or 20% of my corpus, and the rest I will give to professionals. Because it's difficult, as you said, that people have a day job, they cannot do this full time, and therefore their results are unlikely to be as good as the professionals. And and always look at returns and risk volatility, both sides.
Yeah. Okay, fair enough. I think that gives us a good starting point. What we'll do is we'll take a quick break, come back after the break, and we'll get Devina's help to design the rough framework for a medium risk portfolio. We'll take some examples, we'll put certain thoughts in place in terms of the financial goals as well. Back with that in just a bit.
Let's talk money. Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week Devina Mehra is helping us put some rules in place to that whole quest for creating long-term wealth. Devina, so now it's time to ask you for some advice. So I'm going to take an example. Say someone who's in their mid-30s, earning, will perhaps continue to earn for another 20 years and is looking at a holistic approach to portfolio creation. So what is the kind of asset, looking at the market environment today, what is the kind of asset allocation, which markets, which asset classes, what's the proportion? What would you advise this medium risk mid-30s investor?
Okay. So first of all, of course, everybody's life circumstances are different, that how many kids you have, whether your parents are dependent on you, many of those factors come into play.
Absolutely.
But one thing when you're planning for 20, 25 years, which we haven't spoken about till now, is that look at global diversification. That is so important. I give the statistic all the time that when I started working, the dollar was 12 rupees. So it's been
I cannot. What? When you started working, $1 fetched 12 Indian rupees.
12 Indian rupees. So in the
86 something today.
Yeah. So in the course of less than a career, there's been a 90% depreciation. So when you are planning for 20, 25, 30 years hence, this is not something you can forget. So because that your rupee loses value over time. And very often, if anything, hard currency expenses have gone up since then. People study abroad, people's children study abroad and often settle there. So I hear many times people say that after retirement, we'll spend half the year there. So basically your hard currency expenses have been rising, and Indians still do too little global diversification because when we were growing up, there was no option to it. India did not have capital account convertibility. You could not invest in global markets. Now you can. So our grandmothers were right to buy gold because at that time, that was the only currency hedge. But now you have the whole world. Again, people think global diversification means that you buy a NASDAQ index or you buy the 5 stocks you know the names of, or another 3 Chinese stocks you know the names of. That is not global diversification. Global means global because one golden thing in investing is that themes change. So no asset class, no geography, no sector does well forever. So it, US has done well last 12 years, but there was also, for example, 2003-04 to about 2007, US. And it wasn't coming off a high. It was already in the doldrums after the tech crash. Still, it continued to lag, and that was a golden period for emerging markets. India went up 6 times. Whole emerging market index went up 3.5, 4 times. So you have to have the whole globe as the. So that's why for me, it's a cause. So that's why we have a whole all investing across all geographies, all asset product that starts at $10,000, at just 8.5 lakh rupees, which you normally won't get for less than $1 million. So coming back to your question.
So right now, when you want to achieve adequate global diversification in your portfolio, and people, sometimes equated that I'm invested in the NASDAQ, ETF, or I have some fund which is dovetailing on the Dow. I don't know, is that enough?
No, that's not enough. That's what I was saying. US is not the world. So in 2021, if you remember, is when all these NASDAQ ETFs and fund of funds, etc., were launched in India. And not in hindsight, but at that time, I had come on your channel also and said that, 3 years NASDAQ has done brilliantly. Don't assume that this will last. And 2022, NASDAQ was about the worst performing index in the world. It went 40% down from the levels at which those ETFs were launched. And people came to me and said, should I sell now? I said, now that, don't compound a bad buy with a bad sell. Because a stock down 40% can still be a sell. But a major index down 40% is almost never a sell. And so, of course, it bounced back from there. But that's the whole problem with buying very narrow, focused indices or funds, and often it's just a layer of cost getting added at the India end.
So then which are the markets, or where else
so
would
you have to see that changes. Again, I can't say today that you buy this combination and that will last for 10 years. So that's why we do that. We have a fund and we have portfolio accounts which do that, because that changes, and we look at it every quarter. For example, this year, now we've gone underweight US, even though it's still large, but we've gone underweight US, we've increased Europe. Okay. In China, we've been a little overweight from last year itself. India, we are slightly overweight. So that would be, but that changes.
Okay. Okay, so that's global diversification, which is extremely important.
Right. So over time, you should have 30–40% globally diversified.
Wow.
Yeah. So at least, I mean, logically it should be even higher, but because as it is, you are exposed to India. Your career is here. Your real estate is here. So and people say if India is growing so well, why invest?
Why look at other equity markets?
Yes. But in the 90s, which were the highest growing economies, they were the Asian tigers.
Correct.
And then there was a crisis.
Correct.
And in 1 year, those markets fell between 50 and 90%. And that was a wake-up call for me that if I was an Indonesian, my net worth would have been wiped out by 90%. So that was the sort of one of the triggers why we went global as far back as 1999. We were not just the first Indian, we were the first Asian firm to become a member of the London Stock Exchange, other than the Japanese. So because I realized that putting all your eggs in one basket is not a good idea.
It's not a good idea. Okay. On gold, I mean, you briefly mentioned a hedge against obviously currency risk, etc. But you know, gold is an interesting debate right now. Yes, households probably have enough of it, and there's one school of thought saying don't take overexposure because from your grandmother to your mother, I mean, there's enough gold in the households. But the other school of thought is that gold is rarely sold for emotional reasons or whatever. So, you know, many people say that do you really want to include that traditional old jewelry as part of your gold allocation? Because it's not a sensibly well thought out, balanced financial way of investing in gold. No, what are your thoughts on it?
No, whether it was thought out or not, you hold it. So that you have that investment there. So, I mean, there's no reason
but
to
you won't
say
sell
that.
it. That's the point. That people say that it's just notional holding. You won't sell your grandmother's jewelry.
Indians do. I mean, every time gold and silver reaches a peak, Indians are out there selling.
Actually,
I mean, even now the jewelers are saying that buying is not happening in gold jewelry. So. So I think you should definitely add it in your asset allocation. And many times the grandmother's jewelry, the daughter or daughter-in-law no longer wants to wear in any case.
Could be. But you know, on a steady state basis, obviously it will vary in different market conditions. But roughly speaking, I mean, do you give it 5%, 10% in a portfolio?
Yes, in that range. It should not be 25% of your portfolio. Because gold is an extremely volatile asset. People think it is, it is some sort of a stable asset. But the dollar price of gold in 1980 was not breached till 2007. It took 27 years. In between, it came down more than 60%. 19 years later, it was down 60% from the 1980 level. So this is what people forget. It looks good, relatively okay in rupee terms because it's really a rupee depreciation chart. In dollar terms, it has been more volatile than the S&P.
Wow. That's something to think about. But, finally coming down to some closing thoughts, Devina, and beyond, of course, we've discussed the asset allocation and some portfolio advice. I want to understand from you, when you've observed people over the years, what do maybe the rich do differently, which keeps their wealth growing? Or, you know, should I put it the other way? What do perhaps some middle-income Indians also do differently to break through, to move to the affluent side? What have you observed and what would you like to share with us at a more behavioral or maybe personal aspect?
So one thing is that don't start that so-and-so became so rich and what was the way they went. Because, you know, for example, if you follow a very high-risk strategy where bulk of the people go bankrupt, but whoever survives, let us say, makes their money 10 times in a year. So if you start with 100 people, at the end of 5 years, there might be only one person left, but that person would have really made it out like a bandit. So you think that, but that's not good strategy.
Okay.
So never think like that. So as I said, do the basics right, that save sensibly, invest sensibly, start early, manage your risk, which means don't have too much. I mean, if you're talking of the stock market, don't be too concentrated in certain themes or certain sectors. Always have a stop loss on wherever you are investing yourself. So do all the sensible things. Don't think you will suddenly make it rich. I mean, somebody asked Rakesh Jhunjhunwala also that you made your money from trading, so why do you tell people not to trade? And he says that, you know, I may be smoking, but I tell my children not to smoke. So because it's not a good idea, statistically speaking, to do that. So do the sensible, I mean, good investing can be boring. So it just doesn't sound very exciting that, you know, do asset allocation and do global diversification, manage your risk. and manage your mind. That's the, a lot of what I've read in the last few years has been on how many biases and randomness we have as human decision makers, and why those are all very hardwired within us. So you have to
give an example of,
for example, this is loss aversion bias, that we hate to book losses. And a 1 lakh of a loss gives us more pain than 2 lakhs of profit. So don't try to make it up in the same stock or the same strategy. That's another thing which people end up doing, that when the stock comes back to my purchase price, I will get out, because the market has zero interest in your purchase price. So, you should be just agnostic where you make your money.
Okay. Manage your mind, and the money and the wealth will perhaps follow. All right, Devina, it's been a great conversation. Thank you so much for laying out some of the basic rules that we often tend to, overlook or forget. This is a good conversation. Thanks so much for joining us today.
Thank you, Surabhi. Pleasure.
All right. Well, we hope you enjoyed this show, this particular episode of Let's Talk Money. Do give us your feedback, your reviews, and of course, send us your comments, queries, anything else you would want us to talk about. We'll pick it up in the coming weeks. Thank you for watching.
Let's Talk Money.
Hello and welcome to News Center. I'm Parikshit Luthra. Market regulator SEBI has imposed an interim ban on US-based trading firm Jane Street Group and its related entities from accessing the securities market. The entities will be prohibited from buying, selling or otherwise dealing in securities directly or indirectly, alleging market manipulation. SEBI has also impounded unlawful gains of 4,843 crore rupees from the company. Jane Street says it's disputes the findings and will further engage with the regulator. Hormuz Fatakia joins us now with more. Hormuz, take us through the interim order from SEBI.
What is a Friday if it is not crazy? And the SEBI order on Jane Street has ensured that for all of us today. The market regulator has banned Jane Street and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street made unlawful gains to the tune of 4,843 crore rupees through trades between August of 2023 and May of 2025. This entire amount will now be impounded, the largest in India's capital market history. SEBI has ordered that this impounded sum will have to be deposited in an escrow account which can be opened in any scheduled commercial bank, and that no debit will be made without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions or until the expiry of such positions, whichever happens earlier. Now, this matter goes back to July of last year when SEBI, the market regulator, had asked the National Stock Exchange or NSE to examine the trading activities of Jane Street to ascertain any market abuse. The report for this was submitted by the exchange in November of last year. Now, a month later, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in F&O terminology is liquid instruments that is easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was engaged in activities which were in violation of the regulator's PFUTP or Prevention of Fraudulent and Unfair Trade Practices regulations. As a result, SEBI asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. However, the regulator found in May this year that Jane Street was in complete disregard of the caution letter and still running large cash equivalent positions, which was not only a violation of their regulations but also their own undertakings that Jane Street had given to the regulator. And it is this what led to the issue of the order last evening. That's not all. Last year, SEBI had put out a study stating that out of 9 out of every 10 retail traders lose money in the F&O space. How much did Jane Street earn? Not 1, not 2, but 36,500 crore rupees between January of 2023 and March of 2025. But what is Jane Street? Now, a global proprietary trading firm, 2,600 employees across the US, Europe and Asia, uses algorithms to identify trading opportunities in the market, and it's trading in over 45 countries. Now, does this order bring us to the end of this issue? Well, not yet, because Jane Street has contested the findings of the SEBI interim order and will be reaching out to the regulator regarding this. So it's only part 1 that has come to an end. We'll await to see more as the events unfold.
All right, thanks for that, Hormuz. So how did Jane Street manipulate the markets according to SEBI? Anuj Singhal is here with the modus operandi.
In a nutshell, what was happening, especially on the Bank Nifty, while the other order on Nifty and Sensex may also come. For example, on Bank Nifty, and we always say that Bank Nifty is very lopsided index. Why was this more prevalent on Bank Nifty compared to Nifty and Sensex? Because on Bank Nifty, you have 2 stocks, HDFC Bank and ICICI Bank, which primarily account for almost half of the index. So, you have one HDFC Bank which moves 1%. Now, you move HDFC Bank 1%. Suppose you sell a lot of HDFC Bank, but before that you bought put options of Bank Nifty. And that HDFC Bank falls by 1%, but that put option from 100 rupees becomes 400 rupees. So that's a 4x return. And that is where obviously when HDFC Bank falls all of a sudden, some funds will come and buy HDFC Bank and the price will eventually go back to the equilibrium. And that's what was happening. Even if you look at yesterday's price move, look at what happened intraday in a lot of stocks. And that is where you will square off these positions and make huge money. So if you see the table, in index options, they made 43,289 crore, but they lost 7,680 crores in futures. Because that is where, you ended up losing the trade. The same would happen on the other way around. I mean, if you are buying call option and, you're doing that. So eventually that, in a nutshell, is what was happening.
Right. Thank you very much, Anuj, for joining us. Zerodha CEO Nitin Kamath has said if SEBI's allegations are true, Jane Street engaged in blatant market manipulation. He also added that F&O volumes are likely to drop since trading firms like Jane Street account for 50% of options trading volumes. The fears were visible on Dalal Street today, with shares of brokerages like Nuvama Wealth, Angel One and stock exchanges like BSE saw sharp cuts. Here are some legal experts with what they make of the SEBI order.
I think this is an appropriate way in which a regulator like SEBI must make sure that the integrity of the markets is protected. And while we understand the whole idea of why there should be index options and futures and option trading and all of that, I think it has to be done under constraint.
Well, the signal that it sends is that however big you may be, you're not above the law. Based on facts, they've come to a conclusion that there has been a gain which is not justified in law, and therefore they have taken the action which they've done. So let's see whether the factual position is justifiable. And as I said, the only solution now for the Jane Street Group is to go to the appellate tribunal and prove their case before them.
All right, so we will be tracking the probe into Jane Street, but we're taking a break right here on CNBC-TV18. Don't go anywhere. We decode the new employment-linked incentive scheme with Labour Secretary Vandana Gurnani on the other side. Hello and welcome to News Center. With me, Parikshit Luthra. Earlier this week, the Union Cabinet approved an employment-linked incentive scheme with a total outlay of roughly 1 lakh crore rupees. There are two parts to the scheme. Part A, which will target first-time employees. The scheme will offer 1 month EPF wage up to rupees 15,000 in 2 installments. Employees earning up to rupees 1 lakh per annum would be eligible. This is expected to benefit around 1.92 crore first-time employees. The second scheme will incentivize employers up to rupees 3,000 per month for 2 years for each additional employee hired with sustained employment for at least 6 months. How will this help India's employment generation? Joining us to talk about the government's push for more employment generation is Ms. Vandana Gurnani, Secretary, Labour and Employment. Ms. Gurnani, thank you very much for joining us. First of all, could you give us a sense of the timeline? Because a lot of people in the industry would want to know when this is implemented. So could you give us some clarity on that?
Thanks, Parikshit. So that's a very important question. The scheme will commence from 1st August this year itself. So any new employment that is generated after 1st August is something that would be eligible for incentives under this scheme. The first 2 years is basically the registration period. So it commences on 1st August this year and the registration or the enrollment goes on till July of 2027. So whatever employment, additional employment over and above the baseline that gets gets generated during this period of 2 years would be eligible for incentives under the scheme.
Right. I would also like to ask you specifically about Scheme A first. What are the kind of sectors where you want to encourage more first-time employees to join the workforce?
Yeah, so that's a very good question. This entire scheme, especially the Part A, is focused on first-time joinees because that is where the hiring costs are higher, and the scheme can have an impact on the marginal cost of hiring from the employer's perspective. But for employees, it is something that will help them, cover the costs of searching for jobs, transportation, housing, etc. Also provides them, social security, financial literacy, and the benefits of enrolling in the social security, which gives them insurance and pension. So in terms of sectors, I would say it is a very broad-based scheme. It is applicable to all sectors. There is, I would say, an additional incentive, a longer incentive for the manufacturing sector to give a special boost to that particular sector. So all sectors would be eligible for incentive for 2 years after the employment is generated. However, manufacturing sector would have an additional 2 years. It would be eligible for incentives for 4 years. So that is a specific push in some sense in the scheme for a longer duration incentive to manufacturing. It is also expected that a lot of labor-intensive sectors should benefit from it. The MSME sector, the textile sector, the IT and electronic sector, the food processing sector, that is an expectation that one has. But in terms of the design of the scheme, it is completely agnostic to the sectors. It's a very broad-based scheme.
Right. Again, Scheme A is only aimed at giving incentives to the employees itself and through DBT transfers. Is that correct, ma'am? Only for the employees, not for employers?
Yeah. Scheme A is only for the employees. It gives incentive to the first-time joinees and it is through the Aadhaar-linked bank accounts of the people who would be employed. So yes, it is correct that it is only for the employees.
Now, when it comes to Scheme B, ma'am, the Scheme B will provide rupees 3,000 per month for 2 years for a minimum of 2 additional employees hired by a company which has a strength of less than 50 people. And companies with over 50 people will have to hire at least 5 new employees on a sustained basis for 6 months. Now, what does this mean in terms of the number of employees that a company needs to hire per month or in a year?
There is no such per month or per year targeting. As you rightly said, any company which has less than 50 employees has to hire 2 additional employees. So over the baseline of employment that they currently have, just 2 more people hired makes them eligible for the incentive. And if they hire 10 people, 15 people, 100 people, they get incentive for all of them. Similarly, for companies which have more than 50 employees, they have to hire 5 additional employees. So there is no such per month or per annum target that is there. There is only a threshold that 2 employees for a less than 50 employee company and 5 employees for a more than 50 employee company. The objective is that it has to be additional employment, and the second objective is sustained employment. So the other criteria is that these employees should be there for at least 6 months for the benefit to flow, which is basically to ensure that there is sustained employment, there is skilling that happens, there is productivity increase that happens during this period, because current data that we have from EPFO shows that almost 45% attrition takes place in the first 6 months. So the objective of the scheme is to make sure that there is a sustained employment, and therefore the incentive comes in after 6 months of retention in that employment.
And I'm assuming, ma'am, the companies which want to avail of these incentives will have to apply for the government scheme. Would that be correct? And would you know how many companies are right now interested in this scheme? See, there is, first of all, I'd like to clarify one thing, that it's a very simple scheme.
And the vision of the Honorable Prime Minister was to keep it procedurally also very simple and design-wise also very simple. So nobody has to really apply for the scheme. Companies are already on the EPFO database. The ones which are not, which can come on the database, it is a very simple process for that. For companies which are already on the EPFO database, all they need to do is provide the GST number, provide their PAN-linked bank account number, because the incentive is going to flow into the PAN-linked bank account number. So that's all that is required for them. They have to also kind of, it's a very simple 3-4 field kind of a screen that will come on the EPFO website, which they have to fill up. And in the end, they just have to say that, yes, they want to be part of the scheme. It's an acceptance. They just check that box and they are set to go. So there is no elaborate registration process.
And when it comes to Scheme A, ma'am, for first-time employees who get the incentives directly in their Aadhaar-linked PAN bank accounts, in that case, do these employees who are going to be the prospective employees who are applying for a job, will they have to apply for the incentive themselves?
No, there is again no application process. They have to be registered on EPFO database, and they have to just do, for that they just have to do a biometric authentication. We are only insisting on face authentication because that's the latest biometric that is available, and that also can be done through a very simple app called Umang. So again, there are no forms to be filled out. There is no long procedure, just face authentication, or that is a biometric authentication on the EPFO website, and then they will become part of the scheme and will be eligible for the incentive.
This is very important, ma'am. So you're saying anyone who's entering the formal employment or any company who's hiring new workforce can automatically avail of these incentives. You don't have to do anything extra apart from what you already have.
Yes, so as I said, for companies, just the details of GSTN and the PAN-linked bank account. For the employee, face authentication and an Aadhaar-linked bank account. That's all they need to give. There are no detailed forms that they have to fill out. With this, once they are on the EPFO database, they would be eligible for the scheme. And one of the objectives of the scheme is also formalization in Social Security. Once they come on EPFO, they become automatically formal workers.
Right. What would be some of the long-term objectives, ma'am? You said employment generation, social security, some comfort to first-time employees who are joining the workforce. If you had to give us a sense of the vision of the government and what you seek to achieve with this.
So see, I would largely put the objectives in 3 buckets. Employment generation, that is the first very objective. Employability, which I had not spoken about earlier, because this scheme, once people actually get into the job market, because there is some amount of difficulty or resistance in taking the new joinees, but with the impetus of this scheme, once people get into the job market, and if they stay for 6 months, because as I said, the focus is on sustained employment, they acquire very valuable skills, and then these skills can go across various other companies, other sectors, other industries. So we are hoping that through this retention process, it will improve the skilling, the productivity, and therefore the longer term employment. So it's trying to break that initial kind of a block for the fresh joinees to get into the employment, itself. And once that is broken, it would sustain through skilling and productivity increases. And the third, as I had mentioned, was formalization. So that people get into the formal workforce, because currently in the country we have only about 12 to 15% of our workers in the formal workforce. With this, we hope that more and more people, especially the youth, will get into the formal workforce and have the benefits of long-term benefits of Social Security that includes pension and provident fund and insurance.
Ms. Kundani, one more question that we'd like to ask you is to how do you make sure that people are not committing frauds or claiming incentives for employees who were already there in companies?
That's a very important question because risk mitigation strategies are an important part of this entire effort. So for that, one is that the EPFO system has a very strong IT backbone to make sure that these frauds don't happen, and then there are algorithms to detect if things do not go right. Secondly, what is important is that the monies will go only into the Aadhaar linked bank account of an employee through the Aadhaar bridge payment system, and for the employer it would go through the PAN linked, go to the PAN linked bank account. So this is another risk mitigation strategy that we have. Also, as I mentioned about sustained employment, so in the scheme the benefit actually flows after 6 months of an employee being part of an organization or an enterprise, because that will ensure that it's not a company which suddenly springs up, or it is not fake people who are there. For 6 months, the employer and employee have to contribute, give their contribution to EPFO. The companies have to file the electronic challan cum receipt, which they normally file for all employees. They'll have to file for the additional employees also. And once that 6-month period is over, then the incentive flows to the employer and the employee. So these are some risk mitigation measures that have been put in place to ensure that the benefits actually flow to the right people, the deserving people, and that there is no misuse or fraud in the scheme.
Right. Also, to ask you about the internship scheme, there have been some reports which are quoting sources which say that the internship scheme may be merged into the employee-linked incentive scheme. Is there some thinking around that, ma'am, currently?
I think what I would say is that there is certainly a discussion which has happened, and more discussions will happen in terms of seeing how those two initiatives link better, so that people who are getting the benefit of the internship scheme ultimately also get the benefit of employment. So those kind of discussions are very much underway.
Right. Finally, ma'am, I would like to ask you about how to meet the skill gap in the country. Everyone is looking at India as an alternative source of manufacturing, but there is a feeling also that there is a skill gap, especially in areas which need cutting-edge technology. Now, just to take the example of what's happened with Foxconn, with China pulling out their workers for geopolitical reasons. And there are multiple reasons. For the last few months, we've seen how China has stopped rare earth magnets to India, electronic components, fertilizers. Now we're seeing their own workers being pulled out of factories. This impacts us and our manufacturing as well. How do you think we address this situation in the long term?
So I'd like to just kind of remind ourselves that there is this whole package for a boost to employment, and there are several parts to it. You mentioned the internship scheme. We just spoke about the ELI scheme, but we also had a very recent decision of the policy decision of the Union Cabinet on the scheme for upgradation of ITIs, as well as setting up 5 centers of excellence. So it's an entire package which is looking at all aspects of employment, and there is also a discussion which we are having with the Ministry of Skill Development on how we kind of dovetail both the ELI initiative as well as what is happening through its various initiatives for skill upgradation, including the most recent one where several ITIs across the country would be upgraded, as well as centers of excellence would be set up. So that's going to effectively bridge the skill gap and meet the demand of the industry and help the industry to grow further, as you had mentioned before.
Thank you so much, ma'am, for joining us with your perspective, giving us your overview on how the employment-linked incentive scheme is going to work.
Thank you, Parikshit.
All right, that's all the time we had on this special broadcast. Thank you for watching, and goodbye.
From Instagram influencers to high-end wellness clinics, beauty and wellness isn't just about makeup and lifestyle anymore. It's also about IV therapies. From vitamin infusions and hangover cures to skin lightening and anti-aging cocktails, this booming market promises quick fixes in a drip. India's IV hydration therapy for wellness was valued at $38 million in 2024 and is projected to nearly double to $65 million by 2030. But as demand grows, so do concerns. Doctors warn of a rapidly expanding, largely unregulated IV drip industry, often operating without medical oversight, clinical screening, or even sometimes trained personnel. The risks: infections, allergic reactions, incorrect dosages, and unsafe administration. At the heart of this trend is glutathione, known as the master antioxidant. Medically used for liver disease, Parkinson's, and chemotherapy support, it's now being used widely and often off-label for skin lightening. In 2024, glutathione sales in India touched $13.4 million, growing at 12.7%, making it one of the fastest-growing markets in Asia-Pacific. It's apparently freely administered via IVs across salons, spas, wellness clinics, and even in home setups, often with little or no doctor supervision. It's aggressively marketed as part of glow drips, anti-aging cocktails, beauty infusions, and bridal packages that promise fairness and radiance. In fact, over half of Indian dermatologists reveal that they routinely prescribe glutathione, even though 54% admitted there's a lack of long-term safety data. Side effects can include kidney and liver issues, allergic reactions, and in rare cases, Stevens-Johnson syndrome. So today, we ask some important questions. Are IV drip therapies safe? What should we know before trying IV drips? And how do we separate genuine health benefits from marketing hype? To help us unpack all of this, we're joined by Dr. Hemant Thakkar and Dr. Satish Bhatia. Welcome to the show, gentlemen. Well, Dr. Thakkar, let me start off by asking you about your overall take on IV drips in the wellness market. What exactly happens to somebody's body when they take an IV drip which has, maybe an infusion of vitamins?
So if the last decade belonged to pill popping, this decade is solely drip driving and delivery. I have known patients who do not have the time to come to the clinic because early morning they got up after a hangover and took a drip with inverted commas. Salons, spas, wellness clinics have, without regulatory approval and clinical supervision, blossomed at every nook and corner to deliver glutathione, vitamin cocktails, all sorts of drips, peptides, so that this wellness, and this is because the susceptible years of the impressionable young folks, even the middle-aged ones, who want to overnight blossom and look like angels after all that they have gone through, has continuously allowed this unregulated, unsupervised, dose not being maintained, and that is a real danger because that provides all the problems that you just listed. It is not US FDA approved, glutathione especially for cosmetic reasons. Remember, the cosmetic benefit was an incidental discovery when glutathione was given for true medical reasons. There are true medical indications, but those indications are left by the wayside and parlors, etc., get into this.
Can healthy individuals rather be prescribed IV drips such as these?
If you ask me, glutathione should be a Schedule H drug, which should be regulated for specific indications. It is great for cancers, Alzheimer's, Parkinson's, chronic inflammation, but that is medically supervised. How much to give? Glutathione is destroyed by the gastric juice. So oral glutathione doesn't work. They've started transdermal where you give creams, but because it doesn't work orally, they give it IV. And I've known where patients say, my daughter's wedding is coming up, or young ladies say, my wedding is coming up, let me take a few drips before the big family party, before the function. Now, this is unregulated. A doctor cannot write a prescription without an indication. The indication has to be medical more than social.
Well, Dr. Bhatia, you're in the thick of things, considering that this is one of the segments that you do operate in, injectables as well as surgery in dermatology. So just give us a sense in terms of how exactly this market for IV drips, beauty drips has flourished, and especially the unregulated part of it.
Yeah, thanks, Ekta. So the global IV market is booming. In India itself, you have clinics, and wellness centers, as we call them, with IVs and popping up. They are popping up in metros and two-tier cities. And it is estimated in India itself to grow 7 to 10% annually. Now, why this happens is because of aesthetic, promotion, celebrity culture, and social media influence. So all these three together make the common man want to keep getting these injections. And sometimes they end up not going to a medical professional. They end up going to salons and spas where either the wrong dose or an impure dose could be given by untrained technicians, which is definitely could be potentially fatal.
Okay. But can you elaborate a little bit in terms of the misuse of IV drips, especially for wellness and beauty? And how has it changed possibly in the past 3 to 5 years?
Much wants more, Ekta. So many IV drip centers, they are operating without any medical oversight, or there's no protocol, or any, for that matter, even there's no licensing. There's very little regulation, and it's more of a bulk treatment being done. And first of all, we don't know, Ekta, whether these sources where you're getting the glutathione, it comes in a 600 mg ampule, whether it is sourced legally. And this, if it's not sourced legally, this can create serious health and, of course, legal issues as well.
Okay.
So this is where I will interrupt.
Yeah.
The price of glutathione is phenomenally high. So people try to procure it in the grey market.
Correct.
And there was a lot of spurious stuff coming in. An injection, as Dr. Bhatia correctly said, of an adulterated 600 milligrams can produce immediate problems. The local anesthetic which is applied before the injection, because these people want pleasure, no pain. So the local anesthetic itself can be a cardiac stimulant to arrhythmias, drops in pressure, etc.
Or even the needle, right?
Even the needle, because there is, like he said, there is no licensing. Today, I am regulated. I have a license. Maharashtra Medical Council looks at it. There is no license. You walk down a rich avenue or a sprouting complex with skyscrapers, there'll be spas and salons delivering this. Because there are lots of people who, after the vodka shot party or for the Friday night party, are willing to go in and take a vitamin shot, a peptide drip, and of course, the glutathione.
Well, Dr. Bhatia, that's exactly the point that, we're trying to get to the crux of how unregulated this market is. If you talk about, say, for example, untrained personnel, are these nurses who are moonlighting and say, come to your house and say, okay, you can buy the glutathione or you can buy the saline or the drip required from the chemist and we'll administer it for you. They see something on Instagram and they decide that this is the dosage that they want. Is that how unregulated the market is right now?
Absolutely. First of all, there is repeated use when there's no medical need. And also they're using unapproved whitening agents like NAD, peptides, amino acids, or for that matter, combining drugs. Like glutathione is frequently combined with vitamin C and steroids. There is no evidence-based protocol on this. And these are also like, as we may call them, cocktails, gluta cocktails or glow drips, which could be used weekly or even monthly. Because what happens is when you giving an IV glutathione, the results are seen much quicker than when you take any other oral vitamins, which may take even weeks or months. So this is what's being done. The bridal packages, like Hemant sir had said, It's basically the day before the wedding, they take these IV drips, which is done at home, which I find it potentially fatal. It could be potentially fatal.
But doctor, glutathione as a whole is not even approved by the regulators for cosmetic use at this point. But it is being prescribed by dermatologists as well.
Okay, it is, of course, done by me and my colleagues also. But we know the limitations what we have. We do a blood test before that. We take a proper history if there's any history of allergies. And only then and then we will give the right dose with the right medicine. What's happening is especially people are getting IV-based. They're getting over-influenced by these influencers, bridal packages, and even the teenagers we get. So when we get teenagers coming in, we tell them, Ekta, please get your parents and come along. We need someone, no matter they offer a lot of money. We just had someone date for yesterday. Said, please get your parents along with a written consent, then we can think about it.
Okay. Well,
Supreme Court can regulate when an abortion should be done, when it is medically or socially indicated. Why can't somebody regulate whether unjust amounts of adulterated glutathione can be given unsupervised by unqualified professionals and mixed with anything? This is not a bar where you can add a little juice, a little lime, a little soda and make it a cocktail. It's going into the system, and that too directly. So it has to be.
But what are your thoughts, Dr. Thakkar, on the fact that this is not approved by the regulators and it's still being used widely?
So this is where I say that the regulators have to clamp down. So Schedule H has to come in. It's not only for tranquilizers and sleeping pills, but glutathione for cosmetic use. Neither the US FDA nor the CDSCO in India has approved it. So I cannot see how they can do this.
Okay.
It's like those hawkers giving you Louis Vuitton bags at great discounts, which people strut around and wear so that they can fit into the healthy wannabe structure. I think this is a headlight and a tower to show people that when you go unwarranted and when you go unsupervised, the price that you pay can be with your organs, can be with your life.
Okay. Well, Dr. Thakkar, we're talking specifically about glutathione, but do you strongly or do you have the same views about any other IV drips which are available in the market, say a vitamin C infusion or...
If you give too much vitamin C, you can produce kidney stones. So the dose has to be prescribed by the physician according to the indication. And quite often, it's like going in the morning, acha thoda ye bhi dal do, thoda ye bhi dal do. So that Bhelpuri is ordered by people who are not qualified. So if you give IV multivitamin cocktails, vitamin C, vitamin E, glutathione, peptides, after all, it's like using a lot of creatinine in the gym. How many young people or wannabe muscle growers taking a lot of protein supplements come with compromised kidney function? So God made the body to take things in appropriate and apportioned doses.
Well, before we get to the side effects, Dr. Thakkar, Dr. Bhatia, I wanted to understand that before you take an IV, what is the kind of pre-screening that needs to be done?
Glad you asked that, because first we do a complete blood check, which is your CBC ESR. We look for IgE, whether the patient's G6PD, which is a potential threat, fatal threat actually, and the bleeding and the clotting time, whether they're on blood thinners as well, any form of aspirin. If any of these criteria are met, Ekta, we do not inject IV.
Okay. Well, Dr. Thakkar, now tell us about the potential side effects. Say, for example, X person comes to Dr. Y and says, I would like an IV drip. What are the possible complications, or if it's at home?
So first of all, what is the need for the IV drip has to be seen. Do you have a liver dysfunction? Do you have chronic inflammation? Do you want it for the neurological problems like Alzheimer's or Parkinson's?
But what if you have no problem and you just want it because you want a boost in energy, you want to cure a hangover, or you want to look better for a certain
Hangover cures are not satisfied by single shots of IV drips. You need to hydrate yourself. Yes, I am happy if he's vomiting too much and not able to take liquids after the hangover to give him IV fluids.
Yeah.
But what is the need for me to give him glutathione unless he has liver cell dysfunction, which would be manifested by blood reports, by sonographies, long-standing alcoholism, and about looking nice.
Yeah.
Nobody has approved the cosmetic use of glutathione. You look so nice, you don't take glutathione. So the whitening does not come, it's a transient, incidental finding which has not yet been approved because the cure should not be worse than the disease.
Yeah.
So therefore that one has to be seen.
But what I'm trying to understand is that, say, for example, that anesthetic that you spoke about or the prick of the needle, where exactly are the possible risks that emerge from, say, the anesthetic to the air bubble?
Begin from the drip. What is put in the drip? How pure is it? Is it adulterated? Then when the IV line is started, is the needle autoclaved? So it is sterile, because today all needle stick inoculations can give you hepatitis, HIV, infections, etc. Then is the drip properly put? So there is no air bubble. Air bubble can travel into the system and cause cardiorespiratory problems. If it happens that you have an allergic reaction, is the center fully equipped with anti-allergic medication? If you have a severe reaction, is there a AMBU's bag or an endotracheal intubator? Is there a qualified nurse to look into it? So giving it at home, giving it in a spa, unless it is ordered by a qualified doctor who knows the patient, who knows the history of the patient. This is not a barber shop where somebody can come in and say, I want a Chakoti haircut or I want a V-shaped haircut. It's directly introducing something into your bloodstream which can reach within seconds all over the body in every nook and corner of every organ.
Absolutely. Well, Dr. Bhatia, would you like to come in on this?
Yes, I wanted to come in. And basically, like I said earlier, the cocktail regimes or the glow IV drips, usually they are overloaded or there's an overdose of fat-soluble vitamins in them. That is A, D, E, and K. And these may turn into a fluid overload or even an air embolism, like Dr. Thakkar was saying, especially in people with heart or kidney problems. And the other thing is a non-sterile technique, especially since we are dermatologists, the non-sterile technique can lead to sepsis or thrombophlebitis. And also there is another thing to be remembered, risk of cross-contamination in poorly regulated clinics.
All right. What do you recommend when it comes to, say, regulating this IV market, which is booming out of control, you'd rather say, Dr. Bhatia?
Yeah, so sadly, we are now become a country where we are obsessed with skin lightening. And due to, like I said earlier, with the celebrity influencers, actors, actresses, and social media posts coming in, how to get a better glow, there should be a control over this. The DCGI should also do audits of clinics, whether they have a proper medical license as well, and who are the trained personnel, whether they are following the right protocol as well or no, whether the blood testing is done earlier, and find out if the patients are allergic to any substances. Then they should go forward. Not like the salons and spas where, come, like Dr. Thakkar said, come, we'll give you the glow cocktail.
What if you have an underlying condition and you take an IV drip, say
Dr. Bhatia was very clear, and I liked what he said. If you have insulin resistance, if you have chronic inflammation, if you have hepatic, which is liver dysfunction, and you need the glutathione, definitely. But I would not give it in a spa. I would give it in a supervised clinic. I would give it in a hospital. I would give a finite dose. And I would not say, all right, go every time you have the vodka party and the binge, you come and take it. That's not medicine. That's quick fix.
Dr. Bhatia?
So sadly, there's an unregulated dose and frequency, and more of a, salons, they're creating a word of mouth. Oh, go over here, chalo, these guys are giving you a better rate. Of course, people are looking for another, better rate as well. Then it is administered by beauticians, which I shudder at the thought when, I don't know how they will be injecting IV, So the third part is it is sold and administered without any medical supervision. So these are all factors which can be potentially fatal. Okay. And no, sorry, may I please complete this? There's like I said, for the cocktail regimes, when it's combined with vitamin C and peptides and everything, these combinations can mostly affect the liver function, the immune response, and even the hormonal balance can be, affected. The long-term safety of glutathione is unknown.
Okay. Well, that makes it loud and clear that we don't know the long-term side effects of glutathione, or maybe, unregulated IVs is important to note. We do have some viewer questions, so I'll just request if we could just answer them briefly. Dr. Thakkar, do healthy people really need any of these vitamin injections?
No, not really, unless there is some ill health thrown in.
Okay. Is it safer to take vitamins orally as compared to, say, an IV?
So oral vitamins work, oral glutathione may not work because it is gastric problems as far as absorption is concerned. So you could take it IV if you have a medical indication.
Okay. And Dr. Bhatia, your advice to somebody who wants to look fairer ahead of their wedding, do you think you would recommend a glow drip?
First, before going into all salons and spas, I've got nothing against them, but talk to a licensed dermatologist first. Do your blood tests. Avoid black market clinics. You should know that that glow factor is going to be temporary. And we, like I said earlier, we don't know the long-term effects or the long-term health risks of glutathione. The safest options would be take care of your skin, hydrate well, and stress management.
Okay. All right, Dr. Thakkar as well as Dr. Bhatia, it has been a very enriching conversation and very eye-opening as well. Thank you very much for joining in and speaking with us. And we do have a whole host of other topics to discuss as well. If you're talking about misuse of glutathione, I'm sure there's misuse of, weight loss drugs, which could probably be around the corner as well. Thank you very much for joining in and speaking with us.
Thank you.
Hello and welcome to Business 360. I'm Arundhati Ramanan, and here are the top headlines that we're tracking for you this evening. Sensex and Nifty recover in the last hour to end with minor gains on Friday, but indices snap a 2-week winning streak thanks to a sharp fall in financial stocks. SEBI bars American trading firm Jane Street from Indian capital markets alleging market manipulation. Interim order seeks to impound gains of more than 4,800 crore rupees, the largest asset seizure by SEBI till date. Jane Street disputes the findings and says it will engage with the regulator. Reliance Retail moves the company law tribunal for an internal restructuring, seeks to house the FMCG business under new Reliance Consumer Products, which will be directly under Reliance Industries. The move could set the stage for an IPO. Dalmia Bharat is the highest bidder for debt-ridden JP Associates with 14,600 crore rupees, followed by Vedanta and Adani. Most bids are conditional offers and hinge on resolution of Sports City land dispute. President Trump says US will start sending letters to countries specifying what tariff rates will be imposed starting today, floats potential tariffs in a wide range of 10% to 70%. No official word yet on a possible mini trade deal between India and US as the 9th July deadline looms. US lawmakers passed President Trump's sweeping spending and tax bill, handing him a first major legislative victory in the second term. Democrats call it a dark day for the country. The bill is estimated to add more than $3 trillion to the US national debt. India is always top of the list and presents a huge opportunity, says the global CEO of Deutsche Bank, Christian Sewing. The bank has recently pumped $800 million into India. That's an exclusive. More than 60 people are dead as torrential rains and cloudbursts wreak havoc in Himachal Pradesh in the last 2 weeks. The state estimates property damage worth over 400 crore rupees. World chess champion Gukesh beats world number 1 Magnus Carlsen once again. Chess legend Garry Kasparov says questions can now be raised about Magnus Carlsen's domination of the sport. Straight to the day's market action. Sensex and Nifty recovered in the last hour of trade and ended the day with marginal cuts. Nifty held on to the 25,400 mark, and this was largely supported by IT stocks and ICICI Bank. For the week, however, the market snapped its 2-week winning streak, with Nifty and Sensex falling 1% each. The mid-caps outperformed the benchmarks, also gaining nearly 1%. Surbhi Upadhyay joins us now with the day's market action. Surbhi?
Well, it's been a Friday that ended pretty much in sync with how the rest of this week has been, and the week has been all about consolidation. The Nifty moving in a 250-point band and really unable to make a decisive move on the way up. The bias in this consolidation has been slightly negative, though Friday was better. At least we didn't break through on the downside of the recent trading range. So let me talk about how the numbers stack up. The Nifty is down just about 0.7% for the week. The mid-cap index and even the small-cap index, they've done better. Those indices have managed a 0.3, 0.4% kind of a gain for themselves. So the issue with the market largely is the large-cap space where there's no clarity. It seems the market is pausing ahead of big triggers that are coming up ahead. Number one would be earnings. Number two, of course, would be clarity on US tariffs and our own deal with the US, the India-US bilateral agreement. And number three, the upcoming GST meeting, which could offer far more clearer clues on what it means if there are any major slap changes. FPI flows have been patchy right throughout the course of the week, and that explains the selling on the large cap side of the market. The market's also been reading into a lot of the first quarter updates that came through. Case in point would be Trent, and that gives us a sense of how the market is positioned. Trent came out saying that they have had 20% revenue growth for the quarter, which is far slower than what Trent has been doing in the past. The result, a 12% crack on the stock. So it's telling you that the market has no appetite for poor earnings or for slow growth, especially where stocks have already rallied. Let's talk about some of the key gainers of the week. The gainers included the Consumer Durable Index. Healthcare and pharma did pretty well today, a little bit of a defensive bias in the market. PSU banks did well. Defense saw buying. On Friday, we had the news of the Defense Acquisition Council looking at procurement of proposals worth over 1 lakh crores. So a lot of the defense stocks were up and about. And the IT index has done well, 1% up, as that's the next big event. We start off the season with IT earnings. So IT stocks actually seeing some buying ahead of that event. Talking about the losers, real estate was down a little over 2%. And then it's the entire financial landscape. Whether you're looking at the Nifty Financials Index, the Nifty Bank itself, which has been an underperformer, or the capital market space. By Friday, we had the Jane Street episode, which was further weighing on sentiment, but that remains, a soft area for the market as well. We have to go forward and look at, of course, the big headlines from the US, including how markets will react to the passage of the big, beautiful bill. Because remember, yields have been spiking up right after the jobs report. So promises to be an action-packed week ahead.
An action-packed week ahead indeed. Thank you, Suri, for those details. Now, market regulator SEBI has imposed an interim ban on US-based trading firm Jane Street Group and its related entities from accessing the securities market. Now, the entities will be prohibited from buying, selling, or otherwise dealing in securities directly or indirectly alleging market manipulation. SEBI has also impounded unlawful gains of 4,843 crore rupees from the company. Jane Street says it disputes the findings and will further engage with the regulator. Hormaz Fatakia joins us now with more details. Hormaz, take us through this interim order from SEBI.
What is a Friday if it is not crazy? And the SEBI order on Jane Street has ensured that for all of us today. The market regulator has banned Jane Street and its group entities from accessing the capital markets in its interim order that was uploaded last evening on its website. Now, as per this order, Jane Street made unlawful gains to the tune of 4,843 crore rupees through trades between August of 2023 and May of 2025. This entire amount will now be impounded, the largest in India's capital market history. SEBI has ordered that this impounded sum will have to be deposited in an escrow account which can be opened in any scheduled commercial bank, and that no debit will be made without prior permission from the market regulator. Now, Jane Street has been given 3 months to square off or close any of their existing positions or until the expiry of such positions, whichever happens earlier. Now, this matter goes back to July of last year when SEBI, the market regulator, had asked the National Stock Exchange or NSE to examine the trading activities of Jane Street to ascertain any market abuse. The report for this was submitted by the exchange in November of last year. Now, a month later, SEBI discovered that certain entities were running the largest risks in cash equivalent terms, mostly on expiry day. Now, cash equivalent in FNO terminology is liquid instruments that is easily convertible to cash, which can then be used as collateral to trade. Now, in February of this year, SEBI found prima facie that Jane Street was engaged in activities which were in violation of the regulator's PFUTP or Prevention of Fraudulent and Unfair Trade Practices regulations. As a result, SEBI asked the NSE to send Jane Street a letter of caution to dissuade them from taking any positions that could be manipulative in nature. However, the regulator found in May this year that Jane Street was in complete disregard of the caution letter and still running large cash equivalent positions, which was not only a violation of their regulations but also their own undertakings that Jane Street had given to the regulator. And it is this what led to the issue of the order last evening. That's not all. Last year, SEBI had put out a study stating that out of 9 out of every 10 retail traders lose money in the FNO space. How much did Jane Street earn? Not 1, not 2, but 36,500 crore rupees between January of 2023 and March of 2025. But what is Jane Street? Now, a global proprietary trading firm, 2,600 employees across the US, Europe and Asia, uses algorithms to identify trading opportunities in the market, and it's trading in over 45 countries. Now, does this order bring us to the end of this issue? Well, not yet, because Jane Street has contested the findings of the SEBI interim order and will be reaching out to the regulator regarding this. So it's only part 1 that has come to an end. We'll await to see more as the events unfold.
All right, Hormaz, many thanks for taking us through those details. So how did Jane Street manipulate the markets according to SEBI? Anuj Singhal is here with the modus operandi.
In a nutshell, what was happening, especially on the Bank Nifty, while the other order on Nifty and Sensex may also come. For example, on Bank Nifty, and we always say that Bank Nifty is very lopsided index. Why was this more prevalent on Bank Nifty compared to Nifty and Sensex? Because on Bank Nifty, you have 2 stocks, HDFC Bank and ICICI Bank, which primarily account for almost half of the index. So, you have one HDFC Bank which moves 1%. Now, you move HDFC Bank 1%. Suppose you sell a lot of HDFC Bank, but before that you bought put options of Bank Nifty. And that HDFC Bank falls by 1%, but that put option from 100 rupees becomes 400 rupees. So that's the 4x return. And that is where you obviously when HDFC Bank falls all of a sudden, some funds will come and buy HDFC Bank and the price will eventually go back to the equilibrium. And that's what was happening. Even if you look at yesterday's price move, look at what happened intraday in a lot of stocks. And that is where you will square off these positions and make huge money. So if you see the table, in index options, they made 43,289 crore, but they lost 7,680 crores in futures. Because that is where, you ended up losing the trade. The same would happen on the other way around. I mean, if you're buying call option and, you're doing that. So eventually that, in a nutshell, is what was happening. The market impact, you ask me, the market impact would be restricted to 2 or 3 stocks. Yeah. I think BSE, for example, today could be one of the biggest casualties because, a lot of volumes on BSE, I am told, were being generated by hedge funds. So in that sense, there could be some impact, though my sense is at lower level, even that will see some buying because, first of all, this is not a final order. And second of all, I think this is going to escalate.
All right, Anuj, many thanks for those details. Meanwhile, Zerodha CEO Nitin Kamath said if SEBI's allegations are true, Jane Street engaged in blatant market manipulation. He also added that F&O volumes are likely to drop since trading firms like Jane Street account for 50% of options trading volumes. The fears were visible on Dalal Street today, with shares of brokerages like Nuvama Wealth, Angel One and stock exchanges like BSE saw sharp cuts. Moving on, Reliance Retail has approached the National Company Law Tribunal for internal restructuring to house FMCG business under a new subsidiary. The new vertical will be held directly under Reliance Industries. Ashmit Kumar is here with more of those details. Ashmit, take us through how Reliance Retail is planning this restructuring.
Well, clearly a move being made by Reliance to house all the FMCG businesses under one roof, and to that end, we understand an application has been made before the NCLT. In this application, they're essentially saying Reliance Retail then goes on to say that there are the status quo is that there are 2 subsidiaries of Reliance Retail which are housing these FMCG businesses. The attempt is to move all of them under one roof, under one new entity called New Reliance Consumer Products, which will directly be a subsidiary of Reliance Industries. The rationale that has been put before the NCLT is that the retail business is very distinct, very different from the FMCG business. The FMCG business has its own dynamics. It requires focused investments, which it will now be able to attract if it is now hived off as a separate entity. It requires autonomy to realize its own strategic goals. These are all aspects that were laid out before the NCLT. The NCLT, on its part, as a matter of procedure, has asked these Reliance Group entities to reach out to their shareholders, to secure their approval, to reach out to the lenders, creditors, both secured as well as unsecured, to get their approval going forward. Also asking them to reach out to government entities, GST authorities, income tax authorities, to put on record any disclosures they may want to have in terms of contingent liabilities or litigations. And it's after that that the NCLT will consider this application for hiving off the entire FMCG division under one roof.
All right, Ashmit, many thanks for those details. Now, the race to acquire debt-ridden Jayaprakash Associates continues to gather steam. Sources have told CNBC-TV18 that Dalmia Bharat is the highest bidder with 14,600 crore rupees. However, most bids are conditional offers. Ritu Singh is here with all of those details. Ritu, who's bidding how much and what are the conditions here?
Well, some of India's biggest corporate houses, including Adani, Vedanta, Dalmia Bharat, have submitted offers to acquire Jayaprakash Associates, but there is a major catch. Most of these bids hinge on the outcome of a land dispute that is currently pending in the Supreme Court. Now, in absolute terms, and remember the bid includes many components, we understand it is Dalmia Bharat which has placed the highest offer of more than 14,600 crore rupees. But if JP's Sports City land dispute in Noida is not resolved, they could cut their offer by around 2,000 crores or even more. Our sources also indicate Vedanta Group has offered about 13,600 crore rupees. But again, if the land issue is not cleared, they may withdraw their offer altogether. Then you have Adani Group's offer at about 12,250 crore rupees. It also includes NCDs that are payable over more than 4 years. And while their bid is also conditional, our sources indicate Adani's offer may stand irrespective of the land dispute outcome. Then you have Naveen Jindal's Jindal Power, which has bid 10,300 crores, also contingent on the land dispute, and PNC Infratech is the lowest bidder at 9,500 crore rupees. Now, here is the core issue to remind our viewers. Around 1,000 hectares of land under JP's Sports City project was cancelled earlier by YEDA, and that was upheld by the Allahabad High Court, but JP's resolution professional has moved the Supreme Court to challenge it, where the case is currently pending. Now, these are just the first round of bids, remember, so there will be negotiations and even possible revisions to the offers that follow. So we'll have to see who comes out on top, but the process itself is far from over.
So Ritu there with the latest on JP Associates' resolution plan. And staying with court action, Supreme Court has refused to grant interim relief to HDFC Bank CEO Shashidhar Jagdishan in the Leelavati Medical Trust case. While hearing a plea filed by the CEO, the court said that it cannot get into the merits of his case and has directed him to wait for the next hearing of the dispute at Bombay High Court. However, the court also said that Jagdishan's plea has been listed 4 times in the Bombay High Court without a hearing, and it trusts that the plea will be taken up in the upcoming hearing, which is scheduled for the 14th of July. Former SpiceJet promoter Kalanidhi Maran has moved the Supreme Court challenging Delhi High Court's order dismissing his claim for damages worth 1,300 crore rupees. Maran is seeking damages from current promoters of SpiceJet, and this battle has been going on since 2015. The claim had previously been rejected by the Arbitral Tribunal and the Delhi High Court. Apex Court will hear the case on the 18th of July. On May 23rd, Delhi High Court dismissed Kal Airways' plea by calling it a calculated gamble. A hearing has been scheduled to be held on July 18th at the Apex Court. The Petroleum and Natural Gas Regulatory Board has approved the second amendment to the natural gas pipeline tariff regulations. The new regulations will introduce a set of changes to simplify tariffs and improve access to natural gas across the country. The norms also aim at reducing the number of unified tariff zones from 3 to 2. On that note, it is time for us to head into a short break. But coming up next, President Trump says U.S. will start sending letters to countries specifying what tariff rates will be imposed starting today. Details when we come back. Stay tuned. Welcome back. You're still with us on Business 360. In international news, U.S. President Donald Trump has announced that his administration will start sending the tariff letters to countries starting today. The letters will inform these countries what tariff rates they will face. Speaking to reporters before boarding Air Force One, Trump said these countries will be expected to start paying tariffs from the 1st of August. And the tariffs will range in value from 10% to 70%. He also added that negotiating individual trade deals with over 170 countries is a complex process. This comes at a time where India and the United States are inching closer to sign a mini trade deal next week.
So we're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs. But they're going to be starting to go out sometime tomorrow. We've done the final form, and it's basically going to explain what the countries are going to be paying in tariffs.
U.S. lawmakers have passed President Trump's sweeping spending and tax bill, handing him a first major legislative victory in the second term. Democrats have called it a dark day for the country. The procedural rule voting saw one Republican representative joining Democrats in opposition. The legislation will extend tax cuts President Trump signed into law in 2017. The bill is estimated to add more than $3 trillion to the U.S. national debt. And staying with Donald Trump, the U.S. president held a phone call with Russian President Putin last night. Speaking to reporters today, Trump said that he made no progress towards a potential ceasefire during the call, adding that he was not happy with what was happening in Ukraine. He added that both the leaders spoke about many topics, including Iran. Meanwhile, the Kremlin said both the leaders held a frank and substantive chat. Israeli forces have intensified their attacks in Gaza, killing more than 100 Palestinians, out of which 51 were waiting for aid. Hamas has said that consultations have begun on a latest proposal for a temporary 60-day ceasefire in Gaza, and the group will submit its response to mediators. Reports have said that Hamas is seeking guarantees that the ceasefire proposal would lead to the war's end. External Affairs Minister S. Jaishankar will be commencing his 3-day visit to China from the 13th of July. As per News 18, this will be the minister's first visit to China after both nations decided on the patrolling agreement last October. He will be visiting Beijing for a couple of meetings, after which he will attend the SCO Foreign Ministers meeting. Deutsche Bank CEO Christian Sewing has said that India is always top of the list and presents a huge opportunity. Speaking to CNBC-TV18, Sewing added that India is also a strong source of innovation and technology for the world. The bank has recently pumped $800 million into India. Take a look.
Let's talk about why you're here in India and how India is playing itself out in this era of volatility. You've just met with India's Commerce Minister Piyush Goyal. What's the read on India at this point in time?
Well, first of all, thank you very much for having me. It's a pleasure being here. It's a pleasure being in this country. To be honest, that meeting was very positive, but the overall spirit in this country is outright positive. I've been here now for 3 days, and I have to say I'm amazed by the steam, by the drive, by the passion, you know, it's an economy which is obviously outright growing. It's actually with whomever you talk, the story is growth. And it is also coming, obviously, from Germany, being one of the leading European banks, looking at our clients. Our clients are actually looking to India out of the lens of this is an opportunity. A lot of global clients, a lot of multinationals, but also family-owned companies are in the process of reorganizing their supply chains, their production chains, and India is always top on the list. And that is, from a Deutsche Bank point of view, a huge opportunity for us. We have been here for 45 years. We have 23,000 people. We are growing immensely. We just put $800 million of capital into India. So we want to grow and our clients want to grow. So it's a very positive story. So I'm excited.
And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Hello and welcome to the special edition of Voices from the Valley. I'm Shireen Bhan. My guest today is a serial entrepreneur. He decided to make the Valley his home over 4 decades ago, and he's been part of the chip and microprocessing industry and has really watched it change, evolve and grow. Today, he's betting big, not just on AI, but specifically on the digital story that India is hoping to ride on. Joining me today to talk about his previous ventures and, of course, his vision for the future is Raju Vegesna. Thanks very much for joining us. And what a wonderful view we have here. And it's the most appropriate to get your view on how things are shaping up. But let me start with your story going back 40 years when you decided to come to the US to pursue your master's degree. And you never left. And you decided to start up 4 ventures on. What was it that gave you the confidence to say that this is going to be home?
So I think coming from India, right, and the opportunities United States provided, it's a great opportunities. You can look at it. What is United States?
Yeah.
And that started building my base. Then now I'm expanding to India. So my confidence is, I think the technology is continuously is going to evolve.
Yeah.
And if you are on it, I think you're never going to be lose, That is my confidence.
So let's talk about how you actually started. And life for you or work for you began at Motorola, and you were part of the microprocessing and chip industry going back almost 4 decades. From there to where we are today, this battle between NVIDIA with the lion's share of the market, AMD trying to sort of get into it as well. How do you see the chip wars today?
So the way I look at it, I started with the semiconductors in the 80s. And there is a big semiconductor boom at that time.
Yeah.
Then afterwards, internet came.
Yeah.
And afterwards, the social media. Now is AI. So I'm seeing this 4th wave of AI. So what I see is this is technology is going to be evolved, and they're going to be, people who can take the lead. When in the microprocessors, era, how is Intel took the lead.
Yeah.
And now, NVIDIA is taking the lead in AI. And I give a lot of credit Jensen and team, innovating a lot of new technologies. Not only they're spending the money and investing, and then also the kind of the things they're doing to the world. It's the greatest things, And I think they have edge. But there is no business is going to be monopoly.
Yeah.
Over the time, I think people is going to be innovate new things, and there will be a great competition. And that is the way I look at it, is the technology is going to be evolved. But give a credit, Jensen and team, they're doing excellent job to driving this technology, and they're investing continuously and working. I know Jensen very well. He works very hard, and I give the credit a lot of taking the lead.
Yeah.
I think that's what world needs.
Is for leaders to drive innovation. But when you started your first company, your first venture, what was it? What was that spark that made you want to start up in 1988 as a 28-year-old?
So one is I came up always in my body a bug, having owned my own company. So after working for Motorola 4 or 5 years, when my boss started, let's Raju start a new company.
Yeah.
And I already have in my mind, I want to do something new. And so sometimes, you don't have so much baggage in your head.
Yes.
And you want to try.
Yeah.
So that's what motivated me to start. And I never looked back. So when I was a hardcore microprocessor designer.
Right.
And building very tough microprocessors. And that's the way I started my career. So that is my fundamentals of, how I build up my career, building the startups.
Yeah.
So after the, first startup, Ross Technology, doing the microprocessors, then I did the company called ServerWorks. Moved from Austin to Silicon Valley.
Yeah.
Like everybody thinks Silicon Valley is the, is intellectual and everywhere.
Yeah.
The kind of technology, I believed in that. So I moved into the Silicon Valley. I started a company called ServerWorks, designing chips around processors, Intel processors. And that is the way we put, Intel processors into the server market. And we captured good share of the market, worldwide market.
Right.
Then we sold it to the Broadcom
for $1.8 billion.
1.8 billion plus.
And that was huge money back then.
Yes, it's huge money. And also, it's not only the huge money. One of the things our venture is different is there is no venture capitalist funded.
You never wanted to take on any VC funding?
No, never. Because for me, venture capital is more of a money than a strategic partner. Always I look for a strategic partner.
Right.
So we found a strategic partner, Fujitsu from Japan.
Yeah.
That is the way we started the ServerWorks. And the journey went very well. Then after we sold it to Broadcom acquired ServerWorks, we started Server Engines.
Yeah.
And that is basically a convergence between the network and storage technology. So that is, again...
And exited that as well?
Exited that with Emilex. Bought that company.
Yeah.
And then, after doing 3 startups in US, and I have a crazy bug in my head, I want to do something always in India.
In India.
And that is a bug, and I'm spending last 15 years. And before SIFI, I never exposed it to
the Indian market.
Indian market.
Yeah.
Because I never worked. As soon as I graduated from my Bangalore University, I moved to US. So first experience is SIFI. So it's a great learning experience. And working in US and working in India is completely different. If you are running an operation company, it's a different. Culture is different. People are different. And priorities are different. So ownerships are different. So that's what we are looking at. And last 15 years, we made a great progress in SIFI, changing from consumer-centric company to enterprise-centric company, and building one of the biggest enterprise network in the country, and building one of the best data centers in the country, and building one of the best private cloud platform. So what is we are positioning SIFI is the digital infrastructure company of India. That is my vision. I want to drive to be digital infrastructure. I think that's what absolutely required for in India. I think how much you build physical infrastructure, I believe digital infrastructure is the most important. And that is where we focus.
Well, talking about building digital infrastructure in India, you talked about data centers as well. And this is going to require enormous amounts of capital, and that's the kind of commitment that you're willing to make. So take me through the CapEx plans that you have outlined.
So we started, from our own cash, funding the data centers. Now also we took some investment from Kotak.
Right.
One of the reasons, you can ask why you took money from Kotak, you never took from anybody else. I have a lot of respect the group of Kotak, and especially the way Uday Kotak runs the company. And I want to have some validation. Having that kind of investment. It's not the money we cannot invest, but I think that brings a lot of value into consideration. And that is the way we started. And there are plenty of money is available. And I think it's a question of the thing how much we invest. Probably we are looking at investing probably $5 billion by 2030 to building the data centers and the network.
So $5 billion over the next 5 years by 2030, that's the CapEx plan for you. But let's talk about the data center expansion as well as the data center explosion. I mean, it almost seems like there's not going to be enough with the kind of demand explosion that we're seeing. I mean, has this surprised you?
No, I don't.
No,
I'm not surprised, because if you're looking at even forget about before the AI, even the cloud models, I think it requires a lot of the data centers. So especially a country like in India, we are still IT usage is small. I know people can buy the IT in the corporations, but having this cloud, either hyperscalers or a private, public, or hybrid, this gives us the usage of IT in India across the thing is much better. So I think the potential for IT usage in India is very high because it's a long way to go.
Right.
And having 1.4 billion as the corporations are built to serve this 1.4. Second is now this AI. AI gives the next kick, demand. So having AI requires more demand of cloud and the data centers. That gives also next growth of the data centers.
Right.
So I'm not surprised, and it's going to be continuously growing. So for me, 5 billion. There is a lot of people is going to spend 5 billion in India, and I'm going to be one of them. One of them.
But you're also looking at moving outside of the big cities now and address the smaller cities in India as well. So, innovation, but inclusion as well. That's one of the pillars that you're working on.
Yes. The way I look at it is in India, it's not only the 6 or 7 metros we have. The way I look, next 20 cities is going to expand, like Lucknow. Or Vizag, or Chandigarh, Nagpur. All these cities is going to grow because the kind of populations we have, the kind of growth is coming, the kind of consumer market. When you look at the malls in these cities, how much populated in these malls. So to support the enterprises, we need the technology close to that because some of these inferences workloads are a low latency requirements. It has to be expanded into this close to the eyeballs. So all those requires demand such edge data centers. It's not just providing a POP or something. It's there's a confusion between a POP versus edge data center. For a network, POP is important. It's not much workloads, but when it comes to the edge data centers, really you are doing a good amount of work at the edge. That is the way I look at it. So that's what we are working on it. So building in these 6-7 cities major data centers and 12 to 15 edge data centers requires a lot of capex. And that's what we are focused by 5 billion. It's a good plan, and it's not the thing we are going to spend in one day. It's by demand. So we build the basic building blocks, and then we can expand. So for example, our 150, 130 megawatts of data centers, we will start with 20 megawatts, and as the demand comes, we're going to expand. But we will build the basic infrastructure required to go for 130, 150 megawatts. Similarly, the small edge data centers, ultimately we want to build 10 to 15 megawatt, but we'll start with 3 or 4 megawatts
and then cater to the demand as it kicks in. But as someone who has observed what is happening in this industry over the past 4 decades, one aspect that is probably the biggest headwind at this point in time is the cost. You believe the cost of inferencing is going to dramatically decline or decline? I mean, and what will drive that? More competition obviously will drive prices lower, but what do you believe could be that trigger?
I'm a believer of technology we have to offer at the lowest cost. That is fundamental principle of the technology. See, technology is, when it's, I feel as a technologist, it's more people using. So when I build my chips for Serverworks, my kick is 95% of the worldwide using my chips. And
where all was the chip being used? Tell us that.
No, when I designed, when we developed those chips, it went to all the servers. When internet boom, I was not predicting I was doing the chips for the servers, but the internet boom came, and we are one of the biggest player, and all Intel processors, around Intel processors, our chips are used. So being, Intel is the very cost-effective solution at that time. Intel and the Microsoft, Windows, for a server market, we captured that kind of market. So similarly, with AI, the way I look at it is ultimately it has to be, available for a common man, like the way internet is available today. It's going to take time. A country like in India, it may take a little bit more time because we are more cost-effective solutions. Solutions will come.
Yeah.
Today maybe the GPU cost is very high.
Yeah.
But over the time, innovations will come, and there will be competitions. I know in Silicon Valley, probably more than a dozen companies are designing GPUs with a different aspect. And probably half of them or 1/4 of them will be successful. And then we will have much cost-effective GPUs. And that's the way the world is changing. And, NVIDIA and Jensen is going to drive the top end. And then people is going to drive the other aspects of the AI. AI is not one aspect, it's going to be evolved. Just we are seeing just at the beginning. And over the time, it's going to be there everywhere. Like the way internet is there everywhere.
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 AI everywhere. You talked about GPUs, and I think this is the possibility that everyone is talking about at this point in time. A made in India GPU. Do you believe that we're ready for it? Do you believe we're on the cusp of seeing that become a reality? Is that a dream that you have?
I think the way I look at it, I was thinking, see, India is a consumer of technology, the phase one. The phase two is we are a contributor for the technology. If you look at it, the kind of work our people are doing in Bangalore, Gurgaon, Noida, all the major, Hyderabad, Chennai, are major, 6-7 spots. What you supporting GCCs, GDCs. That is our contribution, right? So what is next stage? So I think that is done already. What is the next stage? Creation of technology. I think it's going to happen. It's going to be happen, and it's a question of the time. I think that is my dream, is coming AI chip out of India.
Your dream is to see an AI chip coming out of India. I know that you're also working with the government, you're talking to the government. We have the AI mission, we have the semiconductor mission. Do you believe that that's enough? What more do you think we need to do? How do we involve the private sector more? Should the government involve the private sector more? What will make the Make in India chip happen?
See, my belief is, I don't think we have to depending on the government for everything. Government does what it does to bring the social, economics. I think industry has to take that kind of a risk and have a passion to build the AI chip. I think that's what I believe India needs it.
Are you going to consider doing it yourself?
I may.
Yeah.
I will, and at some point, and I think not too far. I think my dream is producing AI chip out of India. And because...
Have you started working on that dream?
I'm working in my head.
The idea in your head to the idea on paper?
It's not the money. It's not the vision. it is the assembling of people, not too many people, probably 150 to 200 people with the same passion and have a hungry to develop for India. Once we assemble such kind of people, I think we can do it.
Are you going to find those people here in the valley, or do you find them in India?
I think hybrid.
Hybrid.
Yes, I think looking at experience the last 15 years in India, there's plenty of talent is available, especially the city I graduated, Bangalore.
Yes.
A lot of great chip designers, and augmenting with them the chip designers from Bay Area. I think we can do a kick-ass AI chip.
Well, we look forward to that, and we look forward to you making that announcement as and when you're ready to do that. But you've interacted with technologists, but you've also interacted with so many entrepreneurs who've built great companies here in the valley for the rest of the world. Which have been some of the standout companies that that you believe have had a transformational impact, and that you saw that when you first met them?
So the way I look at it, I interacted with Apple in 80s, right? I interacted with Google. All these companies have one thing, is entrepreneurship driven and passion. Even Oracle, Larry Ellison, right?
Yeah.
The kind of passion he has. See, that is the kind of, the product concept. That is what I see the valley is different from rest of the world, They want to make best products, and they can see the thing, what is a customer or a corporate needs to solve the problems, That's what I see the passion in these companies. I have a lot of respect all these companies, and I met most of these people in my career, and I learned a lot from them. And I think that's what is, I don't say one company, but the way even Elon Musk is doing, and he's amazing, the kind of things he's doing in a different things. It's not just one company, he's building 3-4 companies simultaneously, and it's mind-boggling, having that kind of vision and capabilities, it's not the question of the money, having passion. I think that's what, ultimately, I think we'll get there in India.
But and that's what I want to talk to you about, because as you said, that what separates these companies that you spoke of from many others is the passion to build product.
Yes.
And the journey from being a services economy to a product nation, that is the journey that people believe India must now start to accelerate, must now start to take into the fast track. How do you believe we make that journey? What do you believe needs to be done to ensure that we actually pick up the pace on that journey as well?
So my belief is, I don't think there is any technology company in India today will do that. I think it's the new entrepreneurs and new risk takers. Those are the people who is going to build the products. And the current so-called technology companies are tuned to the services, and they have their own challenges, and their mindset is different. So to build a product company, you need to have passion, and you need to have a time, and you need to ready to take a failures, and you need to get up and do the next startup. So that is the kind of passion people have to have.
Will you back that next startup?
Yes, and I not only back, I will be part of it. It's not, see, for me, it's not I'm a financial kind of, advisor.
You're a technologist at heart.
Technologist. I want to assemble those kind of people and work with them to make it successful, That's what it is.
So what could potentially the fifth venture be? We've already talked about the aspiration to do a made in India GPU, but what else could you be looking at?
I think at least, I can see the stack associated with AI. I think it's going to keep busy for next 10 years. I think it's just you seeing, it's not just starting from, chip and then, looking at layers on top of it, going through the application, service layers, like you're talking agents and all these things, right? So different layers. I think just we started. I think they're going to take a lot more time and a lot more, thinking how this is going to be evolved. it's going to be next 15 to 20 years. This is going to be continued, no? And if you look at the internet when it came in late 90s, and you see how much still evolving. Probably 90% is evolved, but still is evolving. So that's the way I look at it. It's going to take time, 10 to 15 years to get there. I think in this process, I see India has a great opportunities, and these entrepreneurs in Bangalore and Gurgaon and Noida. I think this is great opportunity for them.
Are there Indian startup companies that you like? I mean, that have got your attention today?
I didn't focus much but I will start focusing on this. And I see those kind of, when you go to a nice restaurant or a bar, you can see those talks. And see, because I seen Silicon Valley from 90s, 2000s, and similar kind of vibe going in these cities. It is a question of the time. It's going to happen.
You now split your time between the Valley, which is home for you, and India. How do you see yourself giving back outside of everything that you're doing for SIFI, but how do you believe that you could play a larger role outside of business? I know you're also looking at philanthropy at this point in time. What's the plan there? What are you hoping to see there?
So what is, I don't know whether you know, I have a foundation called Rajiv Vegas Foundation. I started about 20 plus years ago. So we do a lot of clean water. I believe, water is one of the things is very important for health. Then we build some hospitals, and then we build, poor people homes and education. So we are contributing over the 20-25 years, but we don't brag much because that should be, kind of the things what is God gave us this thing. I think we should contribute that, you should not talk more about it. So that's the way you look at it. You can look at it, our foundation, Rajiv Vegas Foundation, and we are doing for last 25 years. That's the way I look at it. See, beyond that, my passion is, that is one aspect of it, helping the poor or whatever it is. Second is helping, coaching, and creating the jobs. For me, creating a jobs, especially now with AI, we have to do it next level. It's going to be more skill jobs, whatever you call it. So helping how India can transform to these more skill jobs, that's where I'm looking at. That's the reason one of the things what we are doing, going into these tier 2, tier 3 cities, where people are worried, how this AI is going to be eliminating the low-skilled jobs. Yes, any technology changes, comes, it will eliminate some jobs. That's normal. But how do we handle that? Make the people more skilled to take the next thing. And that's the way, they will have better challenge. I think that's the way the humankind will evolve. And that is where I want to contribute. For me, that's more happy than creating more jobs and more high-skilled jobs. I think that's the way I look at it. It's my contribution to the society.
You know, as a technologist who's seen 4 big tech changes, tech revolutions, and with what you're seeing happen today, the change that's taking place and the pace at which the change is taking place, you know, do you feel excited? Do you want to like become an entrepreneur all over again and do your 5th and 6th and 7th venture, or do you believe that you know this is a tough environment to actually start up in comparison to your previous ventures?
I don't believe it's tough environment. People think I had a, you know, your generation had easy life. Not like that. I looking at every generation
has its own complexities.
Its own complexities. But if you look at it, right? You know, when we are growing up, you know, going to the schools and all these things, doing the homeworks and all these things.
There was no Google, there was no ChatGPT.
Now, no ChatGPT. Now, you are getting a better tools. How do you use these tools to do the next level? That is the way I look at it. There is no, you know, entrepreneur, there is no challenge. I don't believe one environment is easy other than. So you have to be, you know, change yourself to fix into that environment. That is what I call the true entrepreneurship, you know. There's nothing, you know, people will be lucked, you know, some, you know, win, but they're done with that thing. But for me, doing, you know, these 3-4 generations of the startups, for me, I look at it, the AI, you know, what is the opportunities is going to go, and beyond AI, you know, all this stuff. It's a continuous journey, and that's the way, you know, one of the, you know, I want, God's give me the gift, still working until, you know, my life went, you know, creating new companies and new entrepreneurs and creating more jobs and working with the smart people around me. And that way I will not have a dull moment, you know.
No, clearly not a dull moment. But, you know, let's talk about some of the potential headwinds as we move through this era of AI and data centers linked to that problem. Power. And, you know, renewable sources of power, now everyone's talking about nuclear power, and that's sort of seeing a resurgence at this point in time, small modular reactors. How do you see that? And is that a space that you consider wanting to look at all?
No. Power, see, if we look at India, right? India has so much of power. And before this government, we had a problem connecting all these resources. Once this government came, it's connected all the powers together. So India never be shortage of power. You know, the power generation. Power generation never be a problem, never been a problem. Now, with the renewable energy, with the sun and wind, I think that is one of the gift God also gave to India. I think we can use that renewable energy to augment the other sources. I think that is one of the advantages we can take advantage of. And then I don't know whether we need the nuclear or not with our, you know, solar and wind power already have. If needed, we can use that also. But that way, I don't believe India will be shortage of power. I think India will have a lot of power. And see, the way you are asking me for AI, when I look at the stack of AI, you know, one is we have to build a good data centers. SEBI shown building a good data centers, not one. We shown in all 3 regions, in Mumbai, Chennai, and Noida. We are one of the first certified by NVIDIA, liquid cooling, 130 kilowatt per rack. It's par with rest of the world. There are only 6 people can do it. And 6 people in the globe. I'm not talking India. And then we build one of the excellent network. Then when you're building a data center, it's not just building a beautiful building, you know. It's not, people think data center is a real estate. Data center is not a real estate. Data center is a technology. I want to tell the real estate people, it is going to be a technology challenge. It's not a building. Yes, you can build a nice building, but how do you connect the data center with the rest of the world? You know, you need to look at a good fiber network. Then the other point is renewable energy. How do you going to secure the good renewable energy? And how do you make these operations more effective? See, in the data centers, to operation, there will be thousands of variables. So now what we did, you're asking me AI. I took advantage of AI. Our data center operations using AI ops, we automated. See, that is where I look at it. It's very important. how do you look at it as a technology?
Yeah.
And as the AI technology is getting more and more complex, I think you are going to build these data centers much more complex. So that is where that it's a technology center. It's not just a data center, you know.
Yeah, it's not a real estate play.
Right.
What are some of the other myths that people have about data centers? What are some of the other assumptions which you believe are false assumptions that people have about data centers?
Yeah, people think data center is a real estate game. Data centers is a technology, and you know it's getting more and more complex. And if you look at the AI, the way it's going to be more complex, and it's a technology. And the way you use equipment, the way PUE, power efficiency, how you're going to get, and water efficiency, and energy, and all those things, carbon, footprint, how you're going to consume. And the IT technology is evolving around it. It's going to be much more complex. And maybe people thinking, okay, it's a real estate game, I can build a nice building and add them into my portfolio. But that is, I think that game is over,
That game is over. Yes. We're talking about chip manufacturing in India. We're going to see the first chip being rolled out of an Indian fab, hopefully by the end of this year. Players like Tata's are now in the fray. What excites you about that story? But also, what do you believe industry needs to keep in mind and be sensitive of as we start commercialization?
So I think that's a great start. I think I don't know whether at this point India can build top-notch chip fabs, because that is going to be very expensive. And also you have to have a consumption. Building is one thing and having utilized. Otherwise it has a time and it's going to be outdated. So there's not going to be enough return of the investment. So beyond the top, state of the art, there are other semiconductors you can do around it. Let's start with that.
Okay.
And building the ecosystem around the semiconductors and go step by step. In my view, being in a semiconductor guy, it's not a day process or a year process. It's probably 30 years. So, when people talking about we are investing 10 billion, I think 10 billion per year, next 30 years. I think if government can commit, or whatever it is, private industry can commit, that kind of a 10 billion per year, and next 30 years, I think India will see a light. It's not going to be a 5 years, 10 years plan. If you want to be one of the top recognition of the semiconductor, that is a long-term process. Because
it's a long-term process, it's a big capital commitment.
Yes. Yeah, and the commitment and passion to investment, those kind of risks involved. But as India is growing, and its internal consumption also increases. So our defense, our commercial, all those things also required. Our cell phone usage, all those things required semiconductor industry. It's a good bet. I think it's not too late. I think it's good. It started, and it's going to take a long time, 30 years.
30 years and $10 billion a year for the next 30 years is what it will take to create something of significance from a global perspective.
If you want to not name India can produce semiconductors, it's going to take, because there are, because the technology is so advanced, and like Taiwan and US, and it's not just building a fab or investing capital, and the skills available is also important. So how many colleges are teaching to run a semiconductor? It's a very, very demanding efficiency operations. And one mistake can cost a lot of money. So that's the reason India has to focus in all angles before saying that I'm going to be a semiconductor. Yes, you can build a semiconductor, maybe small things. But if you want to be the leader, please get ready. 30 years, 10 billion every year.
30 years, 10 billion every year. I think that message has gone out loud and clear. But, I want to ask you this as a serial entrepreneur who started 4 ventures, exited those ventures, made a lot of money by exiting those ventures as well. What would your number one piece of advice be to entrepreneurs who are starting up, more importantly, entrepreneurs who are scaling up at this point in time?
Yes. So the way you have to look at, sometimes you exit, sometimes you continue, So that is a tough decisions. And for me, SIFI is, I'm going to keep it. And generations, I'm building SIFI. And entrepreneurs should have a passion. You have to come to work. I'm going to make a difference. We are, if you look for just, I'm going to make a rich money and calculating every day, it's not going to go anywhere. First, you have to have a great passion to build a startup, to build an entrepreneur. So that is the way I look at it should be a part of your DNA. That is the way I look at it. A true entrepreneur, don't count money, how much you're going to make. Don't come to work, how rich you are going to get. What you are going to do that day, how you are going to make the difference in the global by doing what you're doing. That should be thinking, and that is what you have to be sleep with,
You said that you're not going to give up SIFI, and SIFI is going to be your way of creating impact, not just in India, but for the world as well. So you laid out a 30-year plan that India must have to become a semiconductor player of any significance. What's the 5-10-year plan for SIFI that you can leave us with?
No, I think we are going to be, like said, we want to be the digital infrastructure provider of India. That's what we are building SIFI across the technologies. Today we are talking data centers. Today we are talking the network. Today we are talking the cloud and AI. I know it's continuously as the technology is evolving. We are continuously is going to bet, and that is the way we want to be relevant for Indian digital infrastructure.
Well, that is the dream and ambition, and you've heard it from the man himself. Raju, thank you so much for speaking to us here on Voices from the Valley. We truly appreciate your time, and we wish you the very best of luck with SIFI as well as with your plan to do a Made in India GPU. But thanks very much, and thank you for sharing with us your dreams, your hopes, and your plans for India.
Thank you.
Well, with that, it is time for us to wrap up this edition of Voices from the Valley. From all of us here on the team, thanks very much for watching. Do visit our YouTube pages, our social media handles for all the information that we brought you here from Voices from the Valley. But from all of us here for now, from the team, thanks very much.